Good morning, everybody. It's Wednesday, June 17th. You're watching Tasty Live. I am Jamal Chandler, joined by the lovely Liz Deerking. Good morning, Liz.
Good morning, Jamal. How are you today?
I'm fantastic. How you doing?
You know what? It's a beautiful Fed Wednesday.
Yeah, right. That's the big thing on the docket today is the Fed meeting. Expected to be no change. We're going to stay at 3.5% to 3.75%, but there's a lot going on. I mean, inflation is high.
It's expected to stay, but the CME Fed Watch tool says it's only a 99.6% chance.
Yeah.
So, in the words of Jim Carrey, you're saying there's a chance.
Sounds like there's a chance. It's a very small chance, but we both know they're not going to do anything.
You know that I know that you know that I know that they're not going to do anything, but yeah, we'll see.
Well, but I still expect some market activity. I mean, Fed Day is always not just about bonds, but like markets can end up moving, oil could end up doing something, gold and silver, I think. I feel like those are the things to watch the most.
I agree, and I think it's more about what he says, right, after the fact. So, I mean, I think it's going to be a moot point with the actual move, but then people are going to be listening. It's his first meeting, so we got to watch the guy. Now, the big topic was, what color do you think his tie is going to be?
It's a good question. I know. What is it? The purple tie means something. What do the ties mean again? I forget exactly.
I don't remember. I know the purple tie means something, but I don't know. I don't think it's going to be a purple tie. I think that's insane.
Yeah, neither do I. I'm curious. I don't remember what they mean. I know we got, well, of course, we got Chris Vecchio coming in a little bit. He can definitely explain.
Tell us about the ties.
Yeah, he's our Fed primer. He's our Fed primer person. I got to tell you.
I hope Chris comes in a tie.
Yeah, I don't know. I wouldn't hold on for that. Well, we do have God at some point this morning. So one of them, either God or it's Hill. But if God comes in, he's definitely wearing a tie. You know, that's going to be our new. That's going to be our new marker on Fed days. What color tie is Gad wearing? I think that'll help us.
I like it.
Last night I watched the soccer. I watched Argentina versus Algeria. Dude, Messi scored 3 goals. Messi's amazing.
Come on, I didn't see it. Fill me in. Talk to me. Give me this.
I mean, he's amazing. It was amazing watching him like just go to work. This little dude. I mean, that dude's like 5'6", all of 5'6". Yeah, but he just like I was having dinner with some friends last night. We were watching the game. He's interesting in that like. Of all the sports stars, I don't think I've ever heard him talk.
I've never heard him talk.
Exactly. Isn't that interesting? He even did a commercial last night during the game where he didn't talk. It's just hilarious. It's hilarious to me. I mean, a global star like that. I don't know. It's been interesting.
It's crazy. So obviously they won 3-0 because all of them have been 0-0. Have you seen all the soccer games? That's the
first game I've watched. That was the first game I watched.
Okay.
Really hadn't had a chance to watch that many. So I'm going to have to start watching more, but I'll probably watch more as it gets closer. You know, as you get more rounds, less teams, I'll start watching more.
For sure. Did you see that for today's day 1 of oil actually being up?
Yes, correct. The first positive day in the last 3 that oil has been up.
Since I've been doing the morning show this week.
Yeah, right. I know. I know, right? It's the first day that I've noticed that oil is positive. This is the reason why I buy the call spreads in oil. Just in case, you know, and I give myself some time just in case things change a little bit.
Oh, for sure. I mean,
take a shot.
Well, yeah, and any given day, I mean, it's up a little bit. What is oil up? 1% right now? It's nothing, but it's still up. So I agree with you. Yeah, you gotta trade to make money. Otherwise, you don't. Otherwise, we're just watching it. We're just talking about it.
Yeah, it's a way to take a shot. Are you trading anything around this whole Fed thing? What would you trade if you trade anything around the Fed meeting?
So, you know what? I'm not an around the Fed person, but usually it's going to be bonds, right? If you're going to do anything around the Fed, it's bonds. And you could sell premium around bonds if you want to, if you think it's going to be a non-event, but I think it's all kind of priced in. So there's not necessarily, I think on Fed days, I will not trade versus put on a trade. I know that sounds bad to say, but I will avoid maybe doing my SPX trades, or I'll avoid doing things that are, or I won't do an earnings trade until after, because there could be some shakeup in the market.
Yeah, that's what. So I was wondering if you, like I said, I was wondering if you trade like metals, because I know you like to trade metals a lot. Metals seem to move a lot on these.
Metals are easy for me because I'm a permeable, so I'm just constantly bullish.
Yeah, and I don't mean like trade on Fed day. I mean like, I know you don't trade it for Fed day. I just mean like once Fed day happens, if something moves, what would be that thing? I would imagine for you it would be like metals, because they end up moving quite a bit sometimes. Right? It depends on what happens with the dollar, et cetera. And then if the metals move, like, is there a trade you want to put on? Like, I feel like that's the thing you would watch.
Hey, Jamal, when the metals dip, I buy. How about that? That's the trade that I look for. So I look at it as a buying opportunity when they dip, which I know is counter. I know it's not a lot of people. I mean, a lot of people on this network don't have that opinion, but I am actually a permeable in metals. Not, like I said, not big, not huge. It's always just going to be a portion of my portfolio because I look at that more of, so I'm a trader by nature, right? I'm an absolute junkie trader. I trade all day, every day. But the metals I look at more of a portfolio than a trade. Does that make sense?
Really?
So I used to say all the time, there's investing and then there's trading. Yeah. And I look at my metals position, I'm using my options knowledge to invest in metals. Does that make sense?
Definitely. Makes sense. Yeah. You always want to have a long position in metals somehow, some way, shape, or form.
Yeah, for sure. For sure.
I hear you. That makes sense.
So what about you? What are you doing? What are you doing around this Warsh day?
Well, to your point, I'm not trading. There's no trade on that I have on in the book right now that is specific to Fed Day, I will say. The only thing I did yesterday, as we did dip into the Fed meeting as we were heading in, by the very end of the day, I did buy a calendar call spread in SPX, long June 18, long short the 17th. So basically short today, long tomorrow, and it's a $7,600 call spread. Bought it for $570. So it's just.
But you did this a couple days ago, didn't you? Because you wanted to wait till after. This was for after the meeting. You did this a couple days ago, didn't you?
No, I did this one yesterday. So you're thinking about when I did a couple of these last week. Remember on the
and
dips?
Did you take off your super bear you did in SPX?
I took that off yesterday. Correct.
Yep. I know. I was going to say, Jamal, if you don't take that off, I'm going to slap your hand.
You know what's funny? You know whose voice I had in my head is yours. You know what I mean? Like I did. Like I will definitely put things on for a specific reason, and sort of be like, whatever, that's the premium, and it's fine. I'm fine with it wherever it may lie. But then, like every now and again, I definitely had your voice in my head yesterday. It's not a profit until you take it off, and I was like, okay, fine, I'm gonna take it off. It was almost exactly like you were in my head saying it.
I was like, slap your hand. I was like, take that profit, take it, go buy your friend dinner. Like,
it was the move. I mean, down 40 points. We haven't really had too many of those. I'm not sure if we're gonna get it down another 100. Who knows what tomorrow? That was my thought process yesterday. Who knows what tomorrow?
I mean, I was surprised that we were so soft yesterday. I was really surprised because during the show all morning, we, kind of kept our wings up a little bit, and then it just slipped. It just literally slid like slowly the rest of the day, which was kind of bizarre.
It was kind of bizarre. That's why it's for that. I don't know how you say this. If it's this type of adjective for that bizarrarity, I decided to take it off. I thought it was bizarre too. I was like, why are we down? Interesting. Let me just take this.
Yeah, and I mean, it was just a slow slide down. And I think we closed on the lows yesterday. And I was looking at it, I was like, this doesn't
down like 40, 42. Yeah.
And I mean, we're relatively unched today, right? So I mean, you're looking across the board at everything, and nothing is really moving. You got green and red across the screen.
Yeah, I mean, futures are sitting right at 7,600 right now, which is a good time to get to our real first look at the markets. Even the S&Ps are right around just 5 points under 7,600 at 8.25. The NASDAQ is up 197 points at 30,500. These seem to be sticking points right now. 7,600, 30,005, 3,000 in the Russell 2000 right now. We're up 3 points. And the Dow, I guess at 52.5 or so around there. So those seem to be the areas. That was the only one that's negative today. Yesterday was reversed. All three, the others were negative, and the Dow was up. Today, the Dow's the only one that's negative.
Yeah, it was reversed yesterday. It's kind of weird, right?
Yep.
But I mean, I would say this is a relatively unchanged market, right? I think we're going to sit here. I personally think we're going to sit here all day until after Warsh talks.
It's very possible, yeah. 10-year yield, by the way, is at 4.4%. Really hasn't moved that much this week.
So, yeah, I mean, the 10-year yield's at 4.4%. That's a pretty decent return, right? So, I mean, if that's your risk-free rate. I mean, if you wanted to sit in cash, you can just sit back and earn 4.4%.
And yeah, you're right. And by the way, VIX options stopped trading yesterday for June, and the VIX future expires this morning. Actually, they're doing the settlement probably right about now. I think it was like 7:30. I always forgot what time. I used to regulate that settlement, actually.
You regulated the VIX settlement?
Yeah, I did. Yeah, in my time in reg, I got a whole crazy little bit of career, Liz. I got to tell you, so I've done some things. But enough about me.
When were you in market reg? I
was there. I'll tell you in a little bit. We got to bring in somebody. We got to bring in the one, the only Chris Vecchio. We got to bring him in. Chris, what's going on, man?
Is he wearing a tie?
Oh, we're not ready for Chris. Oh. Well, he'll be in a little bit. Okay, so I'll tell you the market reg story. I worked in market reg 2017, from 2017 to 2019, just about maybe a year, maybe like 2018. I think I left. But yeah, I was like,
so I was in market reg as well.
Yeah, you did tell me that once upon a time.
Yes. I was in charge of it, and then I always laugh about this because they put. I mean, I guess I was tall down there, but I was in charge of the box. So if anybody wanted to, exercise or assign something, they had till 3:15 to write it in and put it in this box.
Yeah.
And I was the one who's like, nope, you're done. Like I had to, I was like the security guard for market reg.
Jeez. Wow, that's interesting.
Yeah.
Okay, now we got Chris Vecchio on the line. Chris, oh, there he is. What's up, man?
Oh, he's wearing a purple shirt, not a purple tie, a purple shirt. So
this is like a light blue and maybe a flamingo pink.
Just okay. We'll accept that. But what is the deal with the purple tie? Inquiring minds want to know.
Yeah, so Powell did that because if he wore a blue tie, and he said this multiple times in public, if he wore a blue tie, people were going to go, oh, he's such a Democrat. And if he wore a red tie, people would go, oh, he's such a Republican. So he wore purple.
Oh, there you go. Okay. Thank you. Mystery solved. Thank you, Chris Vecchio.
Also, people say purple tie, time to buy. So it has a nice rhyme to it.
Oh, yeah,
it does. Have a nice rhyme to it. Yeah. Although, truth be told, tie and buy are the rhymes, not the purple, but whatever.
No, yes, the time.
What's going on today, man?
For today's Fed meeting, I mean, you see the markets are in a bit of a holding pattern here. AI had a little bit of a nice bounce in Asian markets that trade. So we have NASDAQ leading up overall. But it's another day where the VIX is going to open below 17 ahead of a Fed where the market's not expecting much of anything. I mean, I think Warsh has a fine line to walk today. The hawkish case is obvious. CPI, PPI, those are up. Supply chains have been disrupted. But the dovish case is kind of there too. The Straits reopening. The oil flow is going to resume. The inflation that has been building into the pipeline is going to see some relief. So do you overreact to it? I'm very interested to see what happens at the 2:30 Eastern, 1:30 Central press conference, more so than the actual rate decision itself. That's where the action is going to be.
For sure.
That's what we were talking about too. I mean, I agree with you. Whatever he says is kind of gonna move the markets.
And it's his first meeting, so people are going to be paying much more attention.
Yeah.
What do you
expect? What do you expect, Chris?
Yeah, go ahead. Sorry, Liz.
I'm keeping an eye on the bond market. I mean, bond market's in charge today. At the end of the day, the market needs to have confidence that the Fed is not going to allow inflation to spiral out of control, nor is it going to allow the economy to overheat or melt down. So to that end, stability in the long end of the yield curve, in the 10s in particular, keep that below 4.5%. And, we've got a stew going. And that, to me, is the only thing that matters. Yields need to stay in check today. If yields stay in check today, stocks can continue to breathe.
Yeah, I mean, that's the thing I think I'm watching the most too, like looking at those yields, looking at bonds. I don't know how much I'll trade them. I really haven't traded bonds in quite some time. Volatility's been fairly low in these over the last couple of weeks. And really, they've returned to being kind of quiet. We've seen some interesting years of the last couple of years.
The vol is gone. But where we find ourselves today, right, in ZN and ZB, 10s and 30s, we're right at the 50-day moving average. And so we're meeting this 50-day moving average, this kind of crossroads, if you will, to see if the downtrend remains or we turn a corner right with the Fed. So catalysts meet your technical level. It's kind of picture perfect. I would watch to see if we can, if notes straight through their 50-day today. That's a pretty strong sign that the market feels confident the Fed is not going to allow inflation to spiral out of control. I think about what happened in September 24 as a good framework here. The Fed cuts 50 basis points and then yields shoot higher because the market views it as reflationary. So that's the trick that we have here today. Too dovish, the market goes, oh, inflation's going to spiral, yields are going to shoot to the moon again. And that's going to cause a lot of angst in a lot of different places. So that's it. Walk the fine line, Mr. Warsh. Don't be too hawkish, too dovish. Give us your little Goldilocks here for day one, and we'll be golden.
Yeah, just right. Okay, so Chris, what do you use to trade the bonds? I know you're keeping an eye on the bonds, but what do you use in trade? Are you using futures options, or do you use TLT?
I really like using the futures options, in particular in ZN. ZN is actually a better product for retail traders than ZB. It's about half the overnight buying requirement, half the tick value. And so, it's more manageable, if you will, if you're dipping your toes into futures. But I like the liquidity of futures. Like right now, you're not trading TLT right now in any meaningful way because it's an ETF. So I'd prefer to use the liquidity of the futures market around things like this. And yes, futures options, because I'm going to stay defined risk around big macro events.
So are you going to stay neutral here? Are you doing a defined risk? Like what is Chris Vecchio pressing the button on today?
I think that this is my concern here. So this is not just about the position on bonds. Jamal always points out during Futures Power Hour when we were doing that together, it was, what do you do to bring down the beta weighted deltas of your portfolio? What am I adding in here that could reduce the correlations of what's already in this mix? And so because I'm already leaning long deltas in some software names, in some chip names, in the indexes, in NASDAQ.
Chris, not to put words in your mouth, but wasn't it all tech, no breaks for a while?
It has been, and it has been for the past few months. So what would disrupt that rally? A bump in yields, right? That would cause this long duration scare, if you will. So in my view, what I want to do here is get short deltas in bonds and notes, if I'm going to do that today, which I'm eyeing up some trades here. I think it might just be something like a long out of the money put spread as a bit of a hedge. If yields shoot up, stocks come in, but at least I'll have something that gives me a little bit of convexity on the bond side. Otherwise, it'll be cheap insurance, risking 1 to make 4 kind of situation. If it doesn't work out, it probably means the stock stuff is still working, and I'll be happier in that scenario either way.
Yeah, and I actually love that you're buying an out of the money put spread, because the vol is so low. When I'm looking at this, the ranks are so low, so you wouldn't be selling an out of the money call spread. So if you're getting short delta, that's the way to do it. I like it.
52,
I'm going to try to crack this nut here.
52 points. 52 in the orders are just almost points expected move today in SPX. So not a whole lot is expected. At least as of right now. Now, we've seen plenty of days where there's a certain expected move and we completely exceed that by 1 or 2 times. So anything could happen.
Anything could happen. It is a little bit more volatility anticipated than the last Fed meeting. If I recall correctly, the final Fed meeting under Powell, the implied move was like 36 points day of. So the market is expecting that there's some greater tail here. We may see a little bit more dispersion over the course of the session. And that should be expected. Again, it's his first meeting, and we got to watch the tone that he sets here.
When was that? Was that May 18? That wasn't May.
Yeah, that was back in the middle of May.
Yeah, right? I think it's right here. Yeah, this is the fixed one day right here.
May 20th is when the Powell's last meeting was.
Oh, okay.
Chris, it's amazing that you have these dates just seared into your memory. If somebody were to ask me when the last
It's really not. Liz, it could be filled with poetry and music and art, and instead it's filled with meaningless numbers.
I know.
Hey, they're not
I've had that before too. You have to pay attention sometimes to what goes into your brain. I have all these different years, and I still kind of remember a lot of dates of like famous people from when I was young, when they were born. I used to have that in my head all the time. Useless knowledge, like zero.
Useless.
Yeah.
Okay.
Yeah.
Chris's dates are useful. Those are useless, Jamal.
I know. And just,
It's like I can't remember to do the dishes, but like Nelly's Country Grammar, that entire album is definitely like stored in the memory of me.
He's got some useless knowledge in there
25
too.
years.
Yeah. Yeah.
Why do I still need that?
I don't know. They're not. Well, yeah, I guess we'll see if this ends up being an interesting day or a big fat nothing burger, right? You just never know with these Fed days. But you would expect there's going to be some movement, regardless of the Fed. There's going to be some movement, I would think, at some point in time. Like you said, after it might be slow for a little bit heading into the meeting itself at 2 p.m. Eastern, 1 p.m. Central Time. And then we might get a little bit more activity once he starts talking about a half hour later. But I guess we'll just have to see how this thing goes down.
Are you guys trading any SpaceX options?
And SpaceX got a bunch of new options today too, so they added even more today than they had yesterday. And it was weird because I don't know why they added so much. Can we take a look at that? Look at those. You can see the ones that are new.
912.
In me, nothing but
You can see the ones that are
SpaceX
new because
options.
there's nothing next
I felt
to
like
them.
I talked SpaceX options all day yesterday, but now I'm looking at it even more. Now that you mentioned, I do have a couple of positions. I did put on some calendar spreads towards the end of the day. I mean, SpaceX, dude. Are you kidding me?
912 days to expiration.
It officially took over Amazon. Now it's coming from Microsoft.
So
It's up today.
Yeah.
It's I don't really like trading IPOs the days themselves, but I've dipped my toe in the water here. I'm looking short the 1 standard deviation put spread right now at 1 DTE here. This is the market right now, right? We've seen reports over the past 2 days that this is the number one ticker that people are trading.
Yep.
In fact, SpaceX volumes have been so large, they've equaled the rest of the entire market combined, as it were. So I feel like you just have to have some skin in the game right now. I'm going to continue to play this like we're looking at a little bit of a financial engineering bounce. So being short the 180, 185 put spread to me works. It's risking right now. It's risking 4 to make 1, about an 85% probability of profit. When I put it on yesterday, it was closer to a 3 to 1. But I still think it's a viable trade. And for the time being, until we get through this lockup window in August, I might continue just to scalp this in that regard.
I love that. I love that. Yeah,
I'm checking something out real quick, but you know what I think happened? I'm trying to check a different account because I think the margin has come back to it, right? If you throw in just a put, I mean, just so I can check the margin, do you mind?
Yeah.
Yeah, it's not cash.
It's come in a little bit. It was like 11,000 yesterday.
Today's margin, yesterday everything was cash secured, and today you can use margin. So woo!
Yeah. A little bit better than it was yesterday.
Now you can trade naked options because before you couldn't.
Yeah,
it was like trading
good point.
IRA.
Yeah, you sure can. Yeah, I did puts. I did some calls and put spreads yesterday. So long SEP, short August. So that's kind of my place right now. Around expected moves, but good to see you, man. Thanks for coming in. We gotta bring in TP. We gotta let you go and bring in TP himself, the man. TP from Austin. TP, what's going on?
And there he is. Hi, TP.
TP, what's up?
Amazing. How are you?
Very quiet morning in the markets.
Yeah.
Very quiet morning.
For the time being.
Very quiet.
For the time being, right? Yeah, it would appear.
Okay. So, everybody's waiting for this this FOMC meeting and stuff like that. I think it's going to be nothing's going to happen, and but I just want your guys taking this. This is probably going to be the most politically inclined Fed we've ever seen. And I'm not saying that is good or bad, but whatever your persuasion is, doesn't matter. That's why I think rather than the actual decision, this is going to be, they're going to focus on the minutes about how, what stance for either raising or cutting rates are going to be for the next year or so. And I think they're going to lean towards cutting rates.
So it's pretty funny. All four of us are now in consensus. I don't think it's going to be what happens. I think it's going to be what he says, right? And his tone.
For sure.
That's exactly right. And, everybody watched. Liz, Jamal, and I were talking yesterday about bonds and taking a look at maybe a bond trade ahead of this. And I want to show you something very, very particular. Liz's middle name is Broken Wing Butterfly.
It is.
I thought it was Jay Lizard.
If I had another child, I would name it BRB.
If she did. And so it's, hey, TP, can you find a Broken Wing Butterfly? So let's just take a look, if we can. Let's look at the platform. Let's look at ZN/ZN, the 10-year note futures.
Okay.
Why am I looking at that? Because the way I see it is the ZN options are a little bit richer, a little bit higher premium than the bonds. That's I don't want to get into that right now. But go open up the 23. Let's open up the 37-day options. Just pick an expiration, and let's create a butterfly. So, and here's the issue that I'm running into. Let's buy the 109. Let's buy the 109.50 puts. So buy those for 29 cents. Let's sell two of the 108 halves. Sell two of those and buy one of the 107 halves. That creates our butterfly. And then drag that 107 half put down to the 107 half down to the 107s.
So can you do me a favor, just because it's very small numbers? What is the price of the regular butterfly, and then what are you collecting? So how much were you paying for the butterfly?
10 ticks.
10 ticks? 10 ticks.
$203 in buying power.
Take it down to 107.
Basically risking one to make 7.
Yeah, take it down to 107. Nine ticks. Take it down to 106 half. 8 debit. Take it down to 106.
No, it's not a debit. It shouldn't be a debit. You should be a credit, right?
No, it's a debit.
See, that's interesting.
That's the problem.
Yeah.
Is bond volatility, bond to note volatility have been dropping. They're both relatively low. ZN is a little bit higher than bonds.
But they're low.
So that's why I'm looking at ZN. But the point is, in low volatility products, these can be tough to trade.
Yes.
They can be tough. You could narrow the top, so you could take the.
Sure. I mean, you can.
But why force it?
Yeah,
this one.
Yeah, I mean, go ahead. You narrow it to change it to the 109 half, 109, or the 109. Yeah, 108.
You got to squeeze those together. So take it the 100 Yeah, make them closer together on the top.
On the top?
How do I do that? No.
Yeah,
So,
like buy the 109 put.
yes.
Sell 2 108 half.
108 and a half. Squeeze those. Make them tighter. There you go. You should get a credit,
Yeah,
right?
you got 3-cent credit, but you're risking way more now.
You're risking a lot more because then you don't
love
get
that risk profile.
Right.
And that's the point. So it's sometimes they don't set up.
Right.
And if they don't set up, like your mouth saying, I don't force them. I take my ball and go play somewhere else.
Yeah.
Right.
So it's either. Okay, if I'm bullish.
You and I have talked about this. Hold on. You and I have talked about this for years. Just because I like broken wing butterflies, and I do. I'm confessing right now. I love them. But just because you like them, you can't say, oh, I'm going to do a broken wing butterfly, because then when you open it up, it doesn't work. I love what you're saying, because just because you like them, you can't force it in.
That's exactly right.
Yeah.
And it's the options give you flexibility.
Correct.
Use the flexibility. If you want to be bullish on bonds or notes, either 30-year ZBs or ZNs, you can go and sell a put spread maybe in ZN. Jamal, let's just take a look at put spread, straight up short put spreads in ZN, and the reason I'm not doing a naked short put is the margin requirements are just too high for a lot of folks. Really, it's not practical. So we just go in there and maybe sell the 109, 108 put spread. Yep. See what credit we get for that. On.
Yep, we get 12 ticks of credit. Max profit 187.5, risking basically 7 to make 1.
So,
yeah, it's not great, because like I said, bond volatility was dropping, but it does give you some positive theta. That is a simpler trade. I don't love that trade either, because again, like Jamal was saying, risking 7 to make 1, even pulling that up 1 strike really doesn't get you much more. It's trading bonds like this ahead of this number. I just don't see a lot of short premium strategies in here that are attractive. Even buying call spreads, I hate the negative theta.
You do.
I hate the negative theta too,
I
but
would
you got
almost
to go to
consider.
17 range.
I would almost consider that in this.
But you'd consider buying it?
I would almost. Well, here's the real thing. What we're really talking about here, like TP has said multiple times, how vol is really low. But let's really talk about the implied vol itself. This is single digits, 4.9. Right? So even if you sell this, how much lower is it going to come in? Is it going to come into a 2? Are you really going to get 2?
Well, because that's note volatility.
Right.
That's note volatility.
Sure.
It's like 5,
Yeah.
And so so that's why I would actually look to the S&Ps here.
Yep.
I think they're going to rally them. I think and here's the point. I sold my Iron Condor yesterday, and Liz and I always fight about which strikes we pick for our SPX Iron Condor. I go wider, she goes closer in. Yeah. But I was able to take mine off for 50% profit in 2 hours, Beautiful. A little over 2 hours. It had before they sold off and all that stuff. And I'm just going to go to the well again today.
I thought about you yesterday because your strikes were so far away. I think about you every day, TP. But your strikes were so far away.
I don't owe Liz money. I promise, folks. I don't owe her money.
But so your strikes were so far away. Even at the end of the day, when we kept sliding, I figured you would still be okay. Even if you didn't get out for 50%, you probably would have eked out and been completely out of the money at the end of the day because of your strike selections. Now, I did not.
I had enough room. But it didn't really matter because I don't. I take them off just because it's the mechanics of that strategy. Let's open up SPX options and see what we're doing here. Heck, let's open up ES options.
Yeah, that's a great idea.
ES is open, so it's the same concept, and now you can close everything.
To that end, are there different reasons you choose ES options at times over SPX options and vice versa?
Mainly because right now I can actually execute ES options. I don't think the SPX options are trading.
You're right.
Are they?
You're right. I was just curious, like during daytime.
It's 8:00, and the reason is the whole pattern day trading stuff that's gone. I may not have a futures account. Also, the tick size on the ESs are a little bit smaller. Right.
Yep.
So the credits, the actual dollars you take in is less than an SPX trade. I mean, yeah, you can widen it out. But if I sell this, let's say, if I sell that put spread, it's what, $50 a point as opposed to $100 a point. So it's just less credit. It's just less credit. And the markets are decent in here. Let's just sell that for $1.75. See what we get.
Bam! Immediate fillage, very liquid.
Take a fill. Yeah, these things trade. And so that's how I would be biased towards this FOMC meeting. If I can't get anything done in bonds, I'm just going to look at the S&Ps, and I think they're going to rally them up today.
Yeah, I think you're right too.
I like that you can trade when it's not 8:30 yet, it's 8 o'clock, and you can always get in the futures options.
Yeah. Oh, they're always available.
The other point is too, guys, is we can also look at the currencies. So if you think that rates are going to go nowhere, and that might be bearish on the dollar, you could buy the yen here, you could buy the euro here. But again, the premiums just aren't that high for the broken wing butterflies. Let's open up let's look at the Japanese yen options let's go 15 days. Let's see what they look like. And, let's do the same exercise. Buy the 62.75 put. Yeah, that one. Sell the 225 put 2 times. And then buy the, the 75? Yeah, 61.75. Yeah. Okay, that gives me an 11 debit, and drag that 61.75 down to the 61.25s. See what I get.
Yeah.
One more.
So,
one more?
As somebody who's done this, it's very hard to do in the yen. You're never going to get a credit.
No.
Just because it's almost impossible to do broken wing butterflies in the yen.
It's the same thing. And so what you do is, when Liz says it's almost impossible to do this in the yen, because she's looked at this 1,000 times. Okay? And you try to do this. In this exercise, it doesn't work. Right? So the yen, I would just go back to forget the broken wing butterflies. Remember, broken wing butterfly is a butterfly plus a short extra spread. On the put side, it's a short out of the money put vertical. On the call side, it's an out of the money call vertical. You just focus on the call vertical part or the put vertical part. If you're bullish on yen, which I am, I'm selling put spreads in yen today.
Yeah, no, I agree. I like it. And there's a couple of things you could do. I know Jamal went to the FX markets too, so you could always do that too. You could trade the FX markets.
Absolutely.
I prefer the options in 6J. I'm kind of with UTP, an old school trader.
Yeah, there's nothing wrong if you just want to make an outright bet on a currency to buy it in the Forex market. That's awesome, and it's a great way to understand the mechanics, of that market with the overnight rolls and the adjustments to it like that. But the bottom line is, just for pure trading, I'm an option trader. If it's okay, I might take a shot on a currency, but my bread and butter is doing option trades. And that's why, like Liz just said, if I'm going to make a speculation on a currency, I'm going to the futures options first.
You want the pure exposure of the yen itself.
You get a little bit of room to be wrong, right? With the options, you're giving yourself a little bit of room.
100%. And I can manage it, and I get paid every day. I get a little bit of theta, things like that. I mean, yeah, we've talked to Mike Butler about this last week, trading the Swiss franc. If you look at the interest rate differentials between the countries, you can earn that carry between them on an FX trade. But to me, that's not so much a strategy. It's a nice part, but really you're still taking so much, you're making a directional bet on the currency. That's what your P&L is coming from.
Yeah, it's the direct exposure a lot of times, right? Like with the yen, for example, versus doing that cross, whatever, dollar yen cross. Sometimes, they're little, they move in ways that you don't even imagine. You're not used to it, versus just having the direct exposure on just one of those currencies is probably a little bit easier to do. You
guys are looking at SpaceX. What's SpaceX doing right now?
It was up a couple of bucks, I thought.
Breaking news from an option trader to an option trader. It's margin now. Yesterday, everything was cash secured. Now,
no way.
Yes. It's only
really? I'm still not selling naked puts in there, Liz. Because it's just too steep. It's even regular margins. It's just too steep. And the other thing too, remember, Okay. This is coming from the guy that built all these margining systems. The brokerage firm, the margins you see are minimum numbers. Brokers can raise the margins to whatever they think they need to be. Okay, so it's what the FINRA and the SEC and the Treasury Department send out are minimum numbers. So, but if the broker says, I don't like Liz Deerking's kind of play, she's taking way too much here, they're going to increase the margin requirements, and that could very well happen in SpaceX.
And just kind of clarify that. You're saying broker to broker, they can change. There's a minimum requirement, but they can always make it more. Broker to broker.
Yes. Yeah. Hey, so what's the pre-market to SpaceX? 'Cause I sold some put spreads yesterday.
Yeah, it's 209 and a quarter right now. It's up a few bucks.
Up again.
So about $8. All right, so I'm okay.
Yeah,
I'm okay.
$8.
I sold 2-day put spreads in there because I want to play. I want to be like the cool kids trading SpaceX.
I mean,
but again, I'm not selling, and I don't care what the margin is. I'm not selling naked options in there. It's not worth it. But the volatility has, it's gone up a little bit. Go and open up the 2-day options, Jamal, please.
Yep. It was like 200.
179. So that's down a little bit. And granted, the options aren't open yet, but it was like 211.
You're right.
215 yesterday, the overall IV in SpaceX options. So you're getting rewarded for taking risk. That's what volatility is, folks. That's what implied volatility is. We looked at it in bonds, didn't see it in bonds, didn't see it in notes, didn't see it in the yen. We weren't being rewarded for taking risk. SpaceX, you're being rewarded for taking risk when you sell options.
I mean, you are, but this thing is 100 vol flat. I don't know how much more it's going to come in. It's going to be some time. I mean, when you look at like ASTS and Rocket Lab, those things have stayed at 100 plus vol. They really haven't come in a whole lot. So I wonder at what point how much vol comes in, if at all?
None.
Clearly, volatility for space is 100.
None.
And TP, we got a question, Jamal and I got a question yesterday being like, how, and I'm asking because you're a volatility expert and have created a lot of the models. If you notice, there's no IVR right there. When will that come out? How many days need to trade in order for that number in the IVR to say whether or not SpaceX volatility is high for itself?
I don't know what the dev team has actually coded for the hard. In other words, if they've added some flexibility, but what the IV rank number does is look at the past year of data, 52 weeks, looks at the high value, the 52-week high value, 52-week low value for the IVs, and see where current volatility is in that range. And right now, with only 3 days of data, you don't have a year's worth. So I don't think we're going to have it until next June. That would be my vote.
Really? Okay.
Unless the dev team makes some adjustment for it.
Okay.
And even then, Liz, it doesn't matter. The IV rank doesn't matter. When you get 200% volatility, the IV rank doesn't matter.
It doesn't, and that's a good point. When you've got that high implied volatility, the IVR kind of gets thrown.
It's just screaming.
Yeah, agreed.
Yeah, I mean, boy, that's like I said, it's pretty high. We'll see what, as Liz astutely noted this morning too, they got more options coming out. They introduced some new expirations. October and November are here now, as well as February and March of next year. So, and December of next year. So just more
all sorts of ways of blowing yourself up.
TP, thanks, man. Good to see you. We're going to take a quick little break here. Markets are kind of flat right now, just under 7,600 on the E-mini. S&P's up 4.5. NASDAQ up 155 points. The Russell up 80 cents, if you will. And the Dow, the loner to the downside today, opposite of yesterday. We're going to take a quick 90-second break. We'll be right back. You're watching Tasty Live.
I'm AJ Rudolph. I'm a senior product manager here at Tasty Trade, and I just qualified for the World Poker Tour $5 million free roll in Las Vegas on Friday. So I've been playing poker for about 20 years, actually. I started just with friends. It was like 2005, I think it was, where everybody was like, yes, let's go play poker. There was a huge boom around poker. And I actually feel like that is coming back around again. Right now, there seems to be a lot of interest, and the fields are growing, and everybody wants to get in there, and everybody has a chance to win. That's kind of the cool thing about all of these big events. I feel really privileged that I have the opportunity to go and do this. This particular tournament is only 2,000 people. You cannot buy your way into it. You have to win in order to win your seat, and that's what I did. And so I just buckled in and played my game and really focused and won my seat. I'm a very aggressive player. I do rely very heavily on reading the players at the table. I think that's super important. To be a balanced player, you want to make sure you're doing the math, you're reading the people, and you're doing all of those things in combination with each other, so that way you're using all the tools that are available to you.
Hello, Jamal. We're live.
Hey, what's going on, everybody? Welcome back. You're watching Tasty Live. I'm Jamal Chandler. She's Liz Deerking. Errol is in the house. What's up, man?
What's going on, brother? How are you doing today? What's going on, Liz? Good to see you guys again.
Good to see you too.
Good.
What's going on?
Nothing. I was walking in here. I'd seen the producers looking at me, Laura, Chuck, Matt, all of them. I know they're like, look at this Target manager walking over here. So, other than that, I know we're 20 minutes towards market open. I know we got CPI later on today, so expecting a little bit more volatility into the market. But what's been on your guys' mind?
I mean, we're all watching out for the Fed meeting,
Yeah.
and see what happens there. Obviously, paying attention to the second day of options trading in SpaceX. So we're watching just all those kind of things.
Did you guys dabble in any of the options yesterday? I think they dropped.
Yeah, I did a couple of spreads.
Yeah.
I did a couple of calendar spreads, calls and puts,
Yeah.
just to kind of have something on to keep an eye on it. Like Liz says, it's if you don't have a position on it, how are you going to keep an ey on it?
Yeah, it's a great point.
Yeah. And you have to have a position. I mean, if you're going to a cocktail party this weekend, which I'm sure you are, Errol. But if you're going to a cocktail party this weekend, you have to be able to talk SpaceX options.
That's a
I
really
mean, you
good
can't be
point.
the coolest person there if you're not in SpaceX.
No, it's a good point. And I know, Liz, you made the point, you'll have some things in your portfolio and it keeps you up to date with what's going on. And then also you can kind of start getting a feel for the personality, of that specific underlying too. So I'm sure as time goes on, you get a little bit better of a feel for how SpaceX trades itself. So that's what we got going on.
Yeah, I mean, the biggest proxy up until this point was looking at ASTS and Rocket Lab, and I feel like people aren't even paying as much attention to those now. It's easier to just pay attention to SpaceX.
Yeah.
What are those doing? Did those go down, Jamal, when SpaceX?
They did actually. So you remember I had the two positions. I had one that had a Super Bull and one that had a Super Bear. I took the Super Bear off, kept the Super Bull on, and the Super Bull is an ASTS, but it's done nothing but trade lower since.
Oh, wow.
Yeah.
See.
It's looking like a lot of airs coming out of these names. I know ASTS kind of topping out around 133, now trading at $82.
Yep.
So I mean, some of these are kind of getting taken to the woodshed. Not to be too dramatic, but they're definitely pulling back since SpaceX is.
I mean, this was IPO day right here, and it's done nothing but trade lower since then. And Rocket Lab, let's see, similar deal, kind of the same thing. Yeah, same, almost identical chart. Just took the prices away; they look the same.
Yeah.
Yeah, but you're right. Like, why do you need a proxy if you can use the real thing now? So that was kind of a placeholder for it, right?
Yeah, it seems so.
Yeah, it would seem so.
Yeah.
When we talk about Fed days, usually there's a lot of different things moving. Sometimes it's markets, sometimes it's metals, which I know you dabble in. Sometimes it's bonds. Which of those? Or maybe sometimes it's oil. Maybe on a day like today, talking about inflation. Which of those has your attention the most?
To be honest, just because of the trajectory that oil's been on over the last few days. On a larger time frame, bearish a little bit of oil, but with the velocity and the range to the downside it's been putting in on such a short time frame, a little bit of long delta has been attractive this week. So depending on how CPI pans out, I think I'm going to still be looking at USO. One of my favorite products, pretty liquid, solid liquid options as well on the USO product. So maybe a little bit of long delta. And then for the broader market, I have some of those out of the money call spreads I'm not the biggest bear, right? But I do still have some of the out of the money call options we sold. So 31 days left to expiration, sold the 755s, sitting around break even right now. So it'll be nice to just hold a little bit of the indexes through an event like this, and then also pick up a little bit of long delta. So I'm not doing anything in the broader market.
Just to clarify, you're not. Yeah. Just to clarify, you're talking about the FOMC today, right?
Yeah,
CPI.
Yeah. 100%.
Okay.
FOMC.
I just wanted to clarify that because that's so you're looking at oil as a proxy to trade something through today's.
Yeah, 100%.
FOMC.
It'll be interesting just to see when when the decision comes out today, just how oil responds. Like if there's any volatility in there, the direction it goes, it'll just be interesting to see how it's correlated or inverse correlated, depending on, whenever the news hits today. So
yeah, I got you. See what those algos do. It's because it always hits around. I mean, the statement itself. Well, yeah, the statement itself is going to hit at 1 p.m. Central, 2 p.m. Eastern, and then half hour later he comes on and talks, and that's usually when we see a little bit more. Well, yeah, at least in the past. Very first meeting for Kevin Warsh. We'll see what he says and how
I think he's going to catch a lot of strays. I think he's in a very unintentionally, Jerome Powell brought a lot of attention to the position that he's in. So I think it's going to be interesting how people kind of pick apart the things that he's saying, maybe the things that he's wearing. Oh, he's wearing this color tie today. Yeah. So I don't know. A new guy being in that position, I think is going to be interesting to see how he's kind of not necessarily accepted by the public, but it'll be interesting to see the public's reaction based off of the things that he gives us.
I just really thought about it. This is big for you. This is like the first time. This is the first change in Fed chairs since you've been trading, huh?
100%.
It's like when the president changes for you. Like when you're growing up, you think of the president one way, and then another president comes in. This is different.
This is the first time. Again, before inflation started going crazy, or I guess COVID 2020. Whenever we had the market crash and we had to send rates lower, that was the first time I really started honing in on interest rates, what they are, how the market responds to them, who talks about CPI day, all those kind of things. So 2019, 2020, when the market crashed, that's what really brought my attention a little bit closer. So it is a first for me though, new Fed chair. So
are you guys gonna listen to the minutes? Or do you just let somebody else digest it and get the bullet?
I usually just plug into Twitter. I usually plug into Twitter like 5 minutes after, refresh the feeds, kind of see what goes on.
Yeah, that's probably what I'll do, man. And there's been times where I'll watch the whole thing. Again, you could tell the market was depending on what was going to happen and come out of the Fed. I don't feel like this is one of those situations. So I don't know. I'll just probably watch my Twitter feed, which people have kind of seen now a little bit when I go on Twitter and like I have my whole setup. I mean, I'll probably just watch that because for me, that's like the biggest sentiment indicator. I can just see different things that are said and they'll come out in the order of kind of importance, honestly.
Yeah.
It is interesting though, because it's kind of whatever he says he's going to say, but the market's going to react how the market's going to react. Yeah. And I think that after having lived through as many of these as we possibly could, it doesn't it matters what they say. It does matter what they say, but the market could react violently in one direction or the other, even with the same verbiage. So we'll see. It'll be an interesting day.
Yeah. Are you kind of a little bit more hands-off, Liz, prior to an announcement like this, and then maybe do some adjustments depending on what the reaction looks like afterwards? Or how do you kind of position ahead?
That is usually what I will do, because you don't know if it's going to move or not move. So I do sit on my hands until after the meeting. I mean, we don't have any earnings on deck or anything like that, but what I will avoid is trying to do earnings trades or anything that is really binary until you get to see what the market's actually going to do, and then you can kind of trade. I look at it as an opportunity too. If there's things that are in my my more investment portfolio that are down, I'll look at it as buying the dip and things of that nature. So I mean, I do kind of sit on my hands. Now, I will be trading a lot of SpaceX options today because I don't think that's really going to move on this news, but who knows?
Yeah, who knows, right? Yeah, it really depends. It is up 7 points today, so it's making another move to the upside. It's been nothing but green bars in SpaceX.
And won't stop.
Yeah. Literally going to the moon, I guess.
I haven't traded it yet today. So I haven't traded it yet since the options even dropped. So I gotta get in there and at least do something and manage it.
Gotta have some cocktail
I gotta be able to say I traded SpaceX, like physically traded SpaceX. I gotta be able to say that. So I'll keep you guys posted.
You didn't do anything in it yesterday, Errol?
I didn't. I mean, I was watching it. I debated on buying some of the shares, but I was like, hey, you know what? I know we got the Fed meeting. Maybe it was an excuse that I had given myself, but I was like, we got the Fed meeting tomorrow, FOMC, 1 Central. I'll be patient and wait afterwards. But especially being the first week where we have options, I'll keep you guys posted on what we do in there and how we manage the risk. So
nice. Love it, man.
I like it.
Love it. Well, Errol.
Yeah.
See you around,
pleasure,
bro.
as always.
As always, man. Great to see you, man.
Cool.
We're going to take a quick break here. E-mini S&P starting to move a little bit higher to the upside, 11 and a quarter, just under 7,600, 30,500 on the NASDAQ, up 194 points. Russell up 4 points to 2967, excuse me. And the Dow 52,400 down on the day. You're watching Tasty Live. We're going to take a quick 90-second break.
thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Okay, cowboy, here's an earnings event. Keep an eye out for them when you open your trade. They're fast, they're loose, and they can take you for a wild ride. But that's no reason to steer clear, because you can be your own personal earnings event if you take the bull by the horns. What makes earnings events so special? Before the event, people will start guessing how the stock will move once the earnings report is released. That, in turn, makes the options IV rank higher. Like way, way higher. The nearer the event, the more the speculation, the higher the IV rank. Then right after the event, IVR goes the way of the buffalo. If you sell high premium options right before the event, when IVR is really high, you can take advantage of inflated prices and lock your profits when volatility disappears. Only if, and this is a big if, the stock doesn't move against you. If it does, well, sometimes you eat the bear and sometimes the bear eats you. Earnings events can hit you hard, but they can also pay off big and fast if you play your cards right. Pretty simple.
What's going on, everybody? Welcome back to Tasty Live. It's the opening bell just around the corner. Markets are up right now. 75.97, excuse me. 75.97 on the E-mini S&P's up.
Did we have a number come out this morning?
We had retail sales at 7:30.
Retail sales. It didn't move anything,
did it? Yeah. We had retail sales.
I mean, I don't think retail sales move them. That's not why the spoots are up 10, right?
I think it has the potential. I mean, I think it's an interesting read-through. I didn't look at the number at all, but it's an interesting read-through, right? If the consumer is able to withstand the current environment of inflation, that's the question, right?
Yeah.
Excuse me, as I take a quick.
So they did, and I knew we had something, and it didn't even
coffee
really
that our producer Gabby got for me. Thank you so much, Gabby.
Gabby's getting you coffee now?
I mean, she hooked it up.
That's amazing. That's amazing. Is it from the coffee shop downstairs?
No, that thing's gone. You know that.
It is?
Yeah. That thing's gone. Yeah.
Oh, I come in.
Don't know exactly why I don't know exactly what his situation was. I'm not sure. I don't know why he left, but he left. I think he owns a couple though.
Okay.
Yeah. But Ever is still here.
Traveling. All right. So what are you doing this morning? Hey, can we take a look at something? Did you put that natural gas position in yesterday?
Which natural gas position?
We did it with TP, where we did a downside broken wing butterfly and natural gas.
Oh yeah, I remember that. Where's my nat gas? Right there. I did not.
You didn't get filled. Okay. I just wanted to look because natural gas is down today, so I layered another one on top of it.
Where what are we talking about? What are we doing? Tell me.
So it was the
this
one we did with TP,
July.
41 yesterday. Days? It was in July with 41 days. Okay. But I was just saying that natural gas is down, and that's what you kind of like with the broken wing butterflies. We don't need to put another one on, but
I don't have one on. Tell me.
So I go to the expected move. So I do mine a little bit differently. Sell 2 2.8s.
Okay.
And buy 1 2.5.
Sell 2 buy 1.
I'm sorry, 2.85. You're right there. So
you're selling two. I said
2.5. So sell 2 2.8s and buy 1 2.85.
Oh, okay. Gotcha.
Yeah, up above it. And so what's the credit there?
That is a credit of 40 cents.
Okay, and then buy 1 270.
So 7-cent credit.
7-cent credit, which is $70. You can shift that around.
Any of these.
You never do anything. Oh my God, I love them, Jamal. Yeah. I mean, you should see my positions in natural gas. It's just like you open them up and it's like.
Where's this?
I layered another one in today. But like I said, this is a big product, a very big product. And I will usually do the ratio spreads. So if you delete that 2.7, I just want to talk about what I do on a daily, just delete that leg, what you're breaking. Delete that leg.
So right now we're long one of the 285s and short 2 of the 280s?
Yeah, so this is my go-to move in here. Now, because I have a big enough account where I can handle natural gas in this, but when I look at this, so if I do this naked, right? So I got one naked natural gas position, and I understand that that's a lot of risk. And then I will immediately go in after I get filled on this and put an order in to buy the 2.75 after the fact for, what are we taking in here? 40 cents?
Right now taking in 40 cents, yeah.
Yes, I'll put an order in to buy it for 30 cents. And so then I'll have completed the butterfly, locking in $100.
Okay.
So that's what I usually do if I have a naked option in natural gas. But with the show accounts, because they had been smaller in the past, Jenny and I would always have to break the wing because that was also a good way to do it. But
yeah, I mean, this is a pretty good way to do it.
You take into credit. It's kind of like you want it to go down because I've seen this. You can let them go, Jamal. That's what my favorite part about natural gas is. I just let it go until the end. A lot of times I'll have butterfly. And as Mikey, the Polish warrior, would say on Twitter, and you'd have like a forest of where you want natural gas to land.
A forest.
A forest. Right? So you got peak.
I'm going to try and I'm going to do this broken wing butterfly, 285, short 2 of the 280s, and I'm going to buy one of the 260s. I'm gonna just do this.
There you go. Yeah.
Collect 20 cents. We'll see if we can get filled on that.
I mean, 20 cents, which is crazy in natural gas, is $200. Okay. Just to kind of, it's a bigger tick. It's a bigger product, but I like it.
Yeah, it's true. I like it too. I like those. I don't do those as much. You're right. I know there's people who do a lot of broken wing butterflies like that in times, like say we're moving to the downside in SPX, and you'll do that broken wing butterfly, and then it'll come back, and then you're able to roll the longer leg that's spread out and basically have on a free butterfly. So
a free butterfly, or a butterfly for a credit. So a lot of times we would have done that too in SPX. You kind of follow the move. So if we're up, I would do an upside broken wing butterfly that if it continues to go up, great. And if we're down, I'll do a downside broken wing butterfly. If it continues its plate down, great. If not, then I try to lock it in for a profit on the other sides.
Yeah. Now we're trading like Liz. I
like them in big products. I know TP was trying to look at them. It's very hard to do in the yen. It's very hard to do in notes. Anything with a low volatility like that, you almost need a bigger product.
And I think that was his point, honestly, just showing you how, I think it's a great point. Look, there's a million things we can trade. Don't necessarily have to force a trade in something just because of a catalyst or what's going on, right? Like there's other things to do, but it's interesting too to note how that strategy doesn't work in those products because the volatility is too low. It's really not high volatility. Honestly, that's I think that's fair.
Yeah. Like I said, natural gas, it almost always works, and I almost always do it to the downside. If we're in the 2 handle, I don't like it when natural gas was up higher.
Yeah.
But the markets are going to open in about 30 seconds.
Yeah.
Let's look at SpaceX options. I want to see how tight the new ones are going to be when they open.
Yeah. Good point. October. I know that I've heard rumors that they might not do earnings here like they do quarterly. And I was talking about this with Chris yesterday. They're not going to do necessarily quarterly earnings, but they will put up on their website, that kind of thing. Markets are open. S&P 500 E-mini futures up 5 right now. They kind of been sitting here all morning, hovering right around 7,600. Same thing with NASDAQ, hovering around 30,500. Similar with the Russell, hovering close to 3,000, and 52,400 is your Dow. All of them are positive at the moment, but they're fluctuating around. This is going to be that kind of day. SpaceX up 8 points here, Liz.
SpaceX up 8. Wow, it's another day, another up day.
Yeah.
Is this rally going to hold in SpaceX? Are we going to have 4 green days?
I think it depends on the market today too. If we somehow turn around after the Fed meeting, I feel like SpaceX has to fall as well. That's kind of what started happening yesterday. As much as it was up, it went up as high as 225, and then we faded throughout the day, and it kind of faded as well. So it's already kind of moving with the market. How about that?
Yeah. Yeah. Well, I mean, it should be. It's already in the NASDAQ, which is kind of crazy. Bitcoin is down today too, isn't it? I mean, that's the one thing. So all
Down
the cryptos are down?
750. Yeah, all the cryptos are down. IBIT surely down percent. Kind of long in this thing in here. Kind of got.
It makes me happy when you open yours and I see position. What do you got in here?
I'm long 100 shares. I sold the 38.42 strangle in July, the 31st expiration. I did those strikes specifically because it was trading 38 at the time. I wanted to remember that when I sold the put. I figured it was going to end up looking like this. I am long shares from another put I sold a while ago. And then I sold that strangle, and then I got a little bullish position out in August, selling 2 to buy 1. I did this on a day where it was trading 35 because, again, I wanted to remember. And at some point, this thing is not going to be so hated. It'll bounce. When it does, that's what this position is for. I went out to August for it. Probably should have went out to SEP. And then I just have another short call that I could probably roll down at this point, but I don't know. I don't like to roll. This is September. I'm just going to leave this for now. I sold this base. This is the short that's actually against the shares. So those are the
that's the short.
Rarely do I have that many positions on in one name, but I do in this one.
I like it.
Yeah.
So I like the strangle around the stock. I can't believe you sold an extra short against it. It's pretty cool.
Yeah, I know, right? Yeah. I mean, in that name, in the way it's moving right now, and the way how high the vol is, it's not. I shouldn't say high. It's really not that high, but it's higher than most. I mean, I always look at IV rank. I think that's the most important metric with something that nobody else has that we have. But you know me. I'm an old school trader. I like looking at the actual implied vol of something as well. And 40, that's not high compared to Bitcoin historically, but it's kind of high for an ETF. So kind of like that.
It is. It's very high for an ETF. So, I mean, I agree with you there. So the implied volatility still is high.
Speaking of high volatility for an ETF, EWI is another name I'm short. I got a strangle in here. I did this earlier this year and got my ass handed to me, actually, is what happened. And right around here, I started doing like 150. This thing went up to like 180. I was like, dude, I'm out. And rightly so. It kept going. But now I feel like semis have calmed down. Have you noticed that a little bit the last couple of days? They've kind of calmed down a little bit. Like they're still making moves, but they're not making huge
they're not making the
40,
moves
50,
that they were.
dollar moves, et cetera. Let's take a look at Micron, by the way. 2%. 2% is acceptable. That's fine. 5-10%, that's a bit much.
Those are crazy when you get into the 2020, like the wild gaps up that you saw for a long time.
Yeah. Speaking of gap up, SanDisk back up once again, 2,000. Again, a muted move for now. Looking at my watch list here, NVIDIA is up 75 cents. Google's down at the moment. Apple continuing to go higher more recently after the big fall. It's starting to bounce back. Got some calendar calls in here as well. Calendar calls, I know I say it a lot. I'm telling you, I used to hate the idea of a calendar call because I just felt like it was a silly trade because it just didn't work in a world where everybody knows everything. How can you sell vol in one expiration and buy in another? That doesn't really matter anymore. However, I found a way to manipulate them by going to the expected moves and going some time out, and it works. Work well.
Now, when you set them up, would you try to keep it symmetrical, or your 30 days, 90 days? So you've got a lot of days in there. There's actually some sales in there if things go wrong too.
Yeah. So in this case, I bought, and again, it does vary my decision on the name sometimes. Like this 300 one, I actually probably should take off at this point. I don't know. Depends on how far out. Depends on what's going to happen in the name. But I do keep them symmetrical, and I try to. It depends on my my current feeling on the name. Like Apple, after this big move we had, right? I just showed you the chart. After this big move right here, I was like, okay, I want to get long some Apple, but I don't really want to buy calls. I'll do the calendars, and I'll get long, and an expiration that has earnings, which is August, and or after August, I should say, after July 31st, and I'm going to sell anything in front of that. And so that's kind of the idea of the genesis. Oh, the nat gas, we got filled. Got filled on the nat gas trade.
Yeah, good. What was your credit in nat gas?
20 cents.
20 cents? Okay.
Yep.
You know what you can do, Jamal? Can you open up the options again for me real quick?
Yep.
In natural gas? Okay, just go to natural gas and then the position page, if you open it back up, the cycle that you're in.
Yep.
So you can, if you put an order in, and I put it in as a GTC, to sell out your long and make it a symmetrical butterfly, and so bring it up to the 275, right? 275 would make it symmetrical.
275.
Right, because you're only broken by one wing, so you want to make it a real symmetrical butterfly. And put that order in for, if you collected 20 cents, put it in for a dime. So no matter what happens, if you get filled on this, you've got $100 collection and a butterfly that you can take a shot at.
True.
And put it in as a GTC. And I am ordering you around, and I apologize.
I mean, there's no way that gets filled.
No, you're not going to get filled, but you will get filled sometimes, Jamal. Here's what I'm going to tell you about natural gas too. Sometimes you're going to come in. You can come in and be filled overnight, depending on if you get a pop in natural gas.
Yeah, good point.
If you get a pop up, you could come in and have a butterfly that you've got a dollar credit on, or $100 credit.
Yeah, good point.
Yeah.
Point on that.
Sorry, I didn't mean to order you around. That's your first.
No, that's fine. Actually, I'm fine with it. I don't trade that way. I don't. So I'm glad you're telling me. I don't think about it like that. You know what I mean? Like I just put that trade on and I was like, cool, I'll collect the 20 cents. I'll just leave it the way it is. But I never think about it like that.
Yeah. So then you can, because there's 42 days. If there was 10 days left, I would tell you to keep your $200. You've got 42 days left in this trade. If you come in and you locked in $100, then you can take another broken wing butterfly and put it right on top of it. So then you've got the peak here and you can create another peak.
Mm-hmm.
I'm a junkie. I've been creating.
This is your trade. This is what you do. Like that's what you do. You know what I mean? Like I get it. I totally understand.
Creating lots of complex option orders for years and years and years.
More selling and CME. More selling.
Was the SIBO down too yesterday? I know the CME got hit, but was the SIBO down as well?
Yeah, both. More recently, got a couple positions on in both. IX as well. So yeah, that's the story there.
But you know what? I've never looked at this.
Yeah, I just noticed it yesterday. Yeah.
Is this liquid?
Not really. But I sold a put in here anyway. Just in case we get the bounce at some point. So yeah, even the S&P's up 375.90 right now. So kind of NASDAQ, I feel like is kind of, no, it really hasn't turned. It's been in the same spot. They're all kind of in the same spot. Russell did take off though. Russell's up 19 all of a sudden.
Yeah. Yeah.
Russell's up 19. Let's go to the watch list here. Let's look around futures here. What's moving? Well, we got wheat up some. We got Brent crude oil moving up. We've been talking about that a little bit this morning. Oil, first day in a while, it's up $1 right now. Crude oil, 76.30. Corn is up. So you've seen some commodities move to the upside. We just mentioned Russell 2000 becoming the leader in the clubhouse here as far as the equity futures go. And lean hogs. You ever trade lean hogs? You ever trade any of those?
I have. I have traded lean hogs and live cattle. I've traded both.
Yeah. Very interesting.
I don't know why they have to make them lean or why they have to make them live, because I've never traded a dead or a fat hog. But
yeah, right.
But I mean, kind of to TP's point, this is I would lean towards those because I'm a volatility chaser. If there's nothing else going on, I would go there. But right now we've got volatility across the board, so I don't need lean hogs or live cattle. Do you know what I mean?
Exactly. Yeah, you don't need it in your life when everything is going so well. J-Bill, AMAT leading the leaders to the upside as far as the S&P 500. J-Bill up 11%. I forgot about that stock. That stock's $400 now. Wow. AMAT, $600. Holy cow, man! I just haven't.
I don't have anything in AMAT.
Me neither. I mean, man, I hadn't said that name in a while, but wow, it's up. It's $600 stock. Lam Research, same deal, $300. So the semis are kind of moving. Those spaces are moving a little bit. Some of these other names, Mosaic, that's up $2. Robinhood to the upside, about trying to break 100 once again. Interesting to see Robinhood up.
Wait, is Robinhood's up today?
Yeah, it's interesting to see that up with Bitcoin down and the market kind of flat.
Well, yesterday Robinhood said they were firing 15% of their workforce. 15 or 10, one of the two. Yeah, and the odd part about that is stocks usually go up when companies get.
It does happen. It is a phenomenon. Yeah, for sure. Intel, Williams-Sonoma. Let's see to the downside. What do we got? Carvana. I think they had earnings. I didn't trade it. Not really looking at earnings right now. Like to your point, like there's a lot of things I can trade. Not really. There's not these. Most of these earnings are not that interesting to me. I'll wait till the next cycle, which is coming up not too far. I mean, or is that July? I mean, when's it's probably a while, huh? We got J.P. Morgan earnings like that.
I think we've got quite a bit until the bulk of earnings come, and it's usually, if you want to take a look, it's the financials that kick it off.
14, yeah, July. We got a minute.
And
July
I get so excited for the financials, and then they're terrible earnings vehicles.
Yeah, I know, right? They used to be great to trade on earnings sometimes, but I don't know. More recently, you're right. It's been kind of terrible. Go back to this watch list. What other names? We just mentioned SIBO being one of those down. Adobe is down. I think that stock is cooked, man. I feel like in a world where an AI is creating images, why do you need Adobe?
I don't know.
You know what I'm saying?
I don't know. I think, so I do think AI is going to, this was the age-old discussion. If it's going to create jobs or take away jobs, I think the jobs are just going to change. And I think Adobe is one of those things that's just going to go kind of by the wayside. But you never know. Exactly.
I think that's the case. There's going to be, that's exactly what happens, right? There's just change created, just moved around. I mean, it's just find different ways to do things, I think it would seem. So that's how it goes.
What about NVIDIA? Tim Knight was pretty interesting yesterday, where he pretty much thinks that NVIDIA is going to be the catalyst for the down move. What is that stock doing today?
It is up $1.30, 208 right now.
Now, I am not a chartist, but I hope when he comes on that he brings NVIDIA again with that box around it, because I want to see if it broke out.
Yeah, it was the box. It was basically in this range right in here, right?
Yeah.
To say kind of there's possible failure, but that was, it's trying to stage a rally. I guess we'll see. I could see. I mean, and again, if you just like look at the last time it was at this level, when was that? That was October of last year, and then we ended up seeing a fall. So who knows? That's what the chartists look like. Look, I like charting. I look at a lot of charting stuff. I mean, there's honestly, you can make a lot of stories up based off of charting too. Like you just can, based off of things. Like I could literally use this right here and draw this line and say this is the last time it had failure, and it's probably going to fail again. You can do that, or you can say if it breaks this line to the upside, then it's strong.
I mean, I guess you can create anything you want to out there. I've never seen the charts. It's weird. My brain doesn't work that way. I need the option chain. So when I'm looking at this, I look at charts as just for fun, kind of a visual to see where it's been. But I've never been a chartist. I'm a straight up quant. Options, just the numbers.
Yeah, I kind of started off as a chartist. I understood charts before I even knew what options were. And the hardest part for me, actually, Liz, when I was learning how to trade options, was trying to marry those up. I couldn't do it. Like I was trying to make it work and figure out what strategy I want to apply based off of a chart I see. And it was really hard. And eventually I kind of figured it out with some help from some senior traders that I learned from. I was able to kind of marry it a little bit. And again, it's not an exact science. Like just because a chart, might confirm something for you doesn't necessarily mean your strategy is going to work. But you try to put on the best strategy based off of what you see.
Based off of what you see. And it's good. I think all knowledge is power, right? And it's good to know those things. I've always wanted a segment, Jamal, for my in eternity where you covered up what the name was. So I didn't want to see the name, and I did not want to see the chart, and just open the option chain and I would come up with a strategy. Because it doesn't matter technically where it's been or where it's going, right? Or anything like that. But the numbers are the numbers. Yeah. And I always thought that would be pretty interesting. Because the problem is my emotions go with certain things. Like you talk about Marvell, I'm very emotional. You talk about Intel, I'm very emotional. Things of that nature, I'm emotional about, where if I covered it up, didn't know what it was, can't look at the chart, and can only look at the option chain, what would I do?
Yeah, what would you do? Speaking of, I was too soon to speak. Marvell staging a nice little move today, up 5% and change.
I can feel that in my portfolio, so yes. That's kind of my eye line these days, because that position, I've said this before, but is bigger than a breadbasket by chance, not by choice. So I always know when my account is moving. I wake up in the morning and I look at what Marvell is doing first. Then I check the regular market, which is probably a bad way to be. Somebody needs to stop me.
This fall is high in here, though, man. Look at this fall. That's why I'm short this strangle. 100 and change. I'll take a shot. You know what I'm saying?
You're playing with fire. Jensen Huang says it's going to be $1 trillion company, and what he says is gospel.
Two things can be right. It's going to be $1 trillion. It ain't going to be $1 trillion tomorrow.
It's true. Fair
it's
enough.
Like what? 300? Is it 300 billion right now, or something like that? Maybe. Probably.
I don't even think it's that much.
Yeah.
I'll check the market cap.
Something like that. You can check the market. I think it's something like that.
You move around. I'm going to check the market cap for you, because I actually am very curious.
It's 245 billion. It's right here.
Okay, so yeah,
billion.
I mean, come on, we had a 5x here if that's the case.
We got a long way to go. It's not doing that anytime soon. I am sold on that. Sold selling it. You know what I mean?
Come on, 5x. It's gonna happen.
What else is moving around? What else we got? I'll take you guys through my thing. This is one of the things that I do on the regular. I do look at this just to see what names moving around. And Netflix has been one of those names. I've been thinking about selling a put, but just not yet. This thing is a dog, man, and I don't want to see. This is as much as we trade, there's times we talk ourselves out of a trade. Look at this stock. Like, this chart is disgusting.
Well, and after the split, I fully expected, this is one of those, it wasn't the bell of the ball where it split and then kept going up. It split and it hasn't caught footing since.
Yeah, this one is 75.01. It is just, it is not that great. But yeah, markets.
I watch Netflix. I love Netflix.
I want to sell a put in here. I'm just not going to do it yet, mostly because of the expirations. Like, we got earnings coming up here. I don't know about you, but I don't really like to sell like a put naked in a name that is not really. If it were a complete absolute lows, maybe I'd consider it. But I got to go further out here, and I'm going to have this put for a little bit if I want to really get some actual, like, some real kind of value off of the put that I sell. I have to go almost out to August. I don't really want to go that far yet, so I'm going to wait, I think, a little bit here, but I'm keeping an eye on this name.
So I have no problem making a directional stance or selling premium if you're making a directional stance before earnings or through earnings.
Same.
I have a real problem if you're going to be neutral. So because it's like running in sand. If you sell a neutral strategy, like, you're selling a strangle in there and you're going through earnings, you can get there, but it's just trickier because what you're waiting to happen is time to pass and a vol to come in, but that vol should continue to keep marching up. So it's like running in sand.
It really is. And again, if you're selling in this situation, the reason why I don't want to sell before earnings is because this is just not enough for me. I want more than $1 on a $75 product, and this is just not enough. So that's why I'm not doing it. Markets are moving to the upside, but not that much further than where we've been. 75.95 on the E-mini S&P's, up 8.25, 177 points to the upside in NASDAQ, 30,400. 29.9. We are seeing some movement out of the Russell. Now, I don't know if it's let me look at KRE. I'm not sure if it's the banks that's causing that to move or what it is, but Russell is the leader in the clubhouse, almost up 1%, 52.6 on the Dow right now. Let's. Do you want to get to some confirm and send questions?
You rarely see the Russell. You do, but you rarely see the Russell up.
Yeah,
when everything else is down. The leader in the pack. That's interesting.
Do you want to get to some confirm and send questions? How about it?
Yeah, let's do it. You
want to use that reading voice of yours, your teacher reading voice? I'm just kidding.
My teacher reading voice. Okay, ready? I can't believe today's the 17th already, though. Yeah. The summer it's flying by. Okay. Question number 1. When you scan the options chain on a stock you're interested in, what is the first thing you actually look at before you put on a trade?
Expected move.
That's a good answer.
Somewhere between expected move or vol, one of the two. It just really varies, depends.
So I was going to say the premium around it. So if it's a very cheap stock, if I open up the option chain and you can see that just out of the monies you're getting 50 cents to 30 cents, close that thing right up. Because if I'm selling premium, I want to make sure you're getting paid. Just like you were talking about with Netflix a minute ago. But I changed my answer to expected move. Because I think you're right. I think it should be expected move. My gut reaction would have been premium, but expected move first, then premium second.
Let's go to the next one.
On a Fed day like today, are you more focused on direction or are you mainly watching how implied volatility gets priced before and after the announcement?
Am I mainly focused on direction? I mean, I'm always focused on direction. I mean, Delta, definitely paying attention to that. I mean, usually heading into the meeting, I look at, like we did today. We looked at implied volatility already, kind of got an idea for what is expected for today. But yeah, I mean, I'm definitely focused on direction. Like, the direction changes. A lot of times on Fed Day, we'll see what we're doing right now, which is kind of trading flat. And then as we get closer to that announcement time, things start to move around a little bit. So I definitely have to pay attention to direction.
They do kind of percolate right when we get closer. It's pretty interesting though. I mean, and I'm not trying to downplay this because it is the first meeting and it is Warsh and all this stuff. But I think SpaceX was more important to me the last couple of days than this is, right? So we'll see the bonds move, we might see the oil move, we might see the metals move, but I don't expect a big move out of today because I think they're pricing in such a non-event. It's the ones where it's your 50-50 or anything goes, where you're going to see some more big movements and things. I don't know though. I mean, I could be very surprised by what happens today, but that's my guess. I mean, like I said, I'll be watching more SpaceX options today than looking at the bonds and the gold and the in the metals. So I don't know.
Yeah, I mean, it's been the most interesting thing. Speaking of, it's trading 203, kind of off of its highs here, only up $1.40 now versus $8 earlier.
Has it gone red yet?
Has not gone red yet. Not so fast, Liz. Whoa, slow down.
I'm going to keep an eye on that. Just like when we were watching when it was opening, when it was trading at 175 price. I think we're going to see a red tick today in SpaceX.
Ooh.
One red tick.
Ooh. Yeah, I know. We haven't yet, right? Yeah, put that in the chat, Frankie.
I'm talking.
Actually, put that in the chat. Put that in the chat, Frankie. Will SpaceX close green? Will it close positive or negative today? Put that in the chat.
I think it's going to close positive because
it's a good poll question though. People love a good poll.
But I think we're going to have a red tick.
People love a good poll. Let's go to the next. Let's do another question.
Okay, when options premiums are elevated around a major event, how do you decide whether the better trade is buying the move, selling the volatility, or staying out completely?
That is a really good question.
This is a 4-pronged question, Jamal.
It really is. It really is.
Okay.
How do I decide? I mean, it varies. It really does. That's a great question, and it covers a lot of things. I mean, look. A lot of times, if volatility is really high and it's a major name like a SpaceX or something like that, like SpaceX, say, for example, which is going to be like that soon, but Apple, Microsoft, et cetera, so those type of earnings, I usually like playing those because they're very liquid names. And so I don't mind playing the volatility. I like to play, we're talking about earnings mostly here. I mean, there's not too many other events. I guess we'll add on to this other events, but for now, let's just keep it at earnings. And I like playing those names on earnings because those are some of the bigger names in the market and there's some of the more liquid stuff. Now, there's volatility around things like a WWDC, which we were talking about last week with Apple, where we can change it out. I stayed away on that one. I actually didn't do anything. And then I got in after, which is how I got those call calendars that I have. How about you?
I mean, honestly, this question, like I said, it's a 4-pronged answer. It's almost a personal question, right? So, it depends on the name. It depends on your personal feeling of it. Because sometimes I avoid earnings at all costs. And sometimes I was like, ooh, this looks great. And there's really no rhyme or reason to it. But 9 times out of 10, I'm using the options implied volatility to put on a smart trade in it, right? So I might have a directional assumption or something that I want to get into. I might wait until the earnings volatility is very juicy. Then because I want to get into it, I'm going to use that high premium to sell puts. So like I said, it's a personal question. There are some things on the show that I would do with Jenny. I wouldn't touch with a 10-foot pole, and she loved it, right? So it is a very personal, it's a very personal way to look at it. So removing the emotion is the greatest way to do it. Like I said, cover it up and just let me make a trade. But,
yeah, I mean, it really does depend. Like MicroStrategies is one. I mean, this thing has had some high implied volatility, and most people probably aren't touching it. I'm interested in it just because I find it fascinating to trade names like this and try to play for a bounce when nobody loves them at all and nobody is interested. I kind of made a deal with myself a couple of years ago. I used to always kind of get in things a little bit early, and then it became, I want to wait until everybody is talking about it. And like whether it was you or other people on the network, I would hear if everybody is talking about that name, then I get more interested. And so that's kind of how I've approached myself. I want to just wait until I hear more people talking about it or something in that name. That's what gets me a lot more interested. And regardless of the vol, it becomes a situation of I want to play it for that reason. Now I want to make a play and now I want to put on a position because clearly this is a name that's really interesting to everybody and clearly the vol supports it as well.
I'm going to keep saying Marvell to you. Marvell. I want you to join my bullish stance. To the moon, Alice.
Oh, this is a perfect move. It's pulled back. This is great for my strangle, Liz. This is fantastic.
Come on.
Yeah. Fantastic. We love this.
Never count a good Marvell out. Frank in the chat has a great story about Marvell, by the way.
I bet he does.
I bet he does. If anybody goes to a cocktail party with Frank, number 1, try to punch him in the stomach. Number 2, ask for his Marvell story.
Let's go to another slide. How many more slides we got?
I think we have one more.
Cool.
Okay, I heard Liz say her son puts on a daily 0 DTE SPX options trade. I do. He does. Could you walk us through the mechanics of that trade, how it's structured, when he enters, and what he's targeting, and how he manages it? This is
all right.
Easy
you're on, Liz.
Peasy, lemon squeezy.
Let's
okay.
go.
So if you go to SPX, Jamal, let's pull up the SPX trade. Now he knows, and it's funny because I can watch. And my account is linked to his, so I can see when he puts it on. I say, and he's got to set his alarm today because I know he's sleeping. But 9 o'clock, our time, which is 30 minutes after the market opens. He has no idea what he's doing. He will open up the 0 DTE SPX, go to the expected move. No, just the put spread. So clear all this out.
So just the put spread?
Just the put spread, and go to the expected move down.
Yeah. So I'm right outside the expected move.
All he knows how to do, Jamal. So keep in mind, this is bad trading 101 or bad mothering 101, one of the two. He doesn't know what he's doing yet. He's going to get there eventually, but he knows to open it up on his phone, go to the brown bar. That's all he knows. Mm-hmm. You sell one right outside the brown bar and you buy the next one immediately. So he's usually getting around $1, 90 cents to $1. Is that true here?
Buy the next one immediately. What do you mean buy the next one? What's that?
So he's doing a $5 wide spread. Exactly what you've got there. So he doesn't know what it is.
Got it.
He doesn't know what he's looking at. He knows he goes down, you sell at the brown bar and you buy the one underneath. So sell one, buy one. Gotcha. He usually gets around 80 cents, 90 cents to $1. Uh-huh. And then he sells it. And I've been having him leave it because up until this point, the pattern day trading rule was something that he couldn't do. Mm-hmm. So now we're working on going in there and having him close it at 50%. But he's been setting it up and leaving it. And it's been pretty decent. Because it's not a lot of risk. So I have him collecting about $1. So there have been days when it's a full loss, but then 4 days later, he's back, right? So if you're doing it every day, and what I love about him actually, particularly with this, is that he's very mechanical with it. So I'll open it up sometimes. I'm like, ooh, there's a Fed meeting today, or ooh, the SPOOs are down too much, or they're up too much, or on the day where we were up 120, mm-hmm. I watched it go through, and I was like, ooh, what are you doing? We're up so much already. Why would you put in a put spread? But the mechanicalness of not having the knowledge that we have has been very helpful to him.
Baby.
So that's it. He that's all he does. It's a $5 wide put spread, wrapped around at the expected move for the cycle around about $1. And I'm going to teach my daughter the exact same thing.
Go outside.
Well, I like doing the, I'm going to do the iron condor on this. I'm trying to sell it right now for $2. Let's see if I can get that.
Now, can you hear Tim?
Yes.
Now,
yeah. You want me on? You're going to get this. Yep.
Yeah, I think we should probably bring him in. But all the research says wait until 9 o'clock. When Jacob was on before, when he's done research after research after research, around 9 o'clock is the sweet spot, give or take 5 minutes for trading SPX. So this is right in that wheelhouse.
Well, this is right in that wheelhouse. I just got filled for $1.90, so we'll see what happens. Only $5 wise, nothing crazy.
Yeah, that's great because your drawdown is less. It's not bad.
Yeah. Markets right now just fading to a little bit here. The E-mini S&P is down 2 now, 75.85, 30,362 on the NASDAQ, only up 50. We are fading fast. The Russell even fading. It was up almost 1%. Now it's 0.5%, 29.81, up 17 points, and the Dow up 172. So now the Dow is positive. We're moving. We're flipping around.
Look at SpaceX options. Look at SpaceX.
Let's see what's going on. Down? Hey.
Yep.
Hope does he have the put the poll up, man? Put the poll up. Where will it finish on the day? Red or green? Positive or negative? It's the question everybody wants to know.
Like I said, I'm talking my book because I did buy a put spread, but I think we're going to be down on the day. I mean, barely. This is what are we down?
Good Lord, look at me.
Oil is up.
Mud all over me.
Oil is up percent. NASDAQ down. Not NASDAQ. Sorry, Nat Gas is down. Just put that put spread on this morning. I'm going to publish these trades in a little bit here. We got the Bitcoin down slightly. Talking about currencies here. Is the dollar up today? Let's take a look here. The dollar is slightly up. So therefore, a lot of currencies are moving to the downside. You'll see here. Aussie's down. British pound is down. Canadian dollar's down. Euro is down here. Looking across the landscape of a lot of the tech names, which is really what I look at these days. I think everybody is. NVIDIA's down. We were talking about it earlier being up. Google's down. Apple's slightly up. Microsoft is down. Amazon is down. AVGO positive. Tesla negative. So interesting times here. But I think it's time to bring in our guest. Is it not, Liz? You ready? Ready to do this?
I'm ready. I can't wait to see him.
Mr. Tim Knight, how you doing, sir?
Hello. Hi. Hear me okay?
Yes.
Good.
Puppy? How's the puppy? Is she doing okay?
Yeah. No, I had mud all over me a moment ago in my white shirt. Like I brushed most of it
He's got
away.
white shirt on, Liz.
Yay! 3 for 3. I love it, Jamal.
Well, no, I mean, because in recent days, I've been throwing these moire patterns where like, that's right. Bad on the viewer's eyes. You're absolutely right. Okay. If you get a husky, this is what you get. You're going to get noise. She has things she has to say. Anyway, I actually have a few charts we could bang through if you want to chat charts a bit.
I love it. It's my favorite part of the day. Let's hit it.
Okay. And there may be commentary along the way from below, but I can't help that. As you just heard, this is SpaceX. And it's funny because, like, they do these YouTube videos of my show in the afternoon, and they have to come up with like one banger headline to describe it. And they're not by my choice, but sometimes I have to really watch what I say because it's like, yesterday was like, Tim calls the top on SpaceX. Like, geez, it was just, boy, I could get in trouble for that because that could be wiped out this very morning. But so far, so good, because it peaked I include after hours on that, like a 228, like 30 hours ago. But we're getting our first red bar out of 4 days of trading. And we've got a one handle leading, which is going to kind of bother people because, this thing popped 50% in the first 2 days. And a fellow wrote me yesterday and noted that yesterday Elon could lose $1 trillion and still be the richest man in the world. That kind of puts it in perspective.
Yeah, that does. That does put it in perspective.
So, but anyway, what, to that end, though, I'm curious because I just was reading a lot about this recently. Talk about people like him who have, $1 trillion settled, but he doesn't have that in a bank account, right? It's in these companies. Talking about the way that a lot of billionaires live. They give themselves like a salary of $1, right? And they actually kind of take loans against that in some way, shape, or form against their holdings. Yeah. Is that kind of, you live out in Silicon Valley, is that kind of like the real deal?
Oh, yeah. No, my children all went to very elite private schools, and I was the economic diversity in the place. I was honestly, I felt like a country bumpkin because I'd go to someone's house and they'd have an elevator. It's like, I've never been in a house with an elevator before.
Yeah.
It's they avoid the taxes. Basically, so you've got an enormously valuable asset. If you need $20 million for another villa, you borrow $20 million at a very low interest rate. With your collateral against your stock. They don't tax loans, and you pay it back, tax deductible. So yeah, you just hang on to that stuff forever. There's some amazing tax avoidance stories. You've probably heard the Peter Thiel story as well. So his billions are going to be tax free. Ugly stuff. Sure. So here we have the first red bar, and it's. I think the whole SpaceX thing is going to be an amazing journey. But a year from now, if this thing's like $50, which I'm not saying it will be, but there's going to be a lot of highs and lows in this. But the reason I shot my mouth over yesterday and said I thought the high was in was just, come on, worth more than Amazon and just do nothing but bleed money out. I still kind of stand by it, all as risky as it was to think that SpaceX is kind of topped out 3 days in, but we'll see. Anyway, there's more to life than SpaceX, of course. Let me just look at a few other items. SMH, speaking of shooting my mouth off, 2 days ago, you guys might remember that on this bar, I was talking about how, and I hesitated to do so, but, short semiconductors. And that, so far so good, but this 1 day's plop wasn't really all I was anticipating. I'm looking for plenty more than that, but I don't have any egg on my face on that one so far. That was a really good call in terms of the price teetering right on the trend line. I do have one chart I really want to hit there. NQ, lifetime highs intraday yesterday, but I think that broken trend line. Listen, now that the war is out of the way, now that the UFC match is out of the way, we can focus on earnings next month. I think the worst thing is going to be a nothing burger today, but it'll be really refreshing just to get back to earnings. And, the tech stocks have to basically hit it out of the park like crazy to sustain these valuations. ES also right near lifetime highs yesterday, new record, but that range I think matters, and I am way more inclined for weakness than strength at this point. And if there's one chart I'm really fond of, especially this morning, and I've had puts on this, it's Carvana, CVNA. we're down today on this, which is fine. But what I love about this is this pattern I've drawn here. I know this is an oval, but I'm being lazy here. This is a diamond reversal top, which are good ones are rare. And Carvana is a very richly valued company to begin with, and it's got kind of a unusual history, to say the least, which I've written about a bunch. But what I like about this is, one, from a fundamentals perspective, it's super expensive. Two, we've kind of been here before with respect to, and I'm going to try live and without any net below me. Well, now I'll just do a rectangle. I'll be lazy. We've had kind of a similar setup before, like so. So there's a bit of an analog going here. Added to which we're at the same level we were before this precipitous fall. So
wait, Tim, what time frame is this on Carvana?
We're looking here at a good 6 years of data.
Okay, yeah.
Oh, wow. Okay.
And it just shows the cleanness and the magnitude of that top. Now, you two are about 30 times more sophisticated than me in terms of trading. I'm just a dumb old bear. I just buy puts, but I've got puts on this. All the puts I own on other positions are way up next year, January 2027. This is the exception. This for me is aggressive. It's September, which is still, almost 100 days. But so far, so good on this. I really like Carvana on the short side.
Is this a chart story? Is this more of a fundamental, this business model doesn't necessarily work?
It's a chart story exacerbated by the fundamental story because, I don't know, I get a lot of sketch vibes off this one. And even if you look at the basic fundamentals, it's just like, really expensive. How they've had this extraordinary recovery, just hundreds and hundreds and hundreds of percent is amazing to me. But this has got to be my favorite chart going right now.
Cars in a tower, am I right? I mean,
Tim,
seriously.
That's right. Yep, that's right.
Tim, I just put a short position on in honor of you.
Oh, well, I am honored. Thank you. God bless. Good luck to you.
Yeah, I'm looking.
Yeah. No, I mean, like I keep saying, I know that by and large, folks like to hedge a lot. Like, maybe this, maybe that. But I like to kind of lay it on the line. And I've wound up with enough egg on my face over the years that I don't care anymore. I just say what I think is going on and why, and let the
I'm going to sell a call.
Let the fortunes fall.
I have a lot of long deltas across the whole entire book. I need some short deltas.
I needed some short deltas too, so I went in. I mean, I did a 30-day, 60-day diagonal, bearish diagonal.
Okay.
Yeah, I like it, Tim.
Yeah. Pretty.
So one of my favorite things, Tim, is watching your show in the afternoon because you come up with a directional assumption, then I overlay whatever kind of complex option trading strategy on top of it.
Mm-hmm.
Sense. And it doesn't even have to go down that far. So thank you, Tim. We'll see how it goes.
It's my pleasure. It's my only skill. Glad to do it.
Oh, you got more skills than that. You're selling yourself short. Come on. Don't be that. You got it. You're doing a great job as always. Fantastic stuff. This might be, again, one of those days where we'll see what happens. Your appearance on the show is always important because it's always interesting to see what market does after. I'm telling you, every time something happens.
He's still on, but the spoons are rallying.
Who's around right now?
No, I'm afraid you're stuck with me. I've got some nice tweets and I hope you're sticking around the morning show. It's like, like it or not, here I am.
We like it. It's been great. I really do thoroughly enjoy because I was telling Jamal earlier, I don't understand charts. So I would rather rely on somebody who has been doing it for years to say whether the chart is good or what the chart looks like.
Since 1987. You can see it in my face. Yes.
Not at all.
Love it, man. Love it. Thanks for coming on, Tim. Great to see you. We're going to take a quick little break here. E-mini S&P's up 475.92, and market's seemingly positive right now. And of course, we got the big Fed meeting later on this afternoon. So stick around. We got plenty more content for you. This is Tasty Live.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform. being able to see graphically where your profit and loss zones are. Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better. In fact, I've never seen anything like it in any corporation in the United States.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
What's going on, everybody? Welcome back to Tasty Live. I'm Jamal Chandler, joined by the lovely Liz Deer King, and we got Sahil in the house with the market measure. What's up?
Yeah. What's up, guys?
How you doing, man?
All good, all good.
You watching soccer? You watching World Cup?
Yeah.
I
watched the USA Paraguay game. That's the one game I watched.
Yeah.
Just got to support our country.
For sure.
I'm gonna get more into it when the playoffs, the round of 32, whatever.
I agree.
When that happens. Yeah.
I did watch the game last night. I was telling Liz.
When will that be? When will that be?
When will that be?
I don't know.
Probably in July. The finals on July 19th, I think, something like that.
It's only 6 weeks.
So yeah.
I'm thinking it ends like either probably maybe first week of August, something like that. I haven't even looked at the calendar past the last couple of weeks.
I'm expecting the US obviously to get out of the group stage in a home World Cup. So we'll see how far they go.
I hope so.
But who are you? Are you rooting for anybody besides them? Mm-hmm. Germany, France, Argentina.
Yeah, you know, I haven't been busy, I guess, with life and stuff. I really haven't looked at who's on what, who's on the other teams that I'm interested in. I would say till last night, I just happened to be at a restaurant with some friends hanging out. We were watching the Argentina and Algeria. I watched Messi score 3 goals. That was crazy. Guy's good.
Every sport has those two players at the top that they debate. LeBron or Jordan or whatever. So in soccer, are you Messi or Ronaldo kind of person?
That's a good question.
Yeah.
I guess I gotta go. I do like him, but I guess I gotta go Messi.
Yep.
Liz, you know who Ronaldo is, right?
No, I don't know anything about soccer.
I'm surprised you don't know who Ronaldo is.
I'm just gonna sit here and smile.
Do you know who Messi is?
Most women know who Ronaldo is.
I know the names.
Okay.
I know the names.
Okay, you know the names.
I'm more interested in your LeBron. Be very careful when you answer this, Sahil. I'm more interested in your LeBron or Jordan.
Well, I'm going to phrase it just very simply, why I think this way. So I don't follow basketball too much, but Jordan is a more popular name outside the basketball community than LeBron is, especially what kind of shoes do you wear? You wear Jordans, not necessarily.
I'm wearing some right now.
I don't see many people wear LeBron, so. Yeah. And also, the championship argument, you got to.
It's true.
Yeah, there you go.
True.
It's who transcends the sport to the people who don't necessarily watch the sport?
Yeah. And that's why I would say Messi, because that's a name I know. How about that?
There it is.
There it is.
What's up with this market measure, man?
So we talked about the diversification stuff last time. So we're going to heavily go into it on utilities because we got a bunch of questions on this, basically. We're going to start using the emails, using the research at tastylive.com if anybody wants to send in any ideas or anything they want to talk about with the market. So just nice, simple market measure talking about utilities today. So yeah, let's get started. I have the Monopoly board on the first slide. To shows what exactly we're talking about, water and electric. The one thing I learned when moving out into my own apartment and stuff is the utility costs that gets added to your rent and everything. They got to pay every single month. I don't think when my parents were trying to explain to me this, I don't think it necessarily hit until it starts coming out of your own account,
Dude, I was literally just talking about this type of thing at my dentist yesterday, and we are talking about kids. I got a 22-year-old. He's living at home right now, but we were just talking about how they figured that out over time, paying for stuff. Wait, I got to pay for this? Really? What? Yeah.
Water's not free. Electric not free. No. You want that high-speed internet too?
Liz, what's your favorite properties?
Oh, on this board,
Yeah.
100% the railroads.
That is such an answer you would say. Totally. It's like you and your metals. It's like same thing.
Yeah,
you can get paid off of those railroads for sure.
That's right. The railroad.
There's a whole strategy behind this game too.
Oh, no doubt.
It's like if you take the pink and the orange properties, so like the most valuable because of go to jail and a bunch of stuff that sends you onto the first half of the board all the time. So people have done like math into this. You know, there's like competitive Monopoly matches and stuff.
I could believe it.
Yeah,
I could believe it. I mean, there's all these people who love to get Park Place and Boardwalk, but you don't land on those a whole lot probability wise, right?
Mm-hmm.
But when you do,
oh man,
and people have houses, oh my God, you got to mortgage, you got to mortgage yourself just to pay for it. Oh my God, my brother used to love getting Boardwalk.
You guys have your like house rules or whatever?
Oh yeah, we do. For sure.
It's like nobody knows how to actually kind of play the real rules of Monopoly or whatever. But apparently, if you play by the real rules, it goes super fast. The game,
yeah,
because everybody's just getting bankrupted left or right.
Exactly.
Whatever. And then the one kid,
if you play by the real rules, it goes fast.
The banker, so.
Yeah. Okay.
Oh. Yeah. So utilities.
Yeah.
I like it.
Yeah. Let's go to the next slide in the actual market measures, actual nitty gritty on this. So now we have utility stocks are often used by investors as a defensive option during market downturns, and we're going to talk about basically why. So one of the reasons why is they're higher dividend and they're less volatile. Obviously, you can actually use them as a great dividend kind of building stocks. Nvidia, Apple, Tesla, especially Tesla, they don't really play any dividends. And obviously, with the tech names and the AI names right now, their volatility is super high. But the utilities, not so much. Their historical volatility over the last 30-day period has been kind of low. And relatively speaking, these are actually fairly high volatility numbers, even still compared to like Volmageddon back in the day or whatever, as we've talked about multiple times. But relatively speaking in the market, and their yields are often much higher. So we're just going to keep showing multiple examples on why utility stocks, how you can trade them, how do they compare to different stocks over the next few slides. So
cool.
Switch to the next one. Eventually. Okay. So this is your XLU and SPX graph. I mean, you can just basically see over the past month or over the past 6 months what has happened. So I took it from January 2026 to now June 2026, and it's basically moving in the opposite direction. It's kind of funny how it works. Yeah. Their correlation's like 0.06 or whatever. So if you need some nice diversification play, like we talked about, not necessarily gold, and if you don't want to mess with oil right now because of all the stuff that's happening with oil in the market, you don't need to mess with it. You can go into stuff like utilities or real estate or whatever that has pretty low correlation.
And to your point, low correlation, but you can see at times when correlation does get high, like we saw in March, they follow the same path.
Mm-hmm.
Very similar pattern from March to like middle of April, and then back to being uncorrelated. Right.
Yeah. How you pick the times, pick the times when it works or not.
Yeah.
Yeah. Like these change, like I said 2 days ago. These things like change in the market. You got to reevaluate every month, every couple of weeks or whatever to see what is actually diversifying, what is actually correlating with the market or whatever. But yeah, so utility stocks can be impacted negatively by high interest rates. So high interest rates can put downward pressure on utility stocks, and interest rates hike can make alternative investments such as bonds look more attractive. We're gonna have another slide later in this talking about XLU and the 10-year treasuries, and basically showing that when high interest rates happen, you might want to step away from utilities. So if there's any of that's going to be happening in the market over the next 6 months or so, then you might want to step away more into bonds, more into the super safe haven stocks, because that's when everything becomes more difficult to trade. So, yeah. Okay, next one. All right, so these are how they're correlated with each other. So this is just, again, showing for the correlation graph for anybody who likes the numbers with the green and the red stuff. So you have all your 5 main utility companies that everybody talks about on the first 5, and then, SPY, QQQ, IWM, NVIDIA. An interesting thing about this is, I guess, it has correlation with SPY and QQQ, or negative correlation with SPY and QQQ the most. So it's probably why the stuff in March was happening, was because the correlation happens a little bit, but in the negative direction. When you're trying to look for a diversification play, you don't want a super positive correlation, but you also don't want a super negative correlation, because that makes it kind of difficult, unless you're doing a hedge type of play or whatever. So actually with the small caps, it has the least kind of correlation. So that's just something interesting to know. But I mean, the red and the green, they show the story pretty quick, pretty much, that they have high correlation with each other and low correlation with different parts of the market, the overall market, the NASDAQ, small caps, NVIDIA, your highest market capitalization stock there. So The next one.
There's real no correlation between them.
I like these type of things. I like the visual representation. So thank you for bringing
I'm just trying to like see it in different ways. Some people like looking at correlation matrices. Some people like looking at the graphs. We've had some emails before being like, the text on the graph is too small. I can't read it. Just show me some numbers or whatever. I don't want to like look at the y-axis and like draw my hand or whatever. I'm just trying to show different ways of showing the same thing.
Yeah.
Or whatever. Yeah. Okay. Yeah. So this one is your XLU and TLT. So this one is your XLU and TLT, showing the little correlation that bonds and the utility stocks have over the long run. And in that November period, they had absolutely no correlation. Now that it has a little bit more, it's actually getting up to 0.5 over the past few months or whatever. So that just shows your when your high interest rates happen and stuff, you might want to step more into bonds than you were into utilities. So
yeah, to that end, I remember. I mean, as long as I've been around, you can always learn things, and I had never really looked at the correlation between bonds and utilities, and it was Dr. Data who actually made me realize, like, a lot of times when interest rates go up, that's bad for these utilities because they usually have a lot of debt, and that's why they'll struggle a little bit at those times. So interest rates actually means something to utilities. Trust me, they're the ones who were paying attention to the Fed meeting today too. Yeah, right, Liz? I didn't know that.
Yeah.
And he told me this like 4 years ago. I was like, oh, that makes sense. It was actually it was at that time because in 2022, obviously interest rates were rising. I was like, man, these utilities getting killed. I was noticing, I'm like, what's going on here? And he's the one who pointed that out to me.
Yeah, that makes sense. I never put
it's interesting to see like the correlations or the math behind stocks that you don't really think, or equities or products or whatever that don't really, you would never really think to compare necessarily, but they do. Everything has an impact on each other in the market, so yeah. Let's go on to the next one.
Yeah.
So now even more showing high interest rates because this time we're looking at the treasuries and SPX, so the overall market and treasuries. And actually the correlation over the past few years, so this one is looking at the past 5 years from August 2021 to June 2026, where we are now. So the past 5 years, and before in 2021, 2022, the correlation was not really there, but now you can kind of see that the correlation has started creeping up a little bit. And over the past year or so, over the past 6 months or so, it has actually been kind of following relatively together. So,
yeah, and like you said, in 2021 and 22, when things were really changing rapidly as far as the landscape for yields, I mean, it was fast. Mm-hmm. It was too fast, and that's why the market didn't like it. That's why it didn't go well, because a lot of times it's been highly correlated yields in markets, but it was just entirely too fast when we changed rates that the market didn't like it, and you saw that.
All right, next one is... So now these are your success rates. If you want to do your 45 DT 30 delta puts in here, XLU wins out on the success rate and the average daily P&L actually compared to bonds, but bonds have are less volatile. They have a less large loss. So these are for the numbers for anybody who's trying to trade options in XLU or TLT with the 30 delta puts. And
I like this comparison. I'm glad you put this on here because this actually puts the numbers around it.
Yeah, you're going to have different numbers for strangles, but because generally people like to do puts or strangles or whatever in these strategies. Not too many people do bearish options, so I thought puts would be a good way of doing it. And 30 delta, in case anybody wants to get a little more aggressive into it, you just see it more with the 30 delta than you do with the 16. So
right, because there's less credit, less. It's a little easier comparison. I like it. I like
All
this,
right.
that graph.
Finally, takeaways. These are your. I try to keep these as simple as possible. So your takeaways are rotate into utilities when volatility rises or economic growth slows to reduce portfolio drawdowns, underweight utilities during rising interest rate cycles, and then overweight them when the interest rates start falling. Then use utilities as a nice portfolio hedge. And since they behave differently than stocks and bonds, real estate, all these other things that you can also use as different hedges. It's just nice to see what you can use as a hedge, what you can use for market diversification.
Fantastic. Love it, man. Good stuff. Yeah, I mean, it's a good time. I think with all this concentration in tech, people should be looking at other things like utilities or consumer staples to possibly get some exposure in there.
Or just sell all the puts in SpaceX.
Yeah. Or so you can do that too in SpaceX. You can sell some puts in there. Like Liz said, it is margin now.
Yeah.
It is margin now. And guess what? It is down today. We're seeing the first down day in SpaceX right now.
Oh, no.
The horror.
Here's the market top now.
It's easier to sell puts when the market's down than when the market's up. It's very hard to press that 30 delta put when the market's up 50%.
I agree.
It's true.
Classic contrarian right here.
Yeah, I know, right?
All of you guys, the market makers. Contrarian is like in your blood. Okay?
It is. It really is. Yeah, for sure. Sahil, great to see you, man. Great job. Fantastic market measure. Good stuff. See you another time.
Another time.
Yeah. Nice. E-mini S&P's up 15 now. Market's flying higher. We're just over 7,600. NASDAQ, 30,500, up 217 points. The Russell, up 24 points. And the Dow, up 245 points, 52,700. Stay tuned. We'll be right back after a quick little break. This is Tasty Live.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Tasty Trade has crypto, and you can trade with zero commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
But they kinda like it when I'm feeling myself. Just to look at me, I don't gotta level up. But they kinda like it when I'm feeling myself. I'm feeling myself. I'm feeling myself. I'm feeling myself. Just to look at me, I don't gotta level up. But they kinda like it when I'm feeling myself. I'm feeling myself. I'm feeling myself. But they kinda like it when I'm feeling myself. Just to look at me, I don't gotta level up. But they kinda like it when I'm feeling myself. I'm feeling myself. But they kinda.
Welcome back to Tasty Live. I'm Jamal Chandler, joined by the lovely Liz Deerking, and we got Gad in the house with some research trade ideas.
Yo, what's up? I'm good.
How you doing?
Living the dream.
You're living
No
the dream?
tie?
Yeah, living the dream. Yeah, no tie today.
No tie today. You went no tie on the Fed day.
It's a trade. It's a trade. So tomorrow I will be in ties. So tomorrow will be my
You're still looking good though. You're still the best dressed man in the office.
Yes.
Oh, thank you. Thank you, ladies.
That's just man Tasty Live. I'm at that point in life where like I just want to wear white tee every single day. It's funny. I saw this documentary once. It was actually fantastic. I forget the name of it, but it's with Jimmy Iovine and Dr. Dre, and they talk about the sale of beats and all these different things and their careers and all that. Dr. Dre basically was like, I'm at a point in life where I just wear the same thing every day.
Yeah. My wife wants me to wear good stuff.
Well, you got to do what the wife says.
Yeah, 100%. She buys all my
whatever she wants, you do.
There you go. See, there it is, Liz. She buys his wardrobe.
Yeah,
when he looks
80% of everything I own is from his.
Amazing.
Yeah.
I like her style. You got to tell her I give her a gold star.
Oh, I will. Thank you.
What do you got for these trade ideas?
So let's jump to the trade. So today, I'm into like big boy stuff. So
there you go.
Yeah, I'm gonna start with Tesla. So this is a put spread Tesla. So Tesla today is down a little bit, like 2%, I guess, like around 2%. So my ideology or my thoughts behind this trade is even if it has like low IVR, less than 25 or less than 30, but this trade is going down, doesn't correlate with the SpaceX hype and everything. So this, because it's going down, I'm saying it will not go down.
This was really a put spread, right?
This is a put spread.
Yeah. Oh, but it's really put spread. Selling the put spread.
Yeah, I'm selling put spread. So the last price will be 375 or 365 for the last one. So I'm betting if the price goes down, it won't go reach to that point, and we'll be able to correct those premium even if we are in a raw IVR environment. So we win this Tesla stock. So
okay.
Yeah.
The IV rank is not as high as you would like, but I like the idea from the standpoint that Tesla, I think, is. I think it's. Just looking at the stock here, it's hard to say Tesla sold off, but it kind of has a little bit.
Yeah.
I like this entry point. I'm going to try and get this off for 245.
I like this too. You're at the expected move for the cycle. You're down there. You're collecting enough for it. I like that it's actually in the 30-day instead of going 45 days out because you get earnings on it.
Right, exactly, Liz. Like it's before. That's why I like it. So I'm in.
Yeah.
Sold it.
Yeah, even if it has like some earnings due at the end of in July.
Yeah, July 22nd. So after July expiration, which is why I like your trade too.
Yeah.
So
within
again,
these 30 days, I think we will be okay with this. If you get tested in the other side, you can close out or you can,
Yeah, I like it. Not even so much for the vol. I don't expect the vol to come in a whole lot, but I do expect it to move up. And it is, again, it's selling vol, but it's also a directional trade to some degree. So I like it for that.
Yeah, but it's smart directional because it can even drop. So as long as you only have 30 days, just got to stay above 375. So it's
approved.
Not bad.
Is it approved?
Yeah, approved. We traded that.
Right. So let's go to the AMD. So this.
Let's see the next idea.
The
up
next
on screen.
slide.
Yeah.
There we go.
So this is the cost spread. So the opposite side on the Tesla one. So this is.
Did you say call spread? This says puts.
The one was put spread.
Oh yeah, they got to they have to change the.
Yeah. So this is really a call. You're saying this is really a call spread. You're selling the 580 call.
Yeah.
Okay.
So this is call spread.
Gotcha.
Okay, we'll change that in post production.
Yeah, sure. So this is call spread. So then, this AMD is going high in the row. So when the SpaceX IPO got released, it affected these AMD stocks. It went down a little bit, but it's coming up. So I'm saying within this high IVR rank of 92%, that means there's some activity within this stock. The price will continue to go high. If it goes high, it won't reach to 580. That's my philosophy within this trade. So right now we have like 517 price right now. So if it goes high, it won't reach to 580 or 590 within 30 days. So if you get tasted again, you can manage, you can close the trade area, you can do whatever you want. But that's my philosophy behind this trade, and you're gonna risk the risk ratio is like 2-1. Yeah, behind this trade. So yeah, that's my philosophy behind this trade. These two ones here.
Yeah, lifetime high so far 558.37. Doesn't mean it can't go through 480, but I like this idea. I mean, selling this call spread, I could use a little bit of short delta. And again, this is risk defined.
Yeah.
73% pop. I would say you're risking 3 to make 1 according to this math.
Yeah.
I know you're a research guy, but you got to work on the math. I'm just messing. No, I like it, man. This is a good trade. I'm gonna put this one on too. Weird.
I mean, it looks like you got a lot of room, but that doesn't mean it's not going to go up. But it's the same concept as the other side. It can go up, but it just can't go past 580.
Yeah.
Okay. Yeah. That's my concept, and also it's reacting to the SpaceX IPOs trading aspect. So because it's AI related stocks, so I think they have the same mindset, the same kind of philosophy of moving towards increasing of the stock's price.
Filled. Over 245.
Good. So the next one. Is it approved, this one? The
last one? Yeah, two approved so far.
He's already shipped.
It's the last one. Don't mess it up. Don't mess it up, man. Go fire your bat in the thousands, they say in baseball.
So I don't know why I put bullish on this one, but it's Apple. So Apple right now, I can't say it's moving anywhere. It's not going down. It's not going up. It doesn't react to anything right now. And we don't have major like news in Apple, except in September, we're going to release like iPhone 18. But right now we are in kind of middle of like cool environment in Apple. So that's why I'm taking this skewed ironic candle. So being in kind of neutral bullish-ish, I like to call it bullish because it's like we're in a bull market, but also you can call it neutral according to your understanding and how you're going to press this strike along your prices. So you're going to correct a $1.30, and you're going to risk, and the buying power is 370, by the way. It's a cheap one. In 30 days, you can correct this buying power, and also the IVR makes sense, is above like 25 up to 30, and the last price is 300. And the risk rewards, it's not against our theory research team. Yeah.
And it's skewed because you're farther away on the calls than you are on the put.
Yeah.
And that's how you're skewing it. Because there's a couple ways you can skew it. You can widen out the puts, or you can go farther on the calls. And it's not what I was just checking, and you get it. You're winning on this one. I just deleted the call spread because I want to make sure you were getting enough for the call spread to make sure it made sense to put it on because it was so far away, and you are.
Yeah, because it looks like it's 50 cents maybe on the call spread.
Yeah, it's an extra 50.
Yeah. This one is approved as well. I'm not going to put this on. I like the idea of selling. So I know we're looking at IV ranks, and IV ranks are important, but I'm also trader. I like looking at actual implied vols. I mean, this one is actually selling a 20 vol. So it's going to take a little bit longer to actually harvest that volatility just for people understanding the trade, but it's a good trade. It's a 63 pop, and you're risking 2 to make 1, which is kind of works on an iron condor, and this is a good trade. I got some other things on in here. That's the other reason why I got these calendar calls in, so I want to pay attention to those. But this is approved as well. I like it.
Thank you.
Thank you.
So Jamal, here's my question for you, because I know you've got a lot of stuff in Apple right now. How do you sort them in your when you open your positions? Do you have them grouped by each trade, or is it just one big?
A lot of times, most days, I have the PN. I kind of sort by PNLs to alert me to if there's anything I need to do, either down or up, and then I'll also remind myself.
No, I mean.
What?
Within the Apple, I know you have other Apple trades in there. How do you sort these out? So you've got an iron condor in there. You've got
I don't have an iron condor. I don't. That's the thing.
Cross positions?
No, I don't have an iron condor. I only have calendars. That's why I don't want to put the iron condor on.
Gotcha. Okay.
Yeah. Okay. So that's why. Yeah, that's how.
Okay.
Yeah, but it's a good trade. I like it.
Yeah, thank you.
That's what I was going to say. I was like, Jamal, you're going to be all over the place.
Exactly. That's why I don't do that. That's why I'm not doing it. So, great job.
We are running from the base. You two guys, you're the base traders. So we are running from you, and we always appreciate. Yeah.
Hey, we learn from you
man.
too. We're always learning from you.
Yeah.
Yeah, I mean, honestly, this is just so you know, this is an age-old idea of presenting ideas to traders and letting them tell you what they think about it.
100%.
This is what Liz did. This is what I did when we were learning how to trade at our firm. So this is a great idea. I mean, it helps you. It helps everybody who's listening, and it's cool. And again, we're just giving you our thoughts. I mean, doesn't necessarily mean it's gospel, but we do happen to know a lot, and there's not many people in the world that can do what we do. So, there is that. Yeah. Folks, that's God with trades from the research team. Thanks, God. All three were approved. Fantastic stuff. E-mini S&Ps are flat at the moment, slightly down, 75.85, but NASDAQ is up, the Russell is up, and Dow is up. So things are very fascinating so far. We got a big Fed meeting today. That's the big catalyst of the day. We'll see what ends up happening. We're going to take a quick 90-second break. You're watching Tasty Live.
In road trips, my family, it was like whoever could get the captain seat was it.
That's great. I'm having a great time.
Me too. But I mean, stay a while. Take your jacket off.
No, I mean, I'll stay, but the jacket's not
Come
coming
on,
off.
take your jacket off.
Nope.
Come on, no. Take it out.
I'm sorry. I didn't mean to.
No, I'm sorry.
You hopped on this cowboy's horse, so I guess you got to hear his tale. In '87, I took it off. There was the market crash. In '92, NBC canceled Blossom. A couple of years ago, I lost it for 2 days, and the Lakers won the NBA Finals. Bottom line is when this thing comes off, bad things happen.
You've got to take it off sometimes. I mean,
Never do.
how do you shower?
The jacket's kind of gotten used to it. In fact, every few days it needs it.
No matter what, you keep it on.
I can take my shirt off if you want, but I'm not taking the jacket off.
I just don't know if that's something that I could deal with.
It'll be like a teal tornado. Just endlessly washing up on your short.
I mean,
This is moving so fast, and I like it.
Yeah.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Welcome back to Tasty Live. I'm Jamal Chandler, joined by the lovely Liz Deer King, and we got another person with a white shirt in the house, Liz. Gus is in the house with some retail trends.
I got the memo today. I saw that.
Gus,
It was
very
White
handsome.
Shirt Wednesday, and I am here for it. So excited to get into things here.
Dope.
Nick, we might need to borrow your sheet of singles to decorate the office because
that's pretty cool, man.
Really enjoyed it yesterday.
That's fine. I mean, have they appreciated? Do I get inflation adjustment on what I paid?
You do.
It's 32 bills, but let me tell you, they sell them for more than 30.
I know, right? Imagine
what a racket.
Yeah, how much was the sheet?
Something like 50. I don't know. It's quite the markup for 32
That
bills,
is-
or
it
maybe
seems
it's
a little bit of a
36.
markup.
Government knows how to make money now.
Yeah, no
question.
And they are legal tender. I could cut them up and use them if I so chose. If it ever got to be a super rainy day, but
yeah.
Do they all have, only because I have $1 here, do they all have like consecutive serial numbers?
it's not consecutive in the way that you would think. It's the fourth number that's consecutive all the way through. Like the fourth
Really?
number in the serial number is the one that changes as you go down, and then right, which is odd. You would think it's the last one, like counting up. But
it's that's kind of odd. Almost as odd as the fact that Liz just had $1 randomly sitting there next to her. Like, interesting.
How many singles you got laying around?
I've got 2.
You can't ask your mom that. What you got for retail trends, man? What's going on?
Yeah, lots happened in the retail space today. Something that caught my eye is Lionsgate. They are down big today, opened up down 5%. After Netflix denied reports that they are interested in acquiring Lionsgate. I didn't actually know that was on the table at all. But always a fun topical thing when these movie studios are moving. When as it pertains to Netflix, or I always love when somebody has a movie release that's so bad or so good it can move their shares. It's fun tie-in between pop culture and the stock market. AST Space Mobile is moving. ASTS. If you've heard enough about SpaceX this week, don't worry. We can pivot here. ASTS up 6% after the announcement that they successfully launched 3 new satellites into orbit to continue to build their cellular broadband network in space. And they used a SpaceX rocket. So SpaceX up 3%. Is that because of the AST Space Mobile successful launch? I don't know. I think that could still just be hype driven.
So are they competitors or not?
ASTX no. ASTS needs launch partners like Rocket Lab and SpaceX. ASTS just makes satellites. They don't launch them. Gotcha. So they'll partner with whoever has the best price, whatever launch provider. But yeah, all they do is satellites. They don't care who puts them up there.
Because SpaceX is down almost 4% right now, Jamal.
Yeah, it is.
Yeah, sinking. But yeah, I suppose obviously one successful launch not as pivotal to SpaceX's bottom line as it is for ASTS.
Right.
CarMax shares up 3.5% after a good earnings report. This one, I've actually traded CarMax a few times in the last year or so. It's made some good moves. Quietly, we'll take some volatility or have some volatility, some good spots for swings if you pick your spots right and you're directionally correct.
Yeah, a little bit of wide.
It's a fringe player, but I didn't realize they had earnings last night.
Yeah, and I think, is that why Carvana's down? Is this a sympathy move here?
Maybe it's because car vending machines is a stupid idea. I don't
know. Yeah, we were talking about that with Tim and I earlier. Yeah, I haven't sold an outright call in a while. I sold an outright call in here. I need some short delta.
That was the Tim Knight special. He's very bearish Carvana.
Yep.
There you go. Yeah, I sort of like Carvana's model. Okay, the at-home car buying and selling does seem to work pretty well. I have a friend here who needed to sell his truck in the city, and he sold it to Carvana, and it was super seamless. I mean, they send the truck out. You don't have to lift a finger. You just clean your car out, leave the keys in it, park it on the street. They come pick it up. So there is. I don't know.
That sounds a lot like New York in the 1970s. It's like to me.
Sure. Yeah, not a particularly innovative idea, but I don't know. People are using it. Good way to liquidate your vehicle if you need to.
Okay.
Last thing I have catching my eye today is Figma. This made noise after its IPO. I don't know if that was in the 2026 calendar year or not. Its recent IPO. Has since sank quite a bit, but it is up 4% today. Citi initiated coverage with a buy rating, so not the most exciting reasoning that I could give, but Citi is saying we might be a little undervalued on Figma here.
I mean, there's nothing.
And that really has taken a hit.
There's nothing like when the market lets you know what it thinks of your stock.
Yeah, Figma. This was one where like 3 days post IPO, I had relatives and friends who are not involved in the market texting me and saying, "Oh, should I pick up some Figma? Is that free money?" So I got short when that happened. It worked out pretty well. When the mailman starts asking you about it, it's probably a good time to go ahead and get short. It has come down a lot off those levels, but seems to have stabilized around this current level and moving up a little bit today after the good rating from Citi.
Interesting.
There you go. Did you take a look at the SPOOs just gap down 20? Now they're rallying back to up 14. I wish I knew what was happening. Is the war back on?
Is the war back on? Well, oil is up 243, so maybe this is why we buy the call spreads, Liz. This is why.
Yeah. I'm checking Truth Social. I'm all over it.
Yeah.
I didn't see anything on my Twitter feed. I don't see a bunch of stuff, so I don't know.
I mean, they're not down too much, so I don't think the war's actually back on, but oil reversed and the SPOOs reversed.
Trump is doing a press conference in France right now. I don't know what he said.
He's talking. Did he start speaking?
Yeah. Well, 47 minutes ago, he tweeted and said, or truthed and said, I will be doing a press conference in 45 minutes from France.
Yeah, just so people know what we're talking about, you see this big little gap down right here at 2 minutes ago. You see a little gap.
Yeah, it was a couple minutes ago. It was while Gus was talking. I was listening to you, Gus, but I was also have my eye on the spoos.
Well, Gus, you're talking too. Maybe you did it. Maybe that's what it was. Those are the ideas. We got them all.
Yeah.
Got them all.
That's everything.
Carvana, CarMax, cool, awesome. Yes. Awesome, Gus. Good stuff, man. As always, keeping us on the pulse of what people are looking at right now. Great stuff. Like we just said, a little movement in E-mini S&P here. They're on the negative side now, down 10. NASDAQ is up 62 at 30,370 on the dot. And we got Russell 2000 still positive, 12 points up, 29.77. And the Dow 52.5 up 100 points. Stay tuned. Big Fed Day coming on here today. We're going to be talking about that, SpaceX options, and more. You're watching Tasty Live.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day. Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Ave María Morena, Ave María Morena, Ave María Morena, caballero eres morena, Ave María Morena, le digo rumba buena, Ave María Morena. Morena, pero que me muero. Ave María Morena. Morena, morena, morena. Ave María Morena.
What's up, everybody? You're watching Tasty Live, and it's Fed Day. I am Jamal Chandler, joined by Liz Deerking, and we got special guests in the house, of course. Hit it. Let's go. We got Q from the trade desk. Q, what's up, man?
Oh, how's it going? How's it going? I love it. Love the
I think
intro.
you got a couple extra DD deets from Jamal today. There was 3 additional ones I noticed from Jamal.
There we go. I love it.
Counting DDs
I'm
now.
taking
I
all the
didn't know this.
DD deets I can get.
I didn't know this. I didn't know we were counting them. What's going on, man?
Yeah, good. Desk is good. I've got some stuff that I want to go over today. So first, let's talk about early assignment due to dividend risk on short calls. So we've got SPY going ex-dividend tomorrow. If you want to hop in the platform, there's some examples I can show you guys if you want to pull up the SPY option chain. And so let's say, like, because I was asking the trade desk earlier today, I'll put out like a margin question of the day sometimes out there, and then people are like chomping at the bit to answer it. So like I'll put it out, I get like 5 answers in like 10 seconds. I'm like, oh my God. I'm like, all right, are you guys like not like doing other work? You know, they're like, I'm taking a call, I'm answering your question. I'm like, I love it. But so going over like early assignment due to dividend risk, let's pull up the July 17th expiration here. And then if you go to, this was my question for the trade desk, was if I'm short the 7:30 call, is there high assignment risk due to the dividend?
Absolutely.
So
7:30 call?
Yeah, for the 7:30 call for July 17th, for July.
Oh, July.
you're in 0 day.
Yeah,
Yeah,
If
you
it's
gotta go to
June,
July.
July.
So
very
wait,
high.
can I answer? Can I answer?
Yeah, she wants to
If
tell
the
the answer.
extrin-
She wants.
If the
she's so
extrinsic
excited.
value
Yeah.
is less than the amount of the dividend, you run the risk of assignment. So I don't know what the dividend is right now, but if the extrinsic value of the option is less than the amount of the dividend, you run the risk of assignment.
Yes.
And the cheat
Beautiful.
code is just look at the
A+
put.
for you.
The cheat code is look at the put.
Yes, exactly. Yes, that's what we tell a lot of our customers is like whatever call you're short, just look at the corresponding put. And then if that's higher than the dividend, you're good, low assignment risk due to the dividend. And then if that value is lower than the dividend payment, then you're at high risk of assignment. And then how do you find what the SPY dividend is? Because it's an ETF. There's a few ways you can back into it through the option chain. You can look at like a really far deep in the money put and then see what the extrinsic value is on that. Or you could just look it up on Google now. I just looked it up.
Yeah.
I think like the high end of it is like 167 or something like that. So if you're short a call and that corresponding put has a value of 167 or less, you're probably at high risk of assignment due to the dividend.
Yeah.
And it's kind of everybody beware a little bit because with market at all-time highs, it's very easy to have short in the money calls. So sometimes it's a moot point when we're not at all-time highs or we're not up. So with all these, and there's a lot of things that have dividends, I think tomorrow, right? SPY's not the only one.
Ooh, I am not 100% sure. There's probably a lot of other things that are going.
There's a couple other
tomorrow.
ETFs, I believe, that declare dividends.
Yeah, I know
It's just
SPY's the big one that a lot of our
word of
customers
warning,
trade.
right? Yes. So keep an eye on your short in the money calls on the dividend. But like I said, if it's defined risk, you can just go in. It'll come in. It'll cost you a little bit of money, but you can just exercise your other side or close it as a package tomorrow.
Yeah, you can always do like a covered stock order where you sell the option, sell the long option, and then also close out the shares as well. That's
Correct.
something we see on the desk a lot.
Yes.
And then I know you got another
number two that I want to go over. We've got GTH hours now for SPX. So you can trade SPX pre-market and a little bit post-market as well. So the hours are from 4 a.m. Central to 4 p.m. Central. And then if you wanted to trade these options, what you would do is, Jamal, if you want to just populate like any given trade on the option chain.
Just sell call put spread. Perfect.
Yeah, and then what you would do is just above review and send in the bottom right-hand corner, it says trade session market hours. You can change that to 24 hours. And then you can now trade the GTH hours. So you can trade it pre-market. I mean, we've got pre-market announcements. So if you want to trade those via SPX, you can do so with the pre-market hours trading.
So 4 a.m. to 4 p.m. Now my question to you is, and you don't have to know the answer to this. I think the zeros are different, right? So the zeros might open at 4, but I think they still close at 3, don't they?
Yes, the zeros still settle at 3.
No, the zeros close at 3. Everything else closes at 3:15.
Yeah, well now
Zeros
you can
close at 3?
trade. Yeah, so zeros settle at 3. You previously could trade everything until 3:15, anything beyond 0 DTE. Now you can trade everything up until 4 p.m. Central.
That actually changes a lot for earnings.
Mm-hmm.
Yeah.
So you'll get like an Apple that'll declare, not Apple's later, but let's say Nvidia declares earnings can move the market. You still have SPX options that you could trade. That's pretty interesting.
But you just got to set this to 24 hours, though, right? It's the biggest
Yes,
thing.
correct. Yeah,
Otherwise
you got to
won't get
change the
filled, it'll just be
market
working.
session from, or you got to change the like trade session from market hours to 24 hours.
Gotcha.
So can I trade a zero at 4 a.m.?
Yeah. Oh yeah.
But so zeros are going to be 4 a.m. to 3 p.m.
Yes, correct. Yeah, I traded them the other morning.
Okay.
There you go.
Huh. That's a game changer.
Yeah.
Yeah, right. Yeah, because
It
there's
is.
sometimes
Right.
where like, you know, if you're looking to sell the 0-day volatility and you don't want to wait until 8:30 when the market opens, maybe you want to do it at 7:30, or if you're Liz, maybe 4 a.m. You know, you're able to do so.
I do get up early. It's going to be me trading at 4 a.m.
Well, there we go.
Let's pull up this list that you got.
Yeah, let's go.
What's
for
going
it.
on in the
top
trade desk?
20
What people are
symbols
trading?
going through the system and their IVR. At number 1, that is so cool. At number 1, SpaceX with a 39, Tesla 23, Nvidia 18, Micron 91, Apple 33, TQQQ 71, Microsoft 56, Amazon 24, Palantir 18, SoFi 21, Meta 40, AMD 86, Broadcom 32, Robinhood 61, Google 31, Intel 84, Marvell 89, Netflix 84, CoreWeave 34, and SNDK 83. SpaceX.
What got kicked off? Put SpaceX on.
Gold and silver aren't in here.
Usually Tesla is like number one, but SpaceX being number one, I mean, Elon's just the king of trading volume here.
Wow.
Yeah, 1 and 2. What got kicked off? It is gold and silver.
Yeah, gold and silver were on here the last couple of days. They aren't on here now. Yeah, all 4-letter. I mean, well, not 4-letter names, but mostly 4-letter names. Everything on the NASDAQ.
Pretty much all NASDAQ. That's all NASDAQ. Yeah.
Yeah, that's all NASDAQ for sure.
Time to be alive. Oh yeah.
Wow.
The markets are
CRWV, is that always on there? No, right? Because that's down today.
No, it's not actually. Yeah,
Not always, no, but that's a frequent flyer though. It's not always on there, but frequent flyer.
Yeah, I'm gonna have to keep an eye on this. I feel like this stock has been doing something recently. Something to keep an eye on. Hugh, great stuff, man. Thanks for coming on. Good to see you as always. Folks, that is our show. It's been a phenomenal day. Obviously, we're paying attention to the markets because we have a big Fed meeting coming up later today. That's 1 p.m. Central Time, 2 p.m. Eastern Time. The Fed will issue their statement, and then 30 minutes later, Kevin Warsh will join the discussion for his first Fed meeting that he's going to be at. He's going to have a statement and talk as well. So stay tuned for that. We got a lot more content coming up. I'm Jamal Chandler. I've been joined by Liz Deerking. It's been a fantastic morning. We're watching SpaceX options. We're watching everything. We got TP and Chris coming up next. Tasty Live.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
If your trade's not going how you expected, it's not necessarily that your assumption is wrong. Maybe it's just not right. Yet. Rolling is managing a trade by closing your position and opening another one like it for a credit all in one order. The cool part is that you can change the expiration to get more time, or you can tweak the strike for a higher probability. Usually we want to roll the expiration instead of the strike. Remember, duration over direction. Exactly when and how to roll trades is a learned art, and it can be a little bit subjective. Usually we only roll if we haven't changed our assumption, and we almost never roll winning trades. If you have changed your mind, don't roll. Instead, you probably want to close it if it has undefined risk, or just let the probabilities play out if it has defined risk. So before you cut your losses, consider rolling the expiration or maybe even the strike. Pretty simple.
When you trade options at Tasty Trade, you see your probability of profit and loss right where you need it. Earn up to $3,000 in commission rebates.
We are back. You're watching Tasty Live. I'm your host, Chris Vecchio. He's your co-host, Tom Preston. Tom, you sound excited for Father's Day this weekend.
No, Chris, I can say this as a dad. You're a dad. It's a made-up holiday, okay? And that's as far as I'm going to go with it because I don't want the whole country to hate me. I know I'm okay with a good percentage of it, but I don't want 100% of the country to hate me. The point is, Chris, it's whatever. The expectations for Father's Day for me, whatever. My kids are much older than yours. They're in their 20s. You know, they'll probably call or maybe go out to lunch or something, but I don't have huge expectations for anything. And I still have work to do. You know, there's no day off. So it's whatever, you know. I'm not, I'm happy it's Father's Day, but I don't really care that much.
I'll be working. So
yeah, see, that's the whole point and that's okay. That's what us dads do. That's what we do. We work.
That's what we're here for. Markets here today, Tom. 75.76. Laura, we can go to those charts. 35.2 IVR. We're in a bit of a holding pattern, which is, I guess, no surprise given where we stand on the calendar. We're about 3 hours away from the Fed meeting. Tom, volatility here is up a touch today. VIX is in at 1686, but it's holding below 17. It's lower than where it was going into the last Fed meeting. Is that enough of a signal?
Yeah, it's painfully low right now. I was leaning bullish on the S&Ps. I sold put spread in the ES this morning, losing a little bit of money on that, and it's a defined risk trade, and I'm not worried about it. But the market's selling off here, I think, and talked about it today on the morning show with Liz and Jamal, is I don't think there's going to be any surprise with the actual number. Rates aren't going to change. It's going to be the comments afterwards and the market dissecting what those comments are. Who knows where that's going to take it? And given as I said, the politicization, what's the word, Chris? Politicization, the newly political Fed, or the much more obviously political Fed. I think it's going to be everybody's going to be looking at the exact verbiage he uses going out the rest of the year. By the way, the probability of a rate hike actually went up overnight. For the rest of the year, out to like the September and the December Fed meetings, the probability of going up another 25 basis points went up a couple of percentage points according to the Fed funds futures. So people are starting to think, maybe we could see an increase in rates before the end of 2026, even though a lot of the discussion I've heard is no rate increases. The bias is towards holding or cutting.
Well, look, the way that you can watch this play out in real time on the platform, if it's something that traders are interested in, the market sees more hikes coming. It could be problematic for bonds, could be problematic for stocks. If the cut odds go down, maybe it's a little bit of levity for the stock market. SR3Z6 contract. I don't think we're worried about what's happening here in June, Tom, or really in September, given the market pricing right now. I want to look at the year end for the December expiry. That right-hand y-axis there are numbers on the y-axis there. Simple way to conceptualize this, take that number, subtract it from 100. That is the implied Fed funds rate at that juncture, at that expiration. So I have two numbers marked off here, Tom, 96 and 96.25, because that would be the 4% implied Fed funds rate, or 3.75. Obviously, over the course of today's session, you mentioning that rate hike odds have gone up. We've seen the SR3 dip down and slouch a little bit the past two sessions towards the 4% level. So if that were to continue today, all of a sudden we're back to where we were at the beginning of June, right? When the stock market was in its hole at the beginning of June, that's when the market was pricing in a 4% rate by the end of the year. So I would watch that dynamic today around that 2 Eastern, 2:30 Eastern press conference, more importantly.
So one of the points about this, and bringing up that symbol, is really important, Chris, because what you're looking at with the with the FOMC meeting is they adjust the Fed funds rate. That is the overnight rate. And the impact of that change trickles out to varying degrees down the yield curve. The 3-month is, what we're looking at is going to be more sensitive, that rate is going to change more than, let's say, the 10-year note rate, a yield, or the 30-year bond yield. But those products have higher duration. In other words, they're more sensitive. Their prices are more sensitive to a change in interest rates. They're also more liquid. I think the 10 years and the 30 years are, when I say easy to trade, Chris, you know what I'm talking about. I'm not talking about making money. I'm talking about executing trades. So, I'm just telling everybody, reminding everybody that when they talk about changing interest rates today, those are ultra short-term rates. Are they going to have that much of an impact down the yield curve? Maybe, maybe not. I don't know. But what I do know is Lennar, looking at a company like Lennar, LEN, and Lennar doesn't have great options, but it's up today pretty sharply relative to where it was. I think the housing industry is going to be They had lousy housing starts come out these past couple of days. If interest rates start ticking up again, especially along the 10-year note, that could be just disastrous for the housing sector. So companies like Lennar, Hovnanian, Toll Brothers, XHB, the home builder stocks like that. Look at Toll. Look at XHB.
Sorry.
These things are rallying today. Why? I don't know. This is a contrary. I would consider a contrarian bearish trade in any of these housing sectors.
It all seems like it's predicated on what's happening with rates right now and how rates may have a chance to turn a corner here, which is something I was talking with Jamal and Liz this morning, Tom. I think this is probably the place where, if I'm thinking about my overall exposure right now, where I'm still mostly long deltas in the stock market, what will upset the stock market today, given where I'm trading? Probably going to be something with rates or yields. So what's the risk? Well, higher yields, lower stock prices. I should probably put something small on short term to bring down my beta weighted deltas here. That way, if the Fed comes out and says, we're fine with inflation, we actually can cut rates starting next meeting, yields are going to go ballistic at the long end of the curve. Right, and that could be really bad for the stock market.
So the other, and I agree completely with what you're saying, Chris. The other big point is we don't know the details of this Iran memorandum deal, whatever you want to call it. Crude oil's up today. The inventories of crude oil have been dipped down. We got the EIA report this morning. U.S. crude inventories were the lowest they are. I think it was 6 years, I think I read. I know they're low in the OPEC countries. So there's this bias towards, and I have bullish positions, full disclosure, bullish positions on CL. That said, I think that is a risk to the market that it's not immediate like this FOMC meeting, but I think any increase in a bounce in crude oil, anything like that could start slowing down the market.
Yeah, I mean, this is a great chart. This comes from Josh Young over at Bison Insights, oil guy. This is the U.S. Big Four storage, crude with SPR, gasoline, distillate, and jet fuel.
We are here.
So this is one of the I'm with you on crude longs. I don't know if it's going to be in the Q6 contract, but when I look out to like Z6, for example, after this little bit of a pullback right now, and that's a long time, and locking up capital for that long for a bunch of people could be problematic. But what are the odds that we're going to see the market continue to draw down these inventories, right? If the inventory drawdown stops, it means that they're starting to get rebuilt. It means there's going to be excess demand for crude for a little while. So I'm with you on selling put spreads here, looking for some long deltas. To me, 70 seems to be a perfect level in the Z6 contract, but that's so far away. Most traders are operating more short-term, like 0 DTE, what have you, which I suppose brings us... Can I go to trade here real quick?
I'm in the Q contract. I'm selling... I'm short some of the closer stuff.
I want to go over to ZN, though, because I'm thinking about this potential, what does a hedge today look like around a Fed meeting, given... I'm trading long NVIDIA, CRM, SMH, NASDAQ, right? 1 day to expiration. This is not a typical Tasty trade, Tom. This is purely thinking about what goes into the book today to potentially clip the wings of bigger losses. The 109 put 1 day to expiration here in ZN is going to cost me $15.63.
Yeah, I mean, it's, again, I know you love your long options, Chris, and I shed a tear, an invisible tear every time I see you do that. I would lean towards maybe selling the 975, 10, 25 call spread, something like that. The problem is the premiums aren't huge in these things right now. Volatility is relatively low in these bond products. That said, Chris, note volatility is relatively high compared to bond volatility. So the 10-year vol is a little bit high relative to the 30-year vol.
It's a minus 2 IVR right now for
IVR. And just looking at the raw volatility numbers, if you go to the trade page, What I look at is, and the 1 days don't really count, but it's like 8.5 or so compared to the ZNs, which is about 4.5. Typically, bond volatility is about 2 times higher than the note volatility. It is not right now. It's less than 2 times, which is why I suggest that note volatility is relatively high. And if you're going to sell premium, do it in notes, not bonds.
Notes are usually the better product for retail traders as well, given their size.
I agree, and really that's the benchmark yield. As you know, that's what drives the real estate market. That's what drives so much of retail interest rate stuff. There's people, these organizations, these companies still hedge with the 10 years. So, one stock there's a couple of stocks coming before we close out. CME is down big today.
Another day.
CBOE was down. CBOE was down big yesterday. I'm leaning towards maybe getting long some deltas in these exchanges, given our trading activity, given the rise in just the overall trading activity. And I know they're down for a variety of reasons, but with these IV ranks, they're crazy. Robinhood up huge. Robinhood up huge.
Good day for some of the brokerage stocks out there. Yeah, these perpetual futures, Tom, you and I are going to have to get into them a little bit. They kind of remind me of CFDs in a sense.
Yeah.
Which aren't tradable here in the US. You can trade them if you're over in the UK or Europe. But it's an interesting product, and I'm hard-pressed to think why wouldn't CME and CBOE offer these as well, given their structure?
Hey, Chris, I don't know, because the CME and the CBOE have the finances to fight any legal challenge they want. What do I mean by that? I've been involved with, as I've mentioned, building exchanges, building the smallest exchange, and the difficulty in product and licensing and laws, all that stuff. That stuff is hard to overcome. That those exchanges figure out how to get involved in a bigger way, they would figure it out. They have the legal weight to fight anybody.
They do, and they're not going to give up their market share easily. It's an interesting impulse that's driving the market here, and really it feels like it's just a round trip for a few weeks here. CBOE's back to levels it was trading back in mid-February. Tom, I know that you've got to go here. We're getting ready for this Fed meeting, so we're going to swap you out of bringing Glenn F, as his friends call him. Tom, we'll catch you later.
What's up?
Glenn! There he is.
My
you getting
man.
ready for today's Fed meeting?
I'm so excited. I mean, it's kind of...
I can tell.
I'm kind of nervous, like a new teacher,
So. Oh, true. Yes, the professors here. Stock markets have been oscillating back and forth. The S&P, for what it's worth, 35.6, down by 7 points or so. The world of FX here is a little bit warmer today, though. I'm looking at a U.S. dollar that's bouncing up ahead of this Fed meeting. There's been a bump in rate hike odds, however, marginally over the past 2 sessions. What do you think that we should be doing here, looking down the pipeline to what new Fed Chair Kevin Warsh might say?
Yeah, I mean, dollar's creeping up to no real substantial degree, but still nice to see and interesting to note which way we're kind of sliding into this decision, because like you said, across asset classes, we're waiting on this decision, a bit subdued here early in the morning. What I am looking at, to continue your discussion on rates and those impacts, specifically within the bond market, just pulled some numbers around 1 month correlations for if you are getting granular in trading spot FX or even FX futures. Where do you look if the main driver will be around this rate storyline? And the good news is you don't have to look very far. Historically, we've had dollar yen is one of the more popular products to look for correlation to rates. This time around, we're seeing the euro dollar and the pound dollar move in tandem with the rates over the past month or so. I don't see a large case for why that would decouple today or tomorrow in the short term. of course, over the long run, as this story ebbs and flows, perhaps that correlation does break down. But why I bring that up and why it's nice is this euro dollar, not only the most popular pair to trade, one of the most liquid, one of the lowest margin rates on the spot FX side, and you're not getting the kind of counterparty event risk in the form of an upcoming central bank meeting from them. ECB had it last week. If you're looking at the pound, you're rolling this Fed meeting right into a Bank of England meeting, which of course you could play to your favor. But if you're just looking for this, dollar exposure, I see no real reason to look farther than this euro dollar, which is a good sign. It's been very compressed as of late, stuck to this 116 level in the spot market. A little bit of downward pressure today, but that's where I'm looking. Is that making any sense on your side?
It makes zero sense, Glenn. Please start over. No, that makes a ton of sense. I'm just running some correlations here across the board with like 2 years and 10-year yields versus euro dollar, pound dollar, dollar yen, and a lot of them are just kind of flat right now.
Yeah.
And it's almost like to say that the market's been ignoring the rate differentials in the short term. But today's probably going to be a turning point, right? You obviously got to keep an eye on the euro. It's 57.6% of the dollar index. So as it goes, so goes the broader dollar complex. I feel like you have to just be directionally agnostic here, right? Maybe the options are a better way to do this, but this has been chopping around for how many weeks right now? Euro dollar spot since the end of, well, this is actually a weekly chart. So we're talking about a year at this point. We've been going up and down, slinking between 114 and basically 119.
Yeah.
That's really difficult to play in the short term if you're going to be a spot trader, in my view, having done spot for a long time. Do you sell here against the moving average envelope as a momentum trade, or do you wait to buy a dip down towards 114? So in kind of that omnidirectional sense, one way to go about this, we're expecting some semblance of a move here. You could do something like a reverse iron fly. We talked about this recently here. But a reverse iron fly is effectively buying the at-the-money call and put, and then going out and selling the wings. So in this case, we'd be going down, selling the 115, and we go out here and buy maybe back the 118, and sell the 118. And it gives you something in the neighborhood, actually a little bit better than a 1-to-1 risk-to-reward ratio with greater than a 58% probability of profit. So here's the occasion you get higher than a 50% pop alongside something like a better than 1-to-1 risk-to-reward. But the idea here is that Eurodollar needs to move. It can't get pinned close to 116. It's got to move away from the center point of its recent trading range. So spot, I think, is a little bit more difficult to crack because there's no range trade, so to speak, that you can put on to effectively say this thing is going to stay pinned or move away from the current point without potentially picking the wrong direction.
Absolutely agree. I do see what I have seen recently in the spot market when you're playing more of a dollar-denominated story is you can get, depending on the different tape action you're looking at, you can set up kind of risk-reward that's favorable from a tape action perspective, if that makes any sense. I mean, of course, these markets can go anywhere, but if you're looking at a dollar Canadian dollar and you're looking to get short US dollar, that chart sticks out to me because we're pushing into new year-to-date highs that we tried a couple times over the past week. I only say that to call out if you are looking to get short US dollar there, pretty quickly if you're wrong, trading into these new highs, and then a lot of potential downside if we potential upside for your position, downside in this market if we retrace anything there. So that's how I'm looking at the US dollar tapes from a granular perspective. But you're absolutely right that if you're structuring a non-directional bias, that euro dollar's looking good and bad. Good because we have recent history of it falling away from this 116 level, but it likes it a lot. So
it does like a lot. And you brought up dollar CAD here. I have a weekly chart up here on the screen. It's made an important move. And for those that, aren't so privy to FX, there is this relationship where dollar CAD, because it is both countries are so closely tied together economically, people view dollar CAD as kind of like a bellwether for the broader dollar complex, not dissimilar for what happens with the euro pound pair. And so to that end, the fact that you do have dollar CAD rising right now, it suggests that you may be going into a little bit of a tighter financial conditions environment, which is why we're keeping an eye on that 10-year yield today. Because if the 10-year yield ultimately does make another leg up, the dollar is somewhat positioned to take advantage of it when you take a look at the charts. FX, though, the volatility, where would you affect a trade like that? The euro probably, 62.8 IVR right now. Doing a reverse iron fly is usually best when you have a low volatility and you're just expecting things to explode. Putting it on when volatility is already this high can be expensive, so choosing your product fit matters more than it usually would. That's why the yen actually is the most fascinating thing among these grounds. I know that I'm looking at my little 0064 long call just in case they intervene. But what if they don't intervene? What if the market just starts to run from here, right? And if it breaks through 160, I'm of the mind the thing is just going to explode towards 170. So this feels like the better place to do something like a reverse fly if we want to play that market, where it's a little bit less buying power. It's still better than 1-to-1. In fact, the probability of profit here is increased given the current strikes that are laid out, and 59%. Still pretty good. I like this at 51 days to expiration. Something's got to happen with the yen within the next month and a half. There's no way we stay pinned at 160. There's no way. There's no way. So I'm going to put this on here. Hopefully it gets filled before the Fed meeting today.
There you go. Yeah, that the one call out to make with trading these yen futures options are the market hours and just being wary of when you want to manage these trades, because best case scenario, you get filled right now. You get a move right after our new friend Kevin Warsh starts speaking. You could want to take that off immediately during U.S. market hours, not even give the Asian session time to react. And on the opposite side, you could get a move in your favor during the Asian session and have to be waiting all of those hours to try and manage this position. So just something to be aware of, but you're absolutely right. We haven't stayed at this current price level for long, even though we've hit it numerous times now. 160, very normal over the past year and a half now, but should be super interesting. Excited to see what and how much our new friend Kevin Warsh says later this afternoon.
Ilya and I are going to be covering the Fed meeting today starting at 12:50 Central Time. We're going to go for about 20 minutes. We'll bring in Tom Preston to go over the trades. Then once we get a breakdown and lead into Gus and Errol ultimately for some scalping. So we will have live Fed coverage today. Until we get there, though, 75.81 here on the S&P 500. It's down by 6 points. The market is just chopping around as we wait for our new boss friend, Kevin Warsh. Purple tie time to buy? We'll find out in a bit. We're going to do a quick break here, though, on Tasty Live. Gus and Errol are going to be back shortly. Glenn, thanks for joining us. See you after the break.
First thing about Tasty Trade is how easy it is. It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
If your trade's not going how you expected, it's not necessarily that your assumption is wrong. Maybe it's just not right. Yet. Rolling is managing a trade by closing your position and opening another one like it for a credit all in one order. The cool part is that you can change the expiration to get more time, or you can tweak the strike for a higher probability. Usually we want to roll the expiration instead of the strike. Remember, duration over direction. Exactly when and how to roll trades is a learned art, and it can be a little bit subjective. Usually we only roll if we haven't changed our assumption, and we almost never roll winning trades. If you have changed your mind, don't roll. Instead, you probably want to close it if it has undefined risk, or just let the probabilities play out if it has defined risk. So before you cut your losses, consider rolling the expiration or maybe even the strike. Pretty simple.
When you trade options at Tasty Trade, you see your probability of profit and loss right where you need it. Earn up to $3,000 in commission rebates.
Suena Ave María Morena. Oye, digo Morena, 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 ven Morena, Morena. Oye, Morena, Morena, mira que bien Morena. Estas son las rumbas Morena, en Rumbala Morena. Estas son los buenos, buenos. Hacia la rumba buena, estos son los ratos buenos. Oye mamá, cántalo hasta mañana. Oye pero ve morena, oye morena buena, que bien ya te suena. Oye.
What is going on, everybody? Happy Wednesday and welcome back to Risk and Reward. I would love to say that it's the middle of the week, but as we traders know, it is not. We have a short week this week with Juneteenth this Friday, so it is a synthetic Thursday today. And I'm joined as always by my wonderful co-host, Errol Coleman, who's looking sharp, who's doing red shirt synthetic Thursday today, if you will. How are we feeling, Errol? What's going on?
We'll take it. Red shirt for a red day on SpaceX so far today. Sold a few policies today. Got the Jake from State Farm comments a few times today too, so I'll take it. No, I'm excited for the volatility. I know this is the second day that options are being traded on SpaceX. I haven't dabbled myself, but being the first week, the official full week for SpaceX to be out there on the market, it's only right to take a few positions. So I'll be keeping everybody posted whenever we dabble in there.
Yeah, I went as Jake from State Farm for 2 or 3 Halloweens in high school.
Did you really?
Because it was so easy. It's just khakis, red polo, and I just slap a "my name is" thing on me and write Jake. People loved it too. It wasn't like a cop out. People were like, "Oh, he's Jake from State Farm."
Oh yeah,
it's right
Absolutely.
there.
I would have.
Anybody needs a free Halloween costume out there, you probably have the equipment to be Jake from State Farm in your closet right now.
Yeah, I'll come to you to get a couple policies closed. Absolutely, if I see a Jake walking around.
Yeah,
great branding for that brand.
It is. It is. Yeah.
Are you in good
did you say Allstate just now?
Are you in good hands?
You must know that you're saying Allstate. Yeah, insurance companies in general got good branding right now. I love the Liberty Mutual commercials. Which
one is that again?
They got Limu, Emu, and Doug. It's the emu, the guy in a yellow shirt. Those are hilarious. I also love the guy in front of the Statue of Liberty that just says Liberty Biberty over and over. Really makes me laugh. Big fan of that guy. We have an exciting show planned for you guys today. In about 12 short minutes, we will be joined by Andrew Rader, special guest. Options aficionado, gamma exposure aficionado. We're excited to have him on. But before we do that, we can jump straight into the Tasty platform, talk about some of your positions and today's market action.
Yeah, let's jump into the platform here. We got the Tasty Trade platform pulled up here. I guess we could start with SPY since we have that pulled up. You already know the go-to is QQQ, but we got SPY. We can't ignore, the regular S&P 500. We're getting a little bit of a sell-off today, a little bit of back and forth action. A lot of, I don't like to use the word manipulation, but a lot of clear liquidity grabs clearly on both sides of the market. And that's to be expected, especially with something like FOMC coming up today at 1 o'clock Central. So it seems that a lot of capital is probably on the sidelines right now to make a little bit more definitive decisions whenever that announcement comes out. So that's kind of the market that we've been trading in today, at least. Very choppy. Some of the price action that we saw this morning, we put in some very prominent highs, some very prominent lows, put in some new day lows, and then pretty much reclaiming and recovering back to pretty much near where we opened up today. So that's pretty much been the story all morning. Very choppy price action. If you're intraday trading today, it's one of those days where you got to just take what the market gives you from a shorter duration, because we can't expect any type of full continuations until clock central today. So I'm curious to see what we get. Today's going to be the first day that we have the new Fed chair sitting in the seat. So I'm excited about that. I know we were talking about how Jerome Powell became a little bit of a meme. Your thoughts on this new guy coming in? Are you excited just to check out his presence and persona there?
Yeah, I just think this is a spot where, as a trader, just a little change. It's fun and welcome. Shake it up a little bit.
You're kicking Jerome Powell to the curb.
Interested to see what the new memes bring on. It's a fun little shakeup. I wouldn't say I'm kicking Jerome Powell to the curb. Respect him for all that he did. He was pretty good at the job, as many memes as there were.
Oh, he was. He played the role really well.
Yeah, he did. But it's a little shakeup's fun. Keep things lively. Tune into the Tasty Live Show Instagram later today to see Errol and Jamal discuss the Fed results.
Yeah, we'll chop it up a little bit
live. Yeah, we will have a mini stream there. But yeah, obviously, market sort of just in a holding pattern here as we await what the new Fed chair has to say. I don't believe that it's not in the equation at all that he's going to change rates, right?
Yeah, maybe he'll be holding them there. That's going to be the consensus going into it. Maybe we get a surprise. I don't know. But with that being said, we got volatility upticking just a little bit there, as headed up to this binary event. Volatility sitting at 16.81. How are you kind of viewing volatility right now that we finally collapsed over the last few days? Finally.
Yeah. I'm just not. It would be hard for VIX to do anything that could surprise me at this time. And I'm not surprised to see us climbing up a little bit today. I suppose that this is a little bit more of a jump in VIX than I would typically expect from the very slight downward action that we have going on today. But I don't know. It's sort of a nothing burger to me. Like I said, I don't really pay attention to volatility until it's over 25 in this environment.
No, I hear you. I'm kind of piggybacking off that same idea with volatility right now. Just kind of waiting on it for it to do something now. It's funny because, again, when volatility was trading at around like 20, 21, 22, I was kind of sitting there a little bit like, do something. And then it contracts very aggressively. Now I'm like, okay, well, I guess we did have something. And now I'm really waiting for volatility to do something here. So I don't know what it's going to take to spook the market. I don't know, a surprise announcement with the Fed, I think, could spook the market a little bit. I doubt we get a surprise announcement. But with that being said, volatility is sitting at 1680 right now. And again, that's relatively still high for what we've seen in the past, prior to 2020. I know we bring it up a lot, but I think we were kind of spoiled with the premiums and volatility we've seen after 2020. Ask guys like Scott and some other guys that's been trading over the last couple decades, they'd still tell you 16, 17 is pretty high based off of what they've seen.
Yes, it's what we've become accustomed to, and then the goalposts just continue to move higher for me.
They do.
My laptop has decided to take an OS update now. I clicked nothing, but I'm sitting here staring at a black screen with an Apple on it.
That's hilarious. No, I always press delay. I'll do it tomorrow. Sometimes I'll update the computer tomorrow for like 2 years straight. No joke. And then I'm wondering why my computer's slow.
Yeah, now it's just bricked. The Apple logo went away. There's nothing here, and it had the questions for the guest on it. So yeah, we're gonna have to rattle these off dome. We'll see what we got.
Gotcha.
You're still short the Qs, I see.
Yeah, I'm still short the Qs. Sold an out of the money call spread there. Again, sold the 755s, bought the 760. We collected about $1.69, so just about 3 pennies over a third of the width. I'm pretty. What's the word I'm looking for? I'm pretty meticulous about how much credit I'm really receiving on these things. I really don't want to go underneath a third of the width, right? Like $1.66 is really the sweet spot. Would love to collect a little bit more, but anything under $1.66, in my opinion, it's just not going to be as worth it. Just Because again, the less credit you take upon a defined risk trade, the more risk that you have overall. So it's like the more credit that we can receive up to that $5 with, the better. 50%, you're probably pretty close to the money, and then you're playing with fire a little bit there. But it is nice to reduce that risk, get a little bit of extra reward. Some might argue just sell the strangle, just sell an undefined risk, get a little bit more profit under your belt. But you can always sit very comfortable in these swing positions when it comes down to trading the broader market, at least. So we'll keep an eye on QQQ. And as we have a couple minutes here left before we have our guest come in and join us here in about a minute, check out SNDK. It's funny, whenever we bring this up, it kind of surprises me how impressive this move has been. I'm still going to be patient to get on any type of short delta in here. But SNDK and Micron still putting in legs to the upside. And has not really proven any type of backside just yet. So we'll stay patient there, but that's kind of what's had my eye. And lastly, before we pivot here, we can take a quick look at oil. And let me know your guys' thoughts on oil. How are you guys kind of positioning right now? I know we had a lot of traders in the tastylive community already getting a little bit more short delta onto the downside. Now that we've had 3, 4, 5 consecutive days to the downside, and we've even took out yesterday's low, put in a new low for today, recovering a little bit there now. But I'm looking at a little bit of long delta. I want to get on a little bit of long delta. Might use USO to get a little exposure to the oil market there. But let us know how you're kind of viewing oil right now. I know there's still more headlines coming out about how things are okay with Iran, and it's allowing a little bit more air to come out of these oil names. But we'll keep an eye on it. Oil definitely seen a little volatility to the downside, though.
Well, I'm being told in my ear that we are ready with our very special guest for today. We can bring him on in. This is Andrew Rader. He is at Rader Trader on TikTok.
Good to see you
Instagram.
guys.
Good to see you. How you doing today?
Good. Well, man, exciting market. Lots and lots to talk about.
Yeah, Andrew, you wanna do the plug yourself, or would you like me to do it for you?
You can do some of it. I'll finish the other half for you. How about that?
Sure. Andrew, he runs the RaderTrader.com, which is a website predicated on the idea that options pricing increasingly drives the pricing of the underlying asset, not the other way around, particularly as it pertains to gamma exposure. He has a ton of very cool proprietary tools there based on this idea. Did I do a good job there? Anything you want to add?
Yeah, you did. One correction. It's the RaderReport.com.
RaderReport.com. Yeah.
Absolutely
apologies.
Fine. No, you're good. To build on that, though, there's a lot to kind of what I've done in my life. I'm very young, but I really did start out with a focus on options. When I first got into trading to begin with, a big interest of mine was, well, wait a second, if you're talking about trading, there's this really, everyone was like, hey, trade equities, it's safer, all this. But when you look at it, if you're a trader and you have edge, and edge is only within a defined time window, and you believe, this is going to play out during this time window, then there's no better asset or, way of expressing that idea than options. So I was really interested in that. And through my, several years of research, I was able to develop a few different tools that I think are unique to this industry, but also just build off of knowledge and get to a professional level as far as how I trade with derivatives and stock alike. So.
Yeah, no, that's awesome, Andrew. And I'm also curious. I know you're kind of an options guy yourself. What kind of got you interested in a little deeper in terms of option flow and gamma exposure?
Yeah, so I mean, over the last 10 years, even, you do a lot of reading of what options are, and there's a few great pioneers in this industry. There's people like Jem Carson and other voices to help point people towards this growing, not problem, but growing, influence of options on the
100%.
underlying market that. Even Charlie Munger and Warren Buffett have made comments before regarding that they believe options, they're concerned about them because they're starting to take over the market and to some degree influence them way more than just the traditional stock market. And that's, I'm sure a lot of your viewers know already, but the volumes in options have been exponentially growing as product issuance grows, as, the demand from institutions to hedge these massive long positions grows. You need more options. And with that demand for options, you have a bigger need from market makers to influence the underlying price because they need to, hedge out their risk for providing the supply of options. So there's this really interesting dynamic there that ultimately has influenced the markets.
No, I love that. And then also, I am curious again with the options flow. What are some of the most common products you like to view the options flow from? Is it usually the indices like QQQ, the ETF for NASDAQ, or how do you kind of, view the options flow and what kind of options have the necessary liquidity that makes it attractive to view that gamma exposure?
Yeah, so when I first started out looking at option flows, I started out with the big names and names like Nvidia, Tesla, etc. But what you then realize is that individual orders on stocks like that are far more impactful or less impactful than something which has a massive derivative order on a stock that had previously no option volume.
Yeah.
So there's this really interesting dynamic of, well, how do you balance that between one big large order and the market cap of the stock? But over time, I've really narrowed my focus to kind of what I expect flows to actually do. I mean, a lot of people look at individual orders. There's a lot of services like Unusual Whales or where they track political or even just unusual option volumes. What I typically like to look at rather is just the and this is what I kind of built a tool around, was basically looking at the total flow volume. So, and ranking that against historical readings of that stock, because that way, a $5 million order on Tesla is not going to be the same impactful order than a $5 million order on something like Kohl's, KSS, where there's no option volume. So,
Andrew, give us a little
just.
No,
Yeah,
didn't mean to cut you off. I'm sorry, but if you don't mind,
good.
we have you on here. We're here for a little bit of the sauce. Give us just an idea of some of those playbooks that you like to deploy into the market. And then I assume you use some of those tools that you like gamma exposure, options flow, to then gain a little bit more confidence and conviction in terms of what you're doing. But what does a playbook trade look like for you?
That's great. Yeah, I mean, there's a bunch of simple ones, and I'll just give you a time relevant one, and then I'll kind of give you another, maybe a more classic one. But even with SpaceX yesterday, you guys know that options were introduced to SpaceX yesterday.
Yep.
And there was a big run up into SpaceX. And because of how big of the run up was, you guys saw in the after hours that it spiked to 230 after already 2 days up. It hit that $3 trillion market cap in the after hours. And then we opened right around 2:15 at 4 a.m. on SpaceX. Well, a simple playbook there with options is just simply anchoring in the idea that with options now unlocking, you have a lot of people, institutions who are unhedged, who are long SpaceX, and hedge funds who are buying them would like to hedge because it's up so much. So the thesis there is that you can expect a lot of people to buy puts, and that's going to drive a lot of selling pressure because, again, when you as a participant go and buy puts, market makers sell you that put, and they have, naked exposure to that put, which they can take an infinite loss on, so they have to sell equity to hedge. So that creates selling pressure on the market. And, the thesis yesterday, which was actually a PR trade in my career, was shorting SpaceX to have that. Now, there was that first move up that squeezed everyone out, but on that backside, you can see even today, it's just melting lower. And that's, again, just a very simple playbook of, with IPOs in the future, such as OpenAI and even Anthropic coming up, you can deploy this idea and really look for, if there's a big run up into these option unlocks, there is a very strong case to say that they could go down.
I love it. And, zooming out a little bit here, obviously options are traditionally the focus of the Tasty audience. But as your research suggests that options markets increasingly drive price action rather than just reflect it, do you think we're at a point where the tail is fully wagging the dog here? And if that's the case, what are the implications for traditional investors?
Yeah, sure. So I think this is situational. There is increased magnitude of, impact during certain market environments in less than others. So, for example, when you're in a market where markets have been extremely quiet. So I'll give you, this will kind of lead into another playbook. But I think we're not quite to the point where the tail is being, the options are fully wagging the market per se, because at the end of the day, it's ultimately about stocks. And where options really is not only boosting the volatility of these stocks, but adding, a little bit of a deeper layer of information that you don't get otherwise in the equity markets. So, for example, one of the other playbooks I was going to tell you guys about is just really simple. It actually worked out on June 5th on SPY, where it's super simple. And you kind of just expect, it's called what I call the Jex flip playbook. So whenever you have a run up in a market where it's just positive gamma, positive gamma, positive gamma. So, 10, 20 days in a row of the market's really healthy, really green, indices and positive gamma, their ranges are compressed and they're just climbing higher. All of a sudden, after, a 10, 20 day period, you'll see one day, whether it's a catalyst, like it was on June 5th, kind of gap it down below the negative gamma Jex flip. And when that happens for the first time in 10 to 20 days, what you actually get is a very simple playbook. It is in the morning, you want to look to short pre-market lows. You want to look to, buy, basically short anything with 0DT puts or with equity, short a pre-market low or first opening drive or break. And then into the afternoon, this is the one I like with 0 DTEs, is taking an afternoon roll. So oftentimes you'll see it bounce, either come up to that open or below the Jex flip, and then it'll start to roll over into the afternoon. And the kind of mechanics there is that in the morning, you'll see that IB spike. Into the afternoons, volumes decrease. All these 0 DTEs start to decay, causing a bounce, market makers buying back equity. And then as those decay happens, that afternoon roll can give really great prices for 0 DTE options because they actually decay often more so than even they were at the morning. So you get the same price, but a cheaper contract. Really simple playbook there. But yeah, that's kind of where I'm leading to. Yeah.
No, Andrew, I had actually peeped some of the entries and exits that you took on SpaceX. I had seen that screenshot. So you're a little bit of a scalper sometimes. Sometimes you'll take more scalping opportunities if the volatility is there. Or how do you view that? Is that accurate?
Yeah, so we, trading at a professional desk, there's a variety of different strategies you do. You're expected here to trade a variety of strategies based off what the market environment is. And something like SpaceX is not you can't short this as it's going up 3 days in a row, super strong, and expect it to go down to zero. So it is a move-to-move trade there. And so because we didn't have options, we have to really trade that with equity. But there are instances in significant runners where we'll throw on something called a hedge trade, where, for example, on CAR, what we'll do is grab calls in the short term because we believe CAR, as you could kind of see it break through 200, 300, it's going to turn into an overextension eventually, right? It's going to come back to earth eventually. And because we know that, what we can do is throw on some calls and say, we're going to be long until it's a good short. Because right now it's a bad short. We know it's a bad short. We know what a good short looks like. And so what we'll do is we'll be long calls against short stock when it starts to turn. And that way that we have protection, and that we can actually, when that finally unravels the CAR, we can load the boat short with equity, still have a cushion of calls, and then be able to sell those calls to have a bigger stop. So that's kind of the different dynamics we'll do. But yeah, most of the time we are scalping intraday, but the big trades we take at the desk are definitely swing trades.
No, that's awesome. What's kind of the threshold? I know I'm pulling up CAR right here. You were speaking about the CAR ticker, right, where we had that kind of parabolic move and then that blow off top. What is the threshold to start buying these calls, to start hedging that position when understanding that the top could be near, right? We don't know the exact top, but what is the threshold for when that hedging becomes a little bit more attractive?
Yeah, so it's really interesting because when you talk about a playbook, one of the most important things for any traders is to have the best examples. Go out and grab 10, 20, 30 examples of how this trade plays. So for example, this was a daily overextension short. And so if you can recall different setups such as Silver, such as Circle, such as even prior names like MSTR in 2024. These playbooks, what you'll find is in the final innings often of these daily overextension shorts is you get expanding price and volume. It kind of looks like a cellular service on your phone. Expanding price and volume, starting to go parabolic. Dollar volume is increasing at higher prices. And once that starts to happen, once implied volatilities, again, with options, become so unsustainable, the argument for a top becomes stronger and stronger. And so for something like CAR, what actually happened was, or even Silver, this is a great chart, Silver or Gold, was you had the biggest gap in the last 4 days. You had just a tremendous blowout of that first kind of red day. And that was like, okay, this is pretty crazy. Like having the biggest gap, one of the biggest gaps in the trend so high up at these altitudes is a big sign of exhaustion. And so off the morning, you're looking, hey, how can I position into options short now that you were long calls? But specifically for when we're deploying long calls, it's often an uncomfortable place when we're like buying highs and we're like, we have to have an imagination because you're buying calls at a really uncomfortable place, but that's where it gives really good edge because not a lot of people are expecting to continue higher. As far as where we're looking to hedge, it's really when those big gaps come in, when huge volume to the upside or an unsustainable move happens. And in the case of commodities, oftentimes the moves were after hours, so we were positioning short in the early AM or PMs.
Absolutely.
Fascinating. Yeah, and I would ask as well, circling back a little bit more into your framework, but gamma exposure, open interest, these things are becoming more popular. And as those tools grow in popularity, do you think that there's any risk that your edge gets arbitraged away? Like at what point would you begin to rethink your framework on those things?
Yeah, what I like to say is that I believe that options data is incredibly powerful. I think some of it can be turned into automated strategies or at least, but what ultimately to me options data is a tool in my toolbox. So for example, open interest. What can open interest give us from a basic information standpoint? It can give us levels of importance. It can give us locations where we can expect maybe a turn or something like that. But what it can't do is say, I'm going to buy off the biggest open interest strike every time and make money. We know that doesn't have edge. And so we have to kind of work that into a different playbook, a broader playbook. So for example, if you're a breakout trader, how can I work options data into it? Because it can give you a lot of data. Well, for example, if you have a stock like ARM, which was recently breaking out into all-time highs extremely aggressively, you don't have any frames of reference for technical analysis to the upside. And so, there's no equity volume you can really see. So what are the best ways to look at maybe some levels? Well, definitely the options positioning, because that can give you a level of information that you can't otherwise get in the equity chart or the price chart. So using options like that, but no, I don't think there's a few things in the market that will never be edged or eroded away, rather, and that is human psychology, and that's going to stick around forever. Breakouts have been working forever. If the stock is on a catalyst and it's a good one and people want to buy it, no matter what institution is out there, they're not going to be able to arb that out. And so for stuff like options, especially, options are always going to be mispriced in some areas of the market. Options are always going to be the best vessel in underpriced for what could actually happen in the future, because it can't see everything in the future. So things like open interest, those, and even like option volumes, those I think are here to stay. And it's nice that you can talk about them and not worry about that.
So what you're saying is human behavior never changes and kind of repeats over time.
That's for better or worse. Yep.
I know
that's a great answer. I mean, that's something we talk about all the time. Is it's all the markets are just one big psychological thing, and
100%.
And human psychology is never going to change on you.
Absolutely, we exaggerate moves to the upside all the time. We exaggerate moves to the downside. Quickly, I know you had mentioned some of the data points or some of the criteria that you'll have for some of these playbook trades. You mentioned dollar volume for a moment. Is dollar volume something you track specifically on these parabolic type moves? And then also, are you just taking the average volume traded that day multiplied by the average price traded, or what are you looking at there?
Yeah, there's a few simple ways you can do it. You can literally just do dollars, the stock times the volume traded on the day, or some people do it from VWAP, like what was the shares traded at VWAP, and things like that. I think, to keep it simple, dollar volume is just an idea that, you're trading big volume at higher prices. So if you have a day with 10 million volume, and then the stock's at $100, and then you have, it goes up to $400 the next day, but it only did 8 million volume. Well, just because it did 8 million volume, it did less volume. The dollar volume was still insane. And so it was way more because it's 4 times the price. So it's harder. Even though it did less volume, it's still harder to sustain. It's extremely difficult to sustain that. So I think not a lot of traders look at that, but just to keep it simple, like something like silver or SMDK had this very situation where you're going at higher and higher prices. If you want to short something that's going up that much, you would hope that the volume is also increasing, because ultimately what a daily overextension short is unsustainable price action over a certain period of time. So what is unsustainable? Well, you have to define that, and it can be easily defined with volume and dollar volume.
Yeah, absolutely.
Absolutely, yeah. I would say, and I mean, you can keep this brief if you'd like, but options volume and structured product issuance have really exploded over the last decade. What's one market behavior that you would say exists today that simply didn't exist 10 years ago because of this explosion?
I would think just the pure violence of momentum we're seeing. I mean, we're seeing breakouts. I mean, think about this. Like, we're seeing some of the biggest companies in the world make $100+ billion moves and breakouts in a matter of days. It used to take weeks for something like ARM to get to those prices, or it used to take weeks for memories to explode that high. And now we're getting it in 3 to 4 days. And if you miss that 3 to 4 day window, it's over. So just the sheer opportunity that we're getting now is of what you can make in multitudes over a shorter period of time is insane. And I think that's why you're seeing a lot more traders. I mean, even if you guys are into like the Market Wizards books and stuff, you're seeing a lot of people become breakout traders and make an absurd amount of money. I mean, I think Kwalamagi made 70 million within.
He's nuts.
I don't even know.
He documented that
live.
live.
8 months.
He documented that live.
8 months.
Yeah.
And it's all breakouts. It's all because these breakouts will work, in 4 or 5 days and give you 20, 30 R. And it's like, you just didn't get that back then. So that is the blessing of options, but also the curse of that is, if you're wrong, you lose very quickly and very badly. So
I know we only got a couple minutes here left. Were you able to check out the new Markets Wizard book that just dropped over the last week there, Andrew?
Yeah, I'm still reading
Are you
through
still
it.
reading it?
I will say some standout people in there that I really love. Lance, we work closely with him at our firm.
Are you really?
And he's absolute gem. Lance is.
If you don't mind, what firm are you at again? Are you at Trillium or where is he?
SMB Capital.
Oh, you're at SMB Capital.
He's an advisor for SMB. Yeah.
Oh, okay. I knew he was an advisor for Trillium and SMB, but I didn't realize you were at SMB Capital. That's awesome.
Yeah.
I know one of the guys over there at the desk. I'll have to reach out after this.
Yeah, he's really cool. And, just a ton of gems in there. One standout, too, if you guys haven't read, is Simon Russo. Now, that's a fake name. That's not actually his real name. But if you actually go to his memoir, simonrusso.com, he has posted some of the best trading literature as far as psychology and everything like that. I would 100% recommend everyone after this to go read this over the next few nights. I have read it. I have taken extensive notes over it. And this guy gets it. He gets human psychology. He gets the issues we all experience. And I think you guys will read that and be very refreshed because he tells it in a very interesting way. So that is some of the best trading literature I've read in the last 4 years.
That's fascinating. That's a great recommendation. I do have one more for you. If we could, we keep it quick, 30 seconds here.
Yeah,
but,
keep it rolling.
If you could only look at one market indicator every morning, what would you choose and why?
One market indicator, probably every day. Not a lot of people talk about this, but very simply, where is the market? People want to talk about, put to call ratios or, even like where the MACD is or even market breadth, but very simply where the market is. That's like and it sounds barbaric and super simple, but it is. And it's like right now, like for example, where the market is right now, would I want to go and take huge breakouts and everything right now? No, we're still below all-time high. We're still, in this mess. We still have Fed coming up. So until that clears, I don't really feel like there's opportunity in taking these big breakout trades yet. But when the Fed clears and you see maybe the market gap to 760, what is the expected value of taking breakouts then? Well, it's much, much higher. So just basic indicator, where's the market? Are we from highs? Are we back towards highs? Are we climbing to new highs? That validates everything.
Awesome. I heard expected value. You're definitely an SMB guy. Expected value. I hear Lance in my ear right now.
It's a Lance disease at our firm. Yep.
That's hilarious.
Well, that is going to be all the time that we have for you today. Thank you so much for coming to join us, Andrew.
Yeah, I appreciate you guys having me on, and it was awesome being here.
Yeah, that's Andrew Rader, Rader Trader on Instagram and TikTok, theraderreport.com. Be sure to go check out all the wonderful tools that he has there. That's all the time that we're going to have for today. We'll be right back here on the network
thanks so much.
Later today at 1:30 p.m. Central Standard Time. Be sure to come hang out with us. Like and subscribe to the Tasty Live YouTube channel so you don't miss what we have coming up next. We will see you guys next time.
I didn't realize he's a trader at S&P Capital.
Thank you.
He's an actual prop.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at Tasty Live, joined by who I think is perhaps only our second repeat guest here on the show. Rick Rule is once again with us. He's the founder and CEO of Rule Investment Media. Rick, welcome back.
Pleasure to be back with you. Thank you.
Rick, I've saved all kinds of hard questions for you since our last conversation, and I wanted to go right to the dollar and gold, which we explained last time, how it has been that since the beginning of this war in Iran, we've had, of course, an inflation scare, and against that backdrop, interest rates have come up, and so contrary to what people might have thought, episodically, the dollar is up because there's been a reach for liquidity and higher rates, and gold is down because things have sold it to gain that liquidity and gain exposure to those rates. I want to keep that conversation going. Obviously, this inflation scare is now impacting the broad range of markets. We're seeing it in stocks. We're seeing it in all manner of asset classes. And I wanted to see if in your mind this is an input into the larger gold conversation. Obviously, people have looked at gold as something of a value hedge against fiat currencies being hampered by tremendous levels of debt across most large governments, not just the US, certainly, and not just Europe, certainly. And so I wonder if this kind of inflation in your mind, in that it inflates the debt away to some extent, if that hurts the long-term case or changes the long-term case in any way for gold and precious metals and kind of physical value as a counter to fiat in general?
I think a study of history would suggest that fear of the decline, or in certain cases the decimation, of purchasing power held in fiat instruments has been responsible for most gold moves over the last 1,000 years. People attribute all kinds of attributes to gold. What one finds is that, as an example, other forms of fear, war, political unrest, things like that, have a near-term impact on gold, but they seem to have a negligible long-term impact on gold, except sometimes for participants like refugees, the Jewish community, the Vietnamese community. Those people had a different use for gold. It wasn't speculative, it wasn't investment, it was survival. But for most people, in less dire circumstance, the primary motivation for gold is to shield one's savings from the depreciation in the purchasing power of the currency. It's important to note, as a student of fairly recent history, that is to say my lifetime, that reaction to inflation takes place over longer periods of time. As a very young man, I began to notice and become interested in inflation literally in high school. In 1968, I began reading what are now regarded as Austrian economics or hard money books. And I would suggest to you that although inflation was a topic on people's minds, that the investing public didn't really begin to react to incipient inflation till 1972. In other words, there was a hiatus between the point in time when academics and politicians described inflation and the time that people began to react to it. During that 5-year period, as an example, a hamburger at McDonald's went from 20 cents to $1. By the next year, with the Arab oil embargo, the price of gasoline went from 25 cents to $1. In 1968, 1969, 1970, despite the fact that we were undergoing inflation, investors' expectations of the future were set by their experience in the immediate past. And the 1950s and 1960s have been very good times. People were extremely optimistic. You're probably too young, but your older listeners will remember things like the Nifty 50, which is to say high growth stocks that did extraordinarily well. When your anticipation of the future is set by your experience in the past, and your experience in the past 2 decades is rosy, you don't react to negative stimulus as well. So it took probably 5 years for the population to react to incipient inflation. And I think the same circumstance is happening today. Exactly the same circumstance. We have lived through what I believe is the most benign economic climate in human history in the period 1982 to 2022. People's expectation of the future is set by their experience in the past, by the dips. Believe government inflation numbers like the CPI. If you believe in the CPI and you believe that the destruction of your purchasing power is clipping along at 2.5 or 2.6%, then current interest rates seem very adequate. You know, the 10 years yielding 4.4. You're getting over 100 basis points in real yield if you happen to believe in the CPI. My problem is I don't. I believe that the CPI is better characterized by Mike Maloney as the CP lie. I believe that the deterioration in the purchasing power of the U.S. dollar, marked by the basket of goods and services that I consume, suggests that the destruction of my purchasing power is proceeding along at an 8 or 9 or 10% clip. That presents a very different picture. If you're making 4.4 in a currency that's losing value at, say, 9, you aren't making 4.4. You're losing 4.5. It is when that realization becomes more widespread that gold really performs. Gold is viewed by many people right now after a 50-year hiatus as an investment class or a speculative class. I would argue that 1,000 years of human history teaches us that gold is a liquidity class or an insurance class. And right now, people don't feel the need for insurance. My suspicion is, unfortunately, that that feeling will change.
Well, I think you make a very clear distinction there, and it echoes what we talked about last time as well, that when we say that the dollar is set to underperform, we're not talking about underperforming against other fiat currencies. No. We're talking about underperformance against hard assets, and fiat currencies as a grouping underperforming against hard assets. And typically that conversation is presented as, oh, well, governments will try to inflate away this debt, but we don't need them to try. We have the inflation here. And so I think the next kind of natural question is, well, gold is having a bit of a hangover here after an incredible rally last year. One thing you've talked about recently that hasn't been caught up in this macro narrative is uranium as another kind of vehicle for sort of expressing a view on physical assets and the kind of value storage that is. Break that down. What's the conversation with uranium?
Well, I need to start by saying in most commodities, the easy money has been made. The easy money occurs when a commodity goes from being hated. It doesn't need to go to being loved. It just needs to go to being unhated. When uranium was at $20 a pound, although it took the industry $40 a pound to make it, so the price had to go up, it was a hated commodity. The move from $20 a pound to $85 a pound means that the easy money in uranium has been made. It also means, however, I think looking forward, that the sure money is in front of us. Why do I say that? Well, for several reasons. The most obvious reasons is that the world needs more power of all kinds. All kinds. Global power demands, global energy demands are set to double by 2050, and we don't have the capacity to produce that much energy. We just don't have that much. Energy will be rationed by price. Nuclear power is extraordinarily reliable baseload power, and importantly, in today's political discussion, it's baseload power that doesn't generate carbon. It isn't the same as burning coal and burning oil. Uranium has, in 5 short years, gone from being a pariah to being a politically correct commodity, which amuses me greatly, frankly. The thing that's really changed with uranium, though, Ilya, was and is the conflict in the Gulf. It has been 50 years since the world cared about energy security. If you dial all the way back to 1973 and the Arab oil embargo, that form of energy insecurity stimulated, as an example, the French to build what is now the 4th largest nuclear fleet in the world. It stimulated the Japanese to build the 3rd largest nuclear fleet in the world. The impetus for that was energy security. Energy security ceased to be a concern for 50 years, but is suddenly a very relevant concern. Uranium is the only fuel on Earth that has enough energy density that the Japanese, as an example, could, if they had sufficient reactor capacity, store enough uranium to power the entire country for 5 years in one uranium storage facility. You can't store that much oil or that much coal or that much natural gas. You can't build that big a battery. The only material that can give energy short nations, Korea, Japan, China for that matter, Taiwan, Singapore, energy security is nuclear. The only one. And the big thinkers of the world are beginning to come to understand that. And I think ordinary citizens are beginning to understand it too. That's very important. We are right now producing less uranium than we consume. And 2 things are impacting demand. One is that the Japanese are now speeding up in earnest the restart of the plants that were closed as a consequence of Fukushima. This isn't demand that's going to occur 10 years from now. This is demand that's going to occur 10 months from now. A very different circumstance with regards to pricing. It also is part of a broader trend to nuclear plant construction. Even nations that forswore nuclear, in particular Germany and the United States, are learning that if they are to fund their existing economies, never mind data centers, that they need reliable, inexpensive baseload power, and their voters would prefer that power to be non-carbon generating. I would suggest that the biggest unsung beneficiary, if there is ever beneficiaries of a war, would be uranium with regards to the Gulf conflict. People think of oil, they think of gas, they think of nitrogen, nitrogenous fertilizer, sulfur, helium, all things that move through the Straits of Hormuz. They don't think about the geopolitical attractiveness of a form of energy that gives a country energy security. And there is no other form of energy that gives a country energy security.
Well, I think that's a really important insight here. It's sort of the next step in the conversation where you say, okay, well, today it's a story about a bottleneck, but a year from now, 2 years from now, 3 years from now, there will be some kind of resolution of this bottleneck this way or that, but countries will have learned that they live in a different world now. I think you made the point last time we spoke that the 40 years that were there sort of through the Volcker disinflation almost right up to COVID is a very different period than what we're entering now. Certainly deglobalization and inflation and thinking about kind of the disillusion of U.S. enforced norms would suggest that countries need to start thinking about things like energy security in these kinds of terms. In expressing a view on uranium, because I think, obviously with gold, it's easy. There's any number of ways you can gain exposure, from physical to ETFs to futures. Same thing for silver. What's the vehicle for exposure to uranium in your mind?
There are several. I think for most people, the lowest risk exposure to uranium is to buy something called the Sprott Physical Uranium Trust. Note here conflicts of interest. I'm the largest shareholder of the manager. I'm not an officer. I'm not a director. I'm not an employee. I'm just a beneficiary. The Sprott Physical Uranium Trust is a deposit receipt representing physical ownership of uranium at 4 facilities worldwide. Uranium is one of those commodities that one is well advised not to try to buy and store at home for fairly obvious reasons. So the best form of physical ownership is in fact certificated ownership, and by far the most liquid of those vehicles is the Sprott Physical Trust. If someone wants to take a bit of operational risk, I would suggest that the highest quality uranium producer in the world is the Canadian domiciled Cameco, the symbol CCJ on the New York Stock Exchange and the Toronto Stock Exchange for your Canadian listeners. Highly liquid, really a full cycle uranium shop, all the way from producing uranium to enriching uranium to, by now in its engineering group, building uranium mines and processing facilities for others and generating power. The third that people might want to look at is Kazatomprom, which is the largest uranium producer in the world, formerly a large position of mine. I've sold my stock because of middle management defections. Middle management defections that I didn't understand. And I have a hard and fast rule. If there's a risk I don't understand, I sell the stock. There are also a range of uranium speculations, but I'd prefer not to talk to your viewers about those. They require a lot of work to be a responsible holder. And I've found with 50 years of experience that many audiences love the name but aren't prepared to do the work to prepare themselves to own the name. So we're going to leave the speculative ones aside, I think.
And that is perfect. How do you feel about an ETF like URA and sort of ETF type exposure?
For a lot of people, it's probably appropriate. I'm old school. The idea that somebody, including my former employer, Sprott, constructs an index that has probably 50% of the stocks in it being stocks I wouldn't otherwise own. The idea that I have to pay somebody a fee to construct a portfolio that I normally wouldn't own for free is problematic to me. I realize that most of your listeners have lives. They have kids or grandkids. They like to garden. They like to read. They like to do things with their life other than study uranium juniors. And for them, the ETF is probably appropriate, if inelegant.
And there we have it, folks. Rick, I have, of course, 1,000 more questions for you, but we're just going to have you back to get to those. Tell the good folks where they can get more from you.
I'll give them incentive. Anybody who cares what I have to say about natural resources and wants to personalize it, including, by the way, uranium juniors, can go to my website, ruralinvestmentmedia.com. There, if you list the natural resource stocks that you own, I will personally review that portfolio and rank it 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments have any value. Please, as a sidebar, I know yours is a trading community, no crypto, no tech stocks, natural resource stocks only. The other thing I would suggest to your audience is if you care about natural resources, a conference, which I personally believe is the finest natural resource conference on the planet, takes place July 6 through 10. Not surprisingly, it's called the RULE, Natural Resources Investment Symposium. If you go to rulesymposium.com, you can learn more. The physical conference is sold out, but you can, if you wish, attend the conference from the comfort and convenience of your own home via live stream, rulesymposium.com. By the way, ours is the only conference I know of, live or otherwise, that has an unconditional money-back guarantee. If you attend the conference and think for any reason whatsoever, you being the sole judge, that we didn't deliver full value for your money, email me. I'll give you your money back. Nobody else I know in investor education maintains ironclad money-back guarantee. We've done it for 30 years now. I'm delighted to say we've had to refund about 0.1% of the tuitions that we've charged over 30 years, but that guarantee is your guarantee that we're confident our content at rulesymposium.com can make you money.
And there you have it, folks. If that doesn't explain why Rick is here explaining things to us, well, go check that stuff out and you'll find out too. Thank you, Rick.
Always a pleasure, Eli. Thank you.
Welcome back to Signal versus Noise, where we take a look at the options tape and ask the question, is there any unusual activity that's worth discussing and maybe even trading around? Today's names are two trades, both hitting close to the close yesterday, but with very different messages. The first one is Tesla, ticker TSLA, which is tied directly to the SpaceX IPO, set to open around 175 perhaps here. That has not yet started trading at the time of this recording. The second ticker is Meta, which may be the AI name that the market has not yet fully repriced. But let's start with Tesla here, currently trading at $394 a share. Someone bought the Tesla June 18th 432.5 call, 6 days to expiration. Tesla was trading around $399 when the trade hit. The strike was about 8% out of the money. Premium was $3.31 million, and the volume was 14,263 contracts. The open interest jumped by 5,389 contracts in a single session. That's a 202% increase. So this is not a quiet repositioning. It's not someone taking a little dip of a toe into the water. This is a big call sweep done into the close 1 day ahead of the SpaceX IPO. And that timing tells you a lot about the trader's intentions here. SpaceX is being listed today under the ticker SPCX. The IPO price is $135 a share. Reporting ahead of time says it may trade closer to 171, 175 around the open, which would be roughly 27 to 30% above that IPO price. And in doing so, the company would be raising, well, that $75 billion that it was seeking, making it the largest IPO ever. The demand behind the scenes is reportedly $350 billion. The book is about 4.5 times oversubscribed. No wonder we're looking at a potential pop at the IPO, at the open. So it's not just another trade here, right? Tesla is coming in the context of this Musk halo effect. Tesla owns SpaceX exposure through its AI conversion, the XAI conversion, with the FTC approved on March 11th. So if SpaceX rips on the debut, the Musk halo effect can spill directly over into these Tesla shares. That is your bull case here. SpaceX opens strong. The retail demand is enormous against a tiny float, roughly 3 to 4% of the shares, and traders start treating Tesla as part of the broader Elon Musk ecosystem once more. The call buyer is making a bet here that a successful SpaceX debut lifts Tesla quickly. It's going to happen within the 6-day expiration window. There's no time for a slow-moving story. This is a bet that things will work out well, and they're going to work out well very, very quickly. There is a little bit more of a piece here, the institutional side. JP Morgan just upgraded its Tesla coverage from underweight to neutral and raised its target from 445 to 475, excuse me. But that's a massive reset from a major bank right before the SpaceX IPO. And the target is now sitting above the call strike in this sweep here. So the tape is giving us the trade. We have a catalyst right now, and we have a sell side upgrade all at once. Now, the risk here is obvious, perhaps. For those that were following the SpaceX IPO roadshow, there were some detractors that popped up along the way. Morningstar, which is seen as a fairly neutral rating agency, said that the fair value for SpaceX is closer to $63 per share. So if it comes in at 71, 71, there's a massive gap between enthusiasm and perhaps fundamental value. But it's an Elon Musk company. Jim Cramer pointed out that SpaceX could soar to unsustainable levels after the debut, which may be a pretty honest description. The float being only 3 to 4% matters a lot here. The founder lockup being 366 days matters a lot here. The index rules, particularly for the NASDAQ, could start to force passive buying within the next 15 days. This structure might make for a massive first day move, and it can create a market where price gets distorted fairly quickly, especially through second order effects like Tesla as a proxy bet on SpaceX itself. So while the SpaceX play here through a Tesla call sweep is fairly clean, it is the halo effect trade. If the IPO opens up strong, if Musk market goes full Musk again, then Tesla's going to catch a fast bet. If the SpaceX absorbs capital away from Tesla, the halo effect may just become competition. But right now, all signs are pointing in the right direction. So maybe there's some signal within this particular trade. There is another trade, though, and that goes through Meta. There were two Meta call trades that went across our screen here. The first, August 21st, 6:30 call, 70 days to expiration. The stock trading around 560 at the time. The strike is 11% out of the money. The premium is about 4.09 million spread across 2,066 contracts. And then you have the July 31st 640 calls that hit the tape here. The strike's about 13% out of the money. The premium 1.14 million spent across 854 contracts. The open interest on that line was 0 before this trade, and now everything that you see here is entirely new positioning. So the combined bet is about 5.23 million in bullish Meta calls. And unlike Tesla, there's no real IPO halo trade effect going on here. This is a simple, the market has misunderstood Meta's business model. It is undervalued. This is a re-rating trade, which may be a little bit less speculative, as it were. Meta trading around 568 is about 29% below its all-time highs established near 796. Meanwhile, the business is still printing the enormous numbers that you would think would be accretive to higher share prices. Q1 revenue is $55.5 billion, 20% higher year over year. That beat by roughly $900 million. Operating margin is 41%. Cash levels, $81 billion. The AI numbers are starting to perk up too. Meta has 1 billion monthly active users. Llama has 1.2 billion downloads right now. Even Threads, which I'm not a Threads user, it still has 450 million active users on a single monthly basis, which has actually surpassed X. That was surprising for me to learn. Ray-Ban Meta sold 7 million pairs in 2025, up from the 2 million total in 23 and 24 combined. WhatsApp business messaging is now up 74%. So right now we have an interesting setup here. It's the AI infrastructure companies, the ones that are selling the shovels that are being rewarded. Those that are buying the shovels, the service layer on top of it all, they've been punished because it's costing a lot of money to actually build the build out. But consider it right now. Meta has one of the largest AI distribution networks in the entire world, and the market does not talk about it as it does in the same way as an NVIDIA, Marvell, or even a Google, because it's not a hardware company just yet. Meta is an AI company that no one is actually calling an AI company here. And yeah, they deserve to be dunked on after the metaverse and all. But this is perhaps what the call buyer's seeing. They're seeing the future where we start moving away from the bottleneck and we start looking at the actual applications. This is a company with over $200 billion in revenue, 41% operating margins, more than 1 billion AI users, and the stock is still 29% below its highs. The trade that we're seeing here in Meta is a bet that we're not going to get back to those highs, but we can make a significant leap towards there over this next, say, 70-day window, 49 to 71-day window here. And that's where the signal versus noise trade today gets interesting. The Tesla side of this, prospect of trades here, these are event-driven trades. These are binary event risk trades. They are hoping for SpaceX to come in with a bang, that the largest IPO in history lights up the board and the Musk halo effect continues to work its magic. But the meta signal is that there's going to be a shift in the theme around AI, that the market is going to get past this recent bottleneck phase around memory chips, and we'll call it hardware with Dell and Hewlett-Packard performing fairly strong in recent sessions. We see there's a little bit of a divergence right now in the expression here, but both may be true. I'm curious how the chat is handling the SpaceX IPO. Our very own Tim Knight tried getting in for 1,000 shares, was only allocated, I believe, 24. Were you successful in getting on in SpaceX? Let us know below. This has been another episode of Signal versus Noise. You've been watching Tasty Live. Like and subscribe for more videos. Welcome back to Signal versus Noise, where we take a look at unusual activity on the options tape and ask the question, is there something real going on here, or are people just speculating? You know, Jamal, today's episode, we're going to go with a little bit of a twist on that framing. Sometimes when someone says you should sell your kidneys before you sell your Bitcoin, and then they go and sell the Bitcoin before they sell their kidneys, it makes you wonder about the kind of conviction that's remaining in the market. And that's bringing us to MicroStrategy and Michael Saylor today, because Michael Saylor, the man who said, sell your kidneys, he's still walking around with two of them, as it were. At least that's as far as I know here on this Thursday, June 4th. Before people start throwing tomatoes at the screen for my tacky jokes, let's consider how much they've sold here. 32. Oh, no, that's right. 32, not 32,000. They only sold 32 Bitcoin, roughly $2.5 million worth between May 26th and May 31st. So, okay. The size doesn't matter here. This is a bit of a narrative break, if you will. Bitcoin's been getting hammered this week. What's going on here?
Look, this is really kind of more about what's going on with Bitcoin and what it's turning into. I mean, it used to be this never say die product that you just held on to for life, right? And now it's become more like a treasury asset, it would seem. And the real big story here, Chris, is what did they sell for, right? And in this case, they sold to satisfy some obligations. So I think that's the real thing about it. It's not the size, it's what did they sell for? And this is something we're going to continue to see in the future. And so as a result, obviously the stock is taking a huge hit. I mean, it's taken a huge hit over the last year and change anyway, but it's even taken more of a hit more recently as a result of this news. And we've seen some options activity. We've seen, I think of all of them, the most interesting is further out, but there's some options activity that went down in the June 18th expiration. They bought the 131 puts. And again, honestly, open interest didn't change a whole lot on many of these trades, but nevertheless, they bought some options in the June 18th expiration. They bought some nearer term options in the June 12th expiration, bought the 128 puts. So both of those are around strike. But then, Chris, the big trade that happened was further out in October expiration on the 50 strike. The 50 strike. I mean, you can see the stock is trading $131 right now. They bought on the 50 strike, and that I think is the one that stands out the most. But nevertheless, I mean, this is just more of a story of once upon a time, there was no chance you would expect Michael Saylor and MicroStrategy to be selling Bitcoin, and now they're selling to satisfy some obligations. And that, I think, makes people just a little bit nervous.
Strategy discloses that it sells its 32 Bitcoin at a price of roughly $77,000. And Jamal, I just want to put this in perspective here. That's absolutely microscopic. MicroStrategy owns roughly 843,000 Bitcoin. So selling a handful of them, 32 is about 38%, 0.0038% of their whole total holdings. That's, again, not anything. But there's a change in behavior. Saylor's been the flag bearer for Bitcoin accumulation over how many years now? He changed his verbiage recently where he called MicroStrategy a net accumulator moving forward. For every one Bitcoin that they sell, they're going to try to purchase 9 or 10. But that's a very different type of mindset and level of conviction than never sell or sell kidneys before you sell. And the market's starting to take notice of that right now. It's just a more bad news than what's been a pretty long crypto winter here. But I think perhaps the change that we most care about as tasty traders, volatility has finally come back into the space. There's been a rapid expansion of volatility, which is pushing around these option prices in recent sessions.
Well, there was sort of this romantic idea in a way, right? It's almost like what we experienced for the last, what seemingly 100 years with Warren Buffett. I mean, this idea that you're buying something and you're holding on to it forever. And I think as much as people have loved to make fun of Michael Saylor, they appreciated that idea that you're going to buy something and hold on forever, no matter what. And now I think it almost seems more like that MicroStrategy is becoming more like a managed Bitcoin fund, if anything. And maybe this is going to be something, albeit not all the time, that we see every so often that they sell for various different reasons, because that's kind of how funds work from time to time.
And you're right. MicroStrategy is effectively a leveraged Bitcoin company. They've spent about $64 billion accumulating Bitcoin. That's worth roughly $53 billion mark to market. So that's an $11 billion deficit right now. And when you think about the preferred dividends, the financial obligations, and the capital market dependence to keep the whole game going, you're really starting to stand on stilts here. So the liabilities, once they're factored into this equation, the never sell mantra that Michael Saylor has held, it runs into the gravity of the cash flow obligations that they have to the outside world. So Jamal, I'm curious what the audience thinks here. Is this signal? Is this noise? Is MicroStrategy a time of, a sign of the times? Is this the end of it all for Bitcoin as we dip below 65K? Let us know in the comments below. Thanks for watching Tasty Live. Like and subscribe for more videos.
What's up, everyone? Mike here from Tasty Live, and we're coming at you with another episode of Options in Action. If you've missed this series, it's basically a new series where I take an old whiteboard concept or maybe a strategy that I talked about previously and bring it into an advanced light. We take a look at the platform and we talk through the practical application of some of these concepts. We're going to go through the entire YouTube playlist, the old whiteboard series. So we have talked about call options, put options. We've talked about premium. We've talked about strike prices and expirations, you name it. And today we're talking about the age-old question: can you make more money trading short premium, or can you make more money trading long premium? And what are the gimmies and gotchas, as Dr. Jim says? What are the trade-offs with selling premium versus buying premium? We're going to take a look today, and we'll break it down on this edition of Options in Action. So we got this SPX chart pulled up here, and this is not the SPX stock or index chart. It is actually a chart of a long call out in December, the 8,300 strike to be specific. You can see here SPX at the top is trading at 7,300. So we're looking at this call option 1,000 points out of the money to the upside. And this is the December cycle. So before we dive into this and before I start spewing nonsense, I just wanted to say, when you're selling premium, there's a difference between selling premium in the S&P 500 products like SPX or MES or XSP or SPY. There's a big difference between selling premium in those sorts of products versus selling premium in the equity space, right? S&P 500 or other indices, even products like SMH that have moved quite aggressively with the tech sector popping off and selling off at the same time, there's things to consider, right? Short premium in the S&P 500, I've said this before, I think if you can trade successfully short premium on both sides of a market in an equity, you can definitely do that in the S&P 500 simply because the S&P 500 moves less. It doesn't have the same binary events. It doesn't have the same binary nature of equities. You could have a CEO step down and the stock price be down 20% pre-market or after the market closes, or the opposite can happen. They can announce something that the market likes, and that stock is up or down 20% when the options market is closed. it's not necessarily going to happen in the S&P 500. There's also market stops. Even if there is a big crash in the S&P, there's certain levels where the market stops trading. That doesn't necessarily help you in the case of not taking on risk when it comes to short premium. If we're talking like short puts, for example, into a market move like this, or even strangles. But what I will say is, over the years, I've learned that there's a time and place for all strategies, right? I have long premium strategies where I'm buying options. It's a lower probability trade if you're holding trades to expiration. But I like to say, if you're buying options, you get what you pay for. I don't really buy options that are near term. I don't buy 0-day options. I don't buy 7-day options. In my mind, you're buying a lot of implied volatility in those cases, and it becomes just that much harder to be profitable on those strategies because you have this super decaying asset that is, if it moves against you directionally, it's basically going to become worthless, and it becomes that much harder for it to reverse and work in your favor. If you're buying a leap option, though, totally different story. Leap options cost a lot of money. You get what you pay for when it comes to long premium. But I think when you're buying premium, it doesn't necessarily have to be a naked option. It can be. I actually have a position on in Nike right now. I bought a leap option out at the 60 strike, all the way out almost 600 days away, January of 2028. So this was a situation where, Nike drops to multi-year lows. We're talking decade lows. This Nike hasn't been 45, at least around this price point, since 2015, if I'm not mistaken. So the further a price falls, especially in a product like Nike, where I think we'll still see some upside potential there, yes, I could sell a put to collect that premium. But at the same time, Nike's already fallen, and it's still down at 40. If I sell a put 16 days away for $100, sure, I could sell that. It's a higher probability trade. You can see my probability of profit is nice and high at 66%. But I take on the undefined risk nature of Nike, where maybe they announce something, the stock's not down another 10 points, and now all of a sudden I have a $900 loss on my hands and not much management in terms of what I can do. It also takes a decent amount of buying power, $800 relative to a $40 stock. So for me, instead of selling a put, especially when a product like Nike or any other equity gets to multi-year lows or decade lows, I'd rather just inventory some long-term premium. And you can see here, the further out in time you go, because you're avoiding the implied volatility increase of something like an earnings announcement, something I mentioned earlier, you've got plenty of implied volatility here in the near-term cycles that isn't necessarily reflective of these long-term cycles, right? Look at this expected move for June 30th. You have a plus minus $4.60 implied move with a 60% IV almost, but you look at January of 2028 and it's only a 17-point implied move, and that's because the implied volatility is significantly lower when you get all the way out here on the curve. So will I be trading Nike? Will I be selling premium in Nike around the earnings announcement in a defined risk way? Absolutely. Like I said, there's a time and place for everything. I think for Nike with the upcoming earnings, I'll probably sell something in this 22-day cycle, but I'm going to buy something in July or August. I likely will go to something like a diagonal spread or calendar spread in that sense, because I still want to trade intelligently. I still want to reduce cost basis, which has always been something that we've said here on Tasty Live. I want to make sure that I am reducing my cost basis and improving my probability of success anywhere I can. So in this case, if Nike's offering super high premium to sell something against even a long option I'm buying, whether it be a calendar spread or diagonal spread, we can look at this here, like the 45 strike in July, trading for $2.50, we'll call it. The 45 strike in July 2nd, look at that. You have 2 weeks of a difference in time, but only a 40-cent difference in the option prices. I'm absolutely going to be selling something against that long option that I buy if I'm bullish, and same thing if I'm bearish. But longer term, Nike's down to 10-year lows. So what does that mean? It means I'm going to get really far out on the curve here and risk $500. This option hasn't really moved all that much, which is interesting. Nike's still chopped around, and this 2-year leap basically is trading for $500. My whole thesis is, would I be surprised to see Nike go from 45 back up to 50 or 55 or 60? it was just there a couple months ago. So my answer is no, I would not be surprised. And if I'm buying a leap option that has much lower implied volatility, I know, yes, it's a little bit more costly, but I'm out of the IV spike in the near term. I'm inventorying long-term delta, inventorying premium that isn't going to decay against me all that much. And if we get a move in Nike from 45 to 50 or 55 or 60, that option is going to be worth $1,000, $1,500. And we can see this here. If I right click on the option in the chart, the 60 strike, if you right click on the bid or ask, you can have this menu pop up here. View the option in the chart, and here we go. It's been trading for $500 basically ever since I bought it. But back here, when Nike was at 55 and 60, this option was trading for $1,500. So from a risk reward standpoint, as a product like Nike or any other equity gets to decade lows or multi-year lows, I'm going to be inclined to lean into the long-term positioning. I did the same thing in Microsoft, right? Microsoft went from 550 down to sub 400 levels. What did I do? I was buying into some near-term stuff. We set up some short premium trades, of course, but I also did a really long-term calendar spread at the 500 strike. I bought January of 2027 and sold September of this year, and that was like a $500 trade. I was just like, well, I don't know what's going to happen in the near term, but I do feel like over the course of the year, Microsoft's going to be higher than where it is now. And that ended up being the case. We saw a nice bid, got all the way up to 460. And just looking at the order chains here, you can see I've had some decent trades up until that point. And the only trade I have left is that calendar spread in Microsoft. And it's up a couple $100 right now. If we look at the 500 strike, I bought it for $500. It's up $400 right now. So I still want to have it on. I think there's a bullish case for it. But to answer the question, selling premium versus long premium, I think when you're selling premium, you have to be able to withstand all variance within that product you're selling, right? Because from my perspective, the most success that I've had in products where I've sold premium, it's been in products where I've traded small enough or the product size was small enough to where I could manipulate the strikes, manipulate my time and expiration, or a combination of both, right? That's the beauty of undefined risk. You have the flexibility to be like, you know what? I'm done with this strike. I'm done with this expiration. I'm going to buy this back and I'm going to move it out a month. I'm going to move it out 2 months and move my strike and collect a credit still. So that is how I approach undefined risk these days. It's going to be a much higher probability of success naturally, because when you're selling premium versus buying premium, if you sell an option, you just need the stock price to stay out of the money, or in this case, above your 37.5 put. If you're buying premium, you need a directional move in the stock price, and that's as simple as that. So when you think about that, if I'm selling premium and I just need my strike to be out of the money, I'm going to be much more inclined to sell near-term premium because I know that implied volatility is higher. There's not enough time, or there's not as much time for the product to move against me in a big way. It can still happen, of course, but that 30 to 60 day window is where the implied volatility is nice and high relative to a nice blend of time value as well. So that's why we are selling premium in that window. We have research that shows that that's kind of the sweet spot of implied volatility value plus time value. So selling premium in that 30 to 60 day window. Buying premium, I prefer to be outside of that 60-day window. Honestly, I would rather buy premium in a 90-day, 100-day option cycle if it's something I can afford. In the case of Nike, I can do that in a 25K, 30K account, of course. Even smaller, you have the ability to do it because the stock price is so low. But in something like SPX, $7,300 stock price, I don't have the ability to sell premium in here. I can trade spreads in here. I can do calendar spreads, some diagonal spreads in here. But sometimes the stock price is the determining factor of your strategy. So keep all this in mind and just really make sure if you're selling premium, you need to be able to withstand the variance of any kind of move. I prefer to, if I'm selling a put or a strangle, let's talk about puts. If I'm selling a put, I would rather sell it in a product where I can just hold that premium or take the shares. I would rather not exit at 2 or 3 times the loss of that short put, because if I'm selling an undefined risk put, I kind of want to have that bullish delta anyways if it does get down there. I don't want to be stopping myself out and then 2 weeks later see that it could have moved out of the money. So that's just me. But to summarize, if you're buying options, you get what you pay for. I think in this kind of market environment, I'm always going to have something against it. Like if I'm buying a 60-day option, I want to be selling something in the 30-day cycle or maybe the weekly cycle against it. If there's an earnings announcement where that premium is really juicy and I can reduce the cost basis on my long option, because the more you can reduce the cost basis on your long option, the more flexibility you have going forward to have that long option be profitable or even a scratch. If I'm selling premium, I'm very cognizant of the fact that it is a higher probability trade. You're going to have a lot of winners when you're selling premium, but you should also understand how to manipulate that trade. With defined risk debit trades, when you're buying premium, there's not a lot of things you can do. There are certain things like with calendar spreads and diagonal spreads where you can manipulate that short option by moving the strike or moving it out in time. But with short premium, undefined risk short premium specifically, you can do a lot of different things. You have a ton of flexibility in the ability to manipulate strikes. And if you look at my order chains for the MES position, this is my year-long strategy for 2026. I've clearly manipulated this position over and over and over. And every single time I do it, I collect more credit. I started with 93 points in credit. I now have 700 points in credit overall, which means my break-evens are 700 points beyond my strikes. And this is a profitable trade because I've been selling premium to offset any kind of intrinsic value losses that might show against me. So short premium, I like to reserve it for either products that I can afford any variance in or something in like an index, like MES is a great example, or IBIT even, the Bitcoin ETF. That was my year-long trade from last year. So I think when you compartmentalize these things, it puts you in a good spot to be able to withstand variance. And again, if you have a day like today and you're like, my account is really suffering, then I think your trade size might be off. I think maybe the strategic decisions might be a little bit off. Again, we want to be able to withstand as much variance as possible. With undefined risk, I think it's got to be any variance. The trade size has to be small enough to where you can withstand any variance. It just sets you up for success in the future, and it gives you that flexibility to manipulate the trade as the markets move. And with defined risk, same story. I like to keep them within $500 to $1,000. I think that's a healthy level for me. But again, if I'm doing a diagonal spread or calendar spread, I have a plan for if things go wrong. I know I can move that short strike out in time. I know I can move that short strike up or down depending on the strategy. But yeah, let me know what you think in the comments below. That was a long-winded segment. Wasn't expecting to go that long, but hopefully that kind of mental shift helps a little bit. Again, if I'm selling undefined risk premium, it's usually in an index product or a micro futures product, and it's sector based. It's not something that's going to move 20% pre or post market. But if I am involving myself in those types of products, it's going to be in a product size that is small enough to where I can withstand any variance. I can manipulate the strikes up and down. And I think that's another interesting and important point is undefined risk trading, super high probability if you're doing out of the money sales of options, but understand what you can do to manipulate that risk profile. And that's just going to give you another leg up in the future of trading as the markets move and things go wrong for you. I mean, you're going to have your winners, you're going to have your losers, but you got to know how to manipulate and adjust those losers if they are undefined risk trades. But thanks for tuning in. Let me know what you think in the comments below. Please like this video, subscribe to the tastylive channel, and we'll see you on the next episode of Options in Action. What's up, everyone? Mike here from tastylive with another episode of Options in Action. If you've missed the previous episodes, this is a series where I'm talking about old whiteboard videos where we're looking at concepts and strategies, but we're giving it more of an advanced twang, and we're looking at the platform itself, talking about certain concepts that I'm using today and how it applies to everyday trading. We talked about expirations last time, and today I wanted to talk about letting an option expire in the money and ultimately taking shares of stock. Also, we can talk about expiration risk and assignment risk and how it's not something that I'm worried about at all. I think we can wrap those up into one and kind of just give you a nice package of ways to think about expiration and why not to be afraid of assignment risk, especially if you have defined risk spreads or an in-the-money short put or in-the-money short call, something like that. So let's dive into the tastytrade platform and we'll break it down for you. So we're looking at SPY right now. As you can see, SPY has had a massive rally from the lows of this year. In April, we were all the way down at 635-ish. Now we're sitting at 755. Just an insane run to the upside. And maybe that has resulted in the money options. So for those that don't know yet, if you have an in the money option, it's ultimately going to expire and turn into shares of stock. So if I have a 760 put, for example, that is in the money, I will ultimately be assigned 100 shares of SPY at 760. Same thing with the opposite side. If I have an in the money call, a short option that's in the money, and it is assigned or it expires in the money, I will be basically have 100 short shares of stock at 750. Now, a lot of times we're not really dealing with assignment risk because we're rolling our options positions out in time. And really, assignment risk is highest when you don't have a lot of extrinsic value in your option strike. So even with a 750 call that's in the money, 15 days to go, there's still $600 of extrinsic value that somebody would be giving up to exercise this option and turn it into shares of stock. In other words, they're taking $600 and lighting it on fire. That's why I don't really worry about assignment risk, because it just doesn't happen all too often. I've been trading for over 10 years and I've been assigned maybe 3 times, 4 times maybe. And one of them was a celebration. In this case, it was literally like I had an in the money option that had $200 or so of extrinsic value. And I woke up the next day, I was assigned on it. I got the shares and kept that money, the extrinsic value. I closed the shares and I just resold the option and I basically doubled my credit overnight. So that's another thing. If you are assigned early and there's plenty of extrinsic value associated with your option still, it can actually be a benefit to your position. The only situation where that would not be the case is if you had a dividend that you had to pay. So like with an in-the-money call at 730, for example, let's say SPY had a dividend of $400, there's $288 of extrinsic value here. The counterparty would give up their $280 of extrinsic value to get the $400 dividend. So in that case, it's a net positive for that counterparty. And that is the circumstance where you can get assigned early. Your options can be converted to stock early if there's a dividend where the dividend exceeds the extrinsic value left in the option. But other than that, like you can look at these options here, like this is a 715, 720 option. It's 35 points in the money and it still has $200 of extrinsic value. This is still an option that has a low assignment risk here. So not really worried about options that turn into shares of stock. What I do want to bring up is how it can actually change your risk profile for the better in a lot of cases. So yes, if you have a spread, so like let's say you've got a 755, 750 put spread, right? You're kind of teetering on this short option here. This is a defined risk trade. However, if SPY drops significantly and over time someone exercises this short put, you're still left with the long put here that protects your risk, right? Because a short put converts into 100 shares of stock. A long put represents 100 short shares of stock beyond the strike to the downside. So even if I have a short put spread and I'm assigned 100 shares of stock in SPY, if I can hold that buying power, that's the big caveat. If I can hold that buying power, that would certainly be increased relative to this $300 buying power here for this narrow spread. It actually increases my max profit substantially, potential max profit substantially. And that's because the most I can make from this spread is just the credit I received on entry. However, if SPY drops like a rock and I'm assigned on this short put and I still have this long put, as long as I have the long put, my risk profile doesn't change on that package. But I would now have 100 shares of SPY with a static delta of 100, which means if the market dropped dramatically and I get assigned on the short put, I still have the protective long here. If the market rebounds and now all of a sudden we're back at 755 and beyond, I'm making money on those 100 shares of stock where I wouldn't have been making that money on the shares, because with just this options trade, I can only make the credit received. So another situation where that makes a lot of sense is just like take the shares and just use the shares as a static delta lever is in products that are smaller priced, and maybe you've sold a put and you're trying to roll the put forward. Under Armour stands out to me because I already have 100 shares of Under Armour for this exact reason. But let's say you sold a put in these options expirations. There's not too many here, but let's just say you sold the 7.5 put or like the 10 put. You can see there's very little extrinsic value here. The deltas are super high. And if you were assigned 100 shares of stock in Under Armour, yes, you can only make the amount of the put if you sell this put. And I think that's the big key here. If you're assigned 100 shares, you now have unlimited upside potential on how much you can make if the market does recover to the upside. So the deeper in the money a short put goes, the closer it gets to 100 delta, the less extrinsic value you're going to have. So if you're thinking of rolling a deep in the money put and you're trying to roll it, let's say from July to August or something like that, and you're not picking up a lot of credit, but you have a really high delta on your short put, it actually might make sense to consider taking the shares of stock where you no longer have a option that you can only make as much as the option's worth. You would have 100 shares of stock where you can make a lot more to the upside. So that's pretty much it when it comes to options that expire in the money. I mean, again, I don't really hold things to expiration to risk that. That is one of the things that we should talk about, though. Like if you have a spread that's teetering in the money and out of the money, if you let the spread expire and you're assigned on the short put and your long put goes away, now you don't have the same risk profile. You still have the 100 shares that you're assigned on the 755, but you would no longer have the protective put down here. So something to consider, but deep in the money options that have no extrinsic value, if you take the shares instead, you have a higher max profit going forward, and you have the same risk profile as you did with the deep in the money short put or deep in the money short call. But you now have the static delta in the shares, where a short option that's deep in the money, if it starts to rise towards the at the money price, you can only make the amount of the option itself. So again, deep in the money options, close to 100 delta with no extrinsic value. In almost all cases, your max profit is higher if you just convert the shares, if you're willing to do that. If not, you'd have to manipulate the strategy and change the risk on it by rolling out in time and moving it if you can. But those options that are super far in the money are trading like stock basically anyways. So let me know what you think in the comments below. Please like this video, subscribe to the tastylive channel if you haven't already. But yeah, let me know if you've ever been affected by a short option that had a couple $100s of extrinsic left, not a dividend stock, but like maybe someone made a mistake. Maybe the counterparty made a mistake. They converted to shares. You get to keep that premium. You sold out of it again. It's only happened to me once in 10 years. So hopefully that kind of stuff happens to you guys more often. But let me know what you think in the comments below, and we'll see you on the next episode of Options in Action. DraftKings is down 40% from 2025 highs, but the business keeps improving. Q1 revenue grew 17%, sportsbook margins are expanding, and the new prediction market world is already running at a 3.1 billion annualized volume. Wall Street is overwhelmingly bullish. 29 analysts rate the stock as a strong buy, with targets as high as $52 per share. The World Cup could be the catalyst. Tournament expands from 64 to 104 matches, runs 39 days, and could generate up to $4 billion in U.S. betting handle. DraftKings is expected to process more than $1 billion of wagers alone. The stock is still trading like a company in decline. The question, is the options market pricing the biggest betting event in history, or just the 40% pullback? Let's check it out on today's episode of Options Math Check. So we've got the Tasty Trade platform pulled up here, and the DraftKings chart, as you can see, is looking a little bit better than it has recently. But when we zoom out, we can see this thing has taken a beating here. But I think what's really interesting with DraftKings, and I think that could be really interesting, DraftKings is one of these products where it's like when football season's going. When you listen to their conference calls for earnings announcements, they're talking about the revenue from football season and all these things. The World Cup is obviously a layup for them. They're going to be making a ton of revenue from the transactions alone, from betting. Someone in the office was just like, can I bet on DraftKings for the World Cup? And we're like, of course you can. So I think it's going to be interesting to see how the stock market reacts, specifically with DraftKings alone. But when we dive into the options here, we can see and take a look at the probabilities of being in the money on either side. And we can clearly see that there's an interesting pricing dynamic here when you look at the out of the money strikes relative to the puts and the calls. So I always like to check out just equidistant strikes to see in the near term and also the long term if there's any kind of skew here, and clearly there's a little bit of call skew. We've got a 40 cent option bid on the 25 strike, which is about 5 points out of the money to the downside, but we've got about a 50 cent bid on the upside, 5 points out of the money to the upside at 35. That's in the July cycle, doesn't account for earnings. But if we look at August, which will have the earnings cycle, and we do the same analysis, we've got a 25 strike at $1 and the 35 strike at $1.25 or $1.30. So the market's pricing in the velocity of risk to be to the upside with this call skew. And that's really what call skew is. It's just the options are more expensive compared to equidistant out of the money puts. And that tells us that the market is pricing in velocity of risk to be to the upside if we're going to see a big move. And if we look at the end of the year, December 2026, looking at these same strikes, the 25 strike, 5 points out of the money, trading for about $2.50, and the 35 trading for way more, $1 more, trading for about $3.25. So I think this is super interesting and super telling. Just the fact that the stock has been beaten up, but to the earlier point, you have increasing products, you have increasing revenues, you've got almost every state available in the U.S. For betting markets and prediction markets and whatnot. So I think when you look at all these things and you bring in the fact that we've got the World Cup, we've got football season right around the corner, I think it's only going to be good things for DraftKings. Now, that doesn't necessarily mean that the stock price is going to rally or should rally or will rally, but based on the pricing alone, we've got plenty of call skew here. We looked at 2 different options expirations. So I would say, you know, if we're looking at bullish strategies, at the very least, we can use that call skew either in July or August or even longer term cycles. We can use the call skew to our cost basis reduction advantage by selling that option against something else. So like a call diagonal spread where you've got a short out of the money call further up the options chain, you're collecting more than if you had a bearish strategy on. And the stock's already at 29. It, of course, could go to 0. But if I'm playing for a move to 45 or 50 or 55, at the very least, we've got that call skew to help us out in terms of cost basis reduction. But let me know what you think in the comments below. Please like this video and subscribe to the Tasty Live YouTube channel, and we'll see you on the next episode of Options Math Check. The smart money is getting nervous. Bank of America says 7 of 10 bear market signposts just triggered, the same average seen at every market peak since 1990. The Buffett indicator, which measures the total value of the U.S. stock market as a percentage of GDP, was at 219% as of March 2026, which is 65% above the long-term trend line. Buffett himself said that when it approaches 200%, investors are playing with fire. Hit a record of 228% previously. The Shiller Cape is at 39.8%, only higher once at the .com peak. Kramer flipped cautious Monday night, warning a wave of mega IPOs, including a potential $1 trillion OpenAI deal, could drain liquidity from the rest of the market. Goldman says crowded positioning means when this unwinds, it unwinds fast. The bulls aren't dead. Morgan Stanley sees 8% upside still, and history says the 4th year of a bull market finishes positive. So who's right? A lot of conflicting information here. Let's find out on this edition of Options Math Check. So we got the SPX chart pulled up here, and like we were just mentioning, I mean, what goes up fast might come down fast, and we're kind of seeing that play out here. The E-minis went from 6,300 all the way up to 7,600 in a matter of a month and a half, and just over the past 4 days, we're seeing market moves and intraday moves that are massive here to the downside specifically. E-minis down 1.5% today. NASDAQ down 2.8%, kind of mirroring that big washout we saw on Friday. I think what's really interesting about this market, and maybe a testament to the potential bearish case, is that crude oil, the one thing we've been hanging our hat on time and time again in terms of if we see the market down, we typically see crude oil ripping higher. Crude oil is not moving to the upside. It's actually selling off today. And you parlay that with the fact that when you look at the near-term expirations in these different contracts, this is the most narrow backwardation I've seen in crude oil in quite some time. 87.95 in the front, 86.43 in the back. This thing got as wide as 15 points at the height of the war. So I think with this backwardation going away and crude oil down today, I don't think we can lean on that anymore in terms of finding a reason why the market is selling off today. And I think the fact that crude oil is down and the market is down big is a testament to this being an equity move versus a reaction in global tension. So I think that's really interesting. And when we look at SPX specifically, for the end of the year here, 200 days away, we're seeing some really interesting things play out in terms of implied volatility. We've got a $6,600 price on the 8,300 call, which is 1,000 points above the current market price with a 15% probability of being in the money. You go to the downside 1,000 points, and we've got put skew here, plenty of put skew to the downside now. You've got an option price at 6,300 that is about to eclipse $13,000 with a 21% probability of being in the money. So not only is the probability higher to the downside now, you've got more than twice the amount of premium, or almost exactly twice the amount of premium when it compares to put versus call premium. This wasn't the case about a month ago when the markets were rising higher. You saw similar pricing from the put side to the call side, and we also have to factor in the fact that SPX prices in interest rate premium on the call side. So take that for what you will, but as of right now, we are seeing put skew getting infused into this market, into the sell-off, as you might imagine, pretty sizable sell-off. Probabilities are higher to the downside now, and I think the most interesting thing here is this volatility curve. So when we had the big market rally, we saw volatility creep into the teens. We saw the VIX in the low teens. But now we're seeing the volatility curve flatten out here. Just a few days ago, we had a 2-point contango between the M and the N contract. The M contract currently sits at 2040. The N is at 2115. So it's not even a point of contango now. We are flattening out across the curve. A couple months ago, maybe a couple weeks ago, we had a 5-point contango between the near-term contract and the V contract. Now you can see it's only a 2-point contango. So this entire vol curve is flattening out. You're seeing an 8% increase in the M contract, and the VIX, I think, is the story here. Up 14%, up 3 points, up to 21.5. I think if we see this continue, another red day in the market, down 100 points or 150 points, and the NASDAQ selling off as well, with crude oil selling off, I think you could see this vol curve completely flatten out. Maybe we trickle into backwardation. And I've always said, if the vol market goes into backwardation, that is the gate that opens for a further market sell-off. I'm talking 10, 15, 20% to the downside. Until that happens, though, I'm going to be trying my best to pick my spots here to the upside, staying defined risk. But again, if this vol curve completely flattens out, or if we go into backwardation, I think that might be a sign that we could see a bigger move to the downside. There's lots of warning signs out there, like we mentioned earlier. But again, the vol curve and volatility is my crystal ball in terms of my guiding light and how I position myself. But I've always been placing some downside hedges in SPX, NDX. I actually just closed out of a couple of them today. So make sure that you're accounting for all things. Even if you're bullish, you should still have some bearish hedges on, albeit small. That's how I like to play it. But let me know what you think in the comments below. Please like this video, subscribe to the Tasty Live channel, and we'll see you on the next Options Math Check.
Jim Schultz here for Calculated Risk, and don't forget, before we get started, the best ways that you can help us are by liking the video or subscribing to the channel. Either one of those guys really helps us out a lot. Alright, so earnings season is here, and we all know what that means. Everybody wants in on the action. We're like, you want to get going, I want to get going, we want to trade our favorite stocks, we want to get in on the big names, use our favorite strategies, take our directional shots, and what have you. But we all know that earnings, man, it can go either direction. I mean, these events are binary in nature for a reason. There is most likely going to be a very explosive move in the stock one way or the other. And so when it comes to earnings specifically, a lot of times using a strategy that is defined risk is going to make a lot of sense. I mean, today, I want to walk through my all-time favorite defined risk strategy for earnings, the expected move butterfly. So most of the time as premium sellers, like we're trading time and we're trading volatility. Right, we're selling premium, we're playing time passing, we've got the positive theta, we've got the time decay, we've got all those things working for us. Okay, that's great. We're also trading volatility. We're trading volatility's natural tendency to contract. We're trading volatility's natural kind of grind lower over time. And so these two things are non-directional in nature, and that's typically what we're hanging our hat on as a premium seller. Okay, but every once in a while, we might want to trade direction. Like every once in a while, we might want to take a bullish shot. Every once in a while, we might want to take a bearish shot. And around earnings, one of the metrics that can be really nice to kind of have an objective view of the analysis around that stock or the market at that given time or what have you is the expected move for that cycle. So looking at the expected move, using the expected move for that cycle in that stock can really give you an unbiased look at what the market is pricing in for the upside or the downside. And the really cool thing is we can use the expected move alongside the expected move butterfly to set up a really nice directional shot that's relatively cheap to play earnings and play it to the upside or the downside however we see fit. So let's hop into Tasty Trade now and let's set one of these guys up. All right, so I'm inside of my Tasty Trade platform and I picked a real doozy of a time to do an expected move butterfly around earnings because it's not really earnings season right now. And so if you go to like the Tasty default watch list, I mean, you can look at the all earnings. I was looking at this before the video, and it's like, man, we've got Len. Like Len has earnings today. Never heard of them. Right? We've got Adobe coming up maybe later today or this morning. I guess we could potentially trade Adobe. But you've got Kroger next week and JBL on ACN, and it's like, okay, this is not exactly the season for the heavy hitters. Like if I go into the Tasty default watch list and I sort by earnings just by clicking on the earnings column, you're going to see that, I mean, there aren't really any decent ones coming up that we like to trade on a regular basis until later on in July. And so really, this isn't the best possible time to do a video like this, but we are so far into it now, we can't turn back. So we're going to go ahead and still use the same basic principles of trading and expecting move butterfly like in the front week around a binary event. And so that way you are ready come time July when there are more earnings opportunities. Okay, so let's use Google for the purposes of this example. Now, I may not have done a good job from a calendar standpoint in terms of the best possible time to do a video like this. However, it is a Thursday. So today is a Thursday, and oftentimes using an expected move butterfly, I'm looking to set that guy up in the front week, so using that Friday's expiration. And the reality is this: Thursday into Friday butterflies are really, really nice because with a butterfly, you want to nail the direction of move close to expiration. That's going to allow you to achieve the most profitability out of the strategy. And so by choosing an expected move butterfly on Thursday going into Friday, if you do get the move that you want, you're going to be in a situation to potentially make a decent amount of money in a pretty short amount of time on that following day's opening bell. Whereas if you did a butterfly, the previous week or even like a Monday or a Tuesday going into Friday, it's a little bit more challenging to make significant profits on the strategy because with a butterfly, you want all the extrinsic value to come out of the options. You want all the extrinsic value to drain out of the options, and butterflies oftentimes cling to their extrinsic value until the very end. And so Thursday into Friday butterflies, Wednesday into Friday butterflies using the front week are going to be my favorites. Monday into Friday and Tuesday into Friday, I'll still do them because they do give you more opportunities to make money, but you're not likely going to make that much money. Okay, so if we pretended that Google had earnings tonight, let's say, and I wanted to set up a butterfly to take advantage of that, then what I might do is, let's say I wanted to play Google to the downside. So a lot of times the way that I'm going to set up my butterfly is I want to situate my strike right around where the expected move cuts off. So this copper strip is the expected move for this cycle. So it's only a one-day cycle. The expected move obviously is only plus or minus about $5. And so if I bought a 345 and I sold a 340, and I went ahead and bought a 335 because the butterfly has to be a 1 by 2 by 1. So I go back into the center and I double that guy up. And you can see that is a very, very cheap way to take a directional shot, right? I'm only paying 90 or 91 cents for a $5 wide butterfly. And so again, very cheap way, take your directional shot. If you miss and if you're wrong, and in this case, if Google rallies, then you're only going to lose what you paid. Like you're not going to lose any more than the debit that you pay. And if we were to set this guy up on the call side, you're going to see a very, very similar setup. If I buy a 345, I sell a 350, I buy a 355, I double up on the 350, again, it's 95 cents. It's basically a symmetric market right now with Google being right around 345. And so with us kind of starting at that 345 market, we essentially have the same pricing on both sides of the market. So whether you want to play it down or up, it's effectively going to be the same risk in both trades and the same risk return dynamic. And generally speaking, what I want to do here is I want to size my butterfly such that it fits with my position sizing parameters, right? Remember, with defined risk, we want to be typically 1 to 3% of our account. Now, in this account that I'm trading here, the From Theory to Practice account, this is about a $35,000 account. So this is a very small position relative to my account size. I could easily go up a few more dollars, no problem. But generally speaking, somewhere between 1 to 3%. If you want to live on the lower end, you want to live on the higher end, that's completely up to you, of course. But generally speaking, that's going to be a pretty good range where we can live. Now, the wider you make your butterfly, the easier it's going to be to make money. That is just the truth. But of course, we've heard it before, and here it is again. For every gimme, there's got to be a gotcha. And so if I'm going to widen out my butterfly, then I'm going to have to pay more for that additional width. So for example, if I just stay on the call side here, just to make this a bit simpler, let's say I move my 345 strike down to 342.5, and I move my 355 strike up to 357.5. Look at what happens with to the debit that I pay. It's gone up to $2.32. But now I have a lot more money that I could potentially make. Now my maximum profit is over $500, whereas before it was only about $400. My probability is higher than it was previously because, again, the market understands and the metrics understand that this is going to be an easier trade to manage if it moves in my favor. If you have a super tight butterfly, like $1 wide or $2 wide, like, yes, it's going to be dirt cheap. Like, yes, it's not going to cost you anything. Like, you're literally not even going to know that it's gone if you lose it. The problem is those are very, very hard to manage. Those are very difficult to manage. You have to thread that needle, you have to get the perfect price at the perfect time. And so I much prefer to widen out my butterflies to give them kind of more room to breathe. So I would probably settle on this butterfly, whether it's to the upside or the downside, doesn't really matter. It depends on, the directional bias that I might have. But this is going to make a little bit more sense. Give me a little bit more kind of meat on the bone when it comes to, the risk return dynamics. Give it a bit more economic significance. And so when you're setting up your butterfly, your expected move butterfly, I should say, pin the expected move with your short strike, and then choose the width of the butterfly relative to your position sizing parameters in your account. And again, this is a great strategy for a binary event like an earnings release. So there you go. That is an expected move butterfly. Now, again, it's not technically around an earnings event because I couldn't really find one today, at least in terms of a stock that we all know and trade and are familiar with. And so save this in your repertoire for when earnings season comes around in just a couple of weeks. And so you will be ready to go because we want to hang our hat as premium sellers on time and volatility. But still, from time to time, taking a directional shot, it's fun. It's fun, it's part of the game, and you might even make a little bit of money. And now you have a really, really cheap way to do that, relatively speaking, with the expected move butterfly. And I'll see you guys next time. Jim Schultz here for Calculated Risk. And don't forget, before we get started, the best ways you can help us are by liking the video or subscribing to the channel. Either one of those guys really helps us out a lot. So generally speaking, here at Tasty, we like to sell premium. Right? We want to play into the high probabilities. We want to play into the positive theta. We want to be on the short side of the option contract, generally speaking. But every once in a while, we also like to flip the script. Like every once in a while, we like to buy volatility. Every once in a while, we like to use debit strategies and kind of play for volatility rising. And one of the classic strategies to set up for that type of play is a calendar spread. So what I want to do today is hop into the platform and let's set up a calendar spread. But before we set this guy up, let's just talk in general terms. What does a calendar spread look like? Well, it is going to be a multiple expiration cycle strategy where you're selling the front month and you're buying the back month. You're choosing the same strike in both months. So it's very much an overlapping feature of the strategy between the short option in the front month and the long option in the back month. And the reason why you set the strategy up this way is because you want to take advantage of two elements. You want to take advantage of time decay, even though it's a debit strategy, and you also want to take advantage of any potential volatility expansion. So the time decay comes from the simple fact that that short option that you're selling in the front month, it's going to burn faster than the back month. It's going to decay more quickly than that long option that is sitting in that back month. And for the volatility aspect, the back month option is going to have a higher vega than the front month option. And so by having that higher vega in the back month, if there is any volatility expansion in that underlying stock, you are likely going to see a pop in your P&L from that volatility expansion. This is why we typically like to do calendar spreads when volatility is on the lower end of the range. So all right, let's hop into Tasty Trade and let's set one of these up. All right, so here I am inside of my Tasty Trade platform and I've got Meta pulled up. And this is a $600 stock. Okay, so the first thing you want to understand is we really like to use calendar spreads on higher price stocks. So not necessarily $600, but the price of the stock doesn't necessarily kind of preclude you or prohibit you from doing a calendar spread in that stock, because the higher price of the stock really plays well with the more aggressive management style that we typically deploy with calendar spreads. We're typically managing these spreads at 10 to 20 to 25% of our debit paid. And so if you choose a really low price stock, like a $50 stock or a $75 stock, it's going to be a super cheap calendar spread, which is nice because that is indeed your maximum loss, but it's just not going to give you a whole lot of economic significance when it comes to the profit potential on that strategy. So, okay, so I'm in Meta. The way that we would generally set up a calendar spread is going to be, again, I'm selling the front month and I'm buying the back month. Don't worry about the earnings right now for the purposes of this illustration. We'll come back to that at a later date. Usually, we like to be at about a 1-to-2 ratio between the front month and the back month. So you can see we're at about that ratio right here with this Meta calendar spread. So when I go to set this guy up, I'm going to open up my July cycle first. Now, in terms of the strike selection, remember, we're going to be selling and buying the same strike. So the 580 in both cycles or the 560 in both cycles or what have you. Usually, calendar spreads, the spirit of the calendar spread is more of a neutral strategy. So you're usually typically choosing a calendar spread with some strike around where the stock is currently. Now, you want the stock to pin the strike. So whatever you choose, that's where you want the stock to go. So if you want to be more directional, then you can certainly choose strikes on the low end. You can certainly choose strikes on the high end if you want to be more bearish or more bullish. But usually, the spirit of a calendar spread is more of a neutral strategy. On that note, we typically prefer put calendars relative to call calendars. It's not a huge difference, but remember, this is a volatility expansion play. This is a long volatility play. So if volatility rises, that's going to help our calendar spread. Well, we know, or maybe you don't know, and maybe this is the first time you're hearing it, but market prices and market volatility typically move inversely. So when market prices are down, volatility is typically up. You can even see it on a day like today where the market is down huge and volatility is up pretty significantly. And so we typically observe this relationship across the board with a lot of individual stocks as well. So if I'm playing volatility to expand, I'm playing volatility to the upside, then I want to position myself to potentially extract as much benefit from that volatility expansion as I possibly can. So choosing the put option slightly below where the stock currently sits, even if it is mostly neutral, choosing a 580 or a 575, that's going to allow me to situate my strikes such that if there is volatility expansion and the stock price moving lower, that's going to really help me. So right here, let's say I sell a 580 strike, which is just slightly below where Meta is right now in July, and then I close up July, I go to August, and I buy the same strike, the 580 strike. And so notice how this is a debit of $14 on this strategy. So this is a fairly significantly priced calendar spread. You would probably want to have, I would say, maybe $30,000 in your account or so, or maybe even more than that, or maybe even a little bit less. But this is not going to be a strategy for a tasty bite-sized account. But if I'm managing this at 10% of debit paid, that's $140. 20% of debit paid, that's $280. So it's pretty significant when it comes to the management. when I'm using when I'm selecting my strikes, I want to make sure that the extrinsic value in the front month is over and greater than the debit that I pay in the strategy. This gives me the best possible chance to make money from time decay, because I know if nothing happens and the stock just sits here, which we know that it won't, but if it just meanders around and ends up back here when all is said and done, then all that extrinsic value that came off of that front month is going to cover the debit that I pay in the strategy, and it's going to effectively make it a little bit easier for me to make money. So this $14 and some odd cents, if we go back to July, where my front month is, you can see I'm collecting over $22 in extrinsic value. I know that that's all extrinsic value because this option is out of the money. And so the way that this calendar spread is setting up in Meta looks pretty good. This would be a great candidate for a calendar spread. And so hopefully this kind of makes sense from the higher priced stock preference to the put preference. It's mostly a neutral strategy, managing aggressively at 10 to 20% or even 25% of debit paid, and then making sure that front month extrinsic covers the debit. So, okay, so that is a calendar spread. Hopefully that makes sense. And we kind of covered the major points of setting up a calendar spread. Now, in today's market, with the VIX skyrocketing and volatility rising, this may not be the best market to sell or put on a calendar spread in, but when volatility eventually collapses, when volatility eventually contracts, as we know that it will, if history is any guide, now hopefully you are ready with a strategy that can take advantage of that low volatility, and I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started today, the best ways you can help us are liking the video or subscribing to the channel. Either one of those really helps us out a lot. Okay, so around here, you guys already know the drill. Like, you already know that we are premium sellers. You already know that we want to live on the short side of the option contract. We want to play time. We want to play volatility. We want to play probabilities. We want to do all those kinds of things. But time to time, every once in a while, we want to venture off onto the other side of the contract and maybe buy a little premium. Well, today, that's what I want to talk about. When does it make sense to maybe consider being on the long side of the option contract? Well, I can think of 3 specific scenarios, and I want to unpack those in detail right now. So again, by and large, we want to be on the short side of the contract, right? We want to play the higher probabilities. When you sell premium, especially out of the money premium, you're going to have probabilities of profit that are in excess of 50%. Could be 60, could be 70, could be 80, could be 97 for my 3 delta put sellers out there. I probably wouldn't do that myself, but you've got to blaze your own trail. We want to trade the high probabilities of the marketplace. Okay. We also like being out of the money because that gives us room to be wrong. That gives us a little bit of buffer and a little bit of wiggle room on the position when it comes to not needing to be right historically. And then lastly, we've got the implied volatility, overstating realized volatility on average over time. Doesn't happen every single time, of course, but that is what we're hanging our hats on. So when it comes to why we're on the short side of the contract, those are the main reasons why. But when does it make sense to be on the long side of the contract? Well, here's the first scenario. When the VIX is super low. Like, you've got a VIX at 11, 12, 13, 14. You're just not really getting paid to sell premium. You're just not really getting paid to be on that short side of the option contract. And so in these markets, when volatility is at these levels, it's now going to make a lot more sense to be on the long side of the contract because A, option prices are cheaper. So whether you're buying the options outright, again, something else I don't know that I would necessarily suggest, or even buying your spreads, they're going to be relatively cheaper than they would be if volatility was higher. But then also remember, volatility has a tendency to mean revert. Like, volatility has a tendency to move back towards its long run average. So with a long run average VIX at like maybe 16, 17-ish, when you've got a VIX at 13, 14, like, there's some upward pressure for volatility to expand. Now, volatility can live on the lower end of the range for a very, 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 very long time. And so it doesn't mean that it's going to revert back, today or tomorrow or the next week. But statistically, this is a decent time to take a shot by buying premium and playing for that volatility expansion. Okay, so scenario number 2, earnings, right? If you've been around the Tasty world for any length of time, you know we love to trade earnings. There's high volatility, there's lots of movement, lots of action, and honestly, it's just fun. Like, you want to do something in your favorite stock, you want to do something in, some hot stock in the marketplace, you want to take a shot, whatever, upside, downside, doesn't matter. It's fun, it's engaging to trade earnings. Well, earnings can be a little, I don't know, man. I mean, it can be a little crazy, right? The moves after an earnings event can be rather significant. So it can make a whole lot of sense to maybe buy options going into earnings rather than selling options. By and large, we do think the opportunity is still on the short side of the contract, even for earnings announcements. But I respect the fact that some people might look at the scenario and the situation and say, man, I'm looking at AMD earnings. I'm looking at Amazon earnings. Hey, maybe you're trading NVIDIA earnings. And you're like, hey, I don't want to do this from the short side. I would much rather do this from the long side. That's totally fair. That's very reasonable. That's going to be a great time and a great scenario for you to lean into the long side of the options contract and consider buying some premium. You could buy vertical spreads. Hey, you could buy expected move, butterfly, shout out to yesterday's calculated risk. You could buy a lot of different strategies, diagonals, calendar spreads even, around earnings and play that long side of the option contract in a much more controlled way. Okay, scenario number 3. It's also going to give you a little bit of strategic diversification. Right? When you've got a portfolio, when you've got a book, as the pros call it, and it's mostly short premium, it's mostly short options, it's like, that's all well and good. You got the probabilities, you got the theta, you got all those things. But just to smooth things out a little bit, just to smooth out your directional bias, just to smooth out your exposure and smooth out the different strategy sets that you might be using, it can make a little bit of sense to add in some long options and add in some long spreads and add in some debit strategies that really kind of balance everything out. Now, let's be clear about this. You're buying verticals, you're buying calendars, you're buying diagonals. In my humble opinion, those are not going to be the things that move the needle. Those are not going to be the things that ultimately kind of get you where you're trying to go. And so we can't expect too much out of our long premium strategies and put too much pressure on them to carry the load and carry the weight. That's what the short premium is supposed to do. And so it definitely allows us to strategically diversify, but we just have to temper our expectations. Make sure that we're not asking too much out of these strategies, things that they were really never intended to do. Because remember, when you buy options, especially naked options, but oftentimes even with spreads, what are you giving up? What are you sacrificing? What are the gotchas, as they say? Well, effectively, you're not going to have high probability. You're either going to have like a 50-50 shot, like an at-the-money spread, or you're going to have very low probability, 10%, 20%, 30%, with like a butterfly or something like that. And you also don't have time working for you. So the two primary pillars of what we like to lean on as a premium seller are essentially going to be either A, non-existent, or B, working against you when you buy premium. So hopefully now you can kind of see we can't really expect too much out of these strategies in the end in terms of being a really significant needle mover. And that's why at Tasty Trade, we lean on the probabilities, we lean on theta, we lean on the short side of the option contract because we do feel like that's where we're going to be able to tap into the big needle movers. Those are going to be the things that get us where we're trying to go and move the portfolio forward. But still, there's a time and a place to add a little bit of long premium to your portfolio. And hopefully now it's a little bit clearer to you what those times are and where those places are. And I'll see you guys next time.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at Tasty Live, with a very special guest joining us today. Jeff Curry's here. He's the executive co-chairman of ABAC's Commodity Futures Exchange, a senior advisor to the Carlyle Group, and the former global head of commodities research, I should say, at a little place called Goldman Sachs. Welcome, Jeff.
Hey, it's a pleasure to be here. Looking forward to it.
I have the perfect guest here, I think, for the events that we have unfolding in the world. Obviously, we have some sort of a U.S.-Iran deal, maybe possibly finally coming together. You've pointed out that you can't print molecules, and so all of this stuff may be kind of a moot point. What do you think is going on here? Obviously, crude is down on it.
Well, I think there's a couple things creating the downdraft in prices. One is people were anticipating a deal, so they've quit buying. There's a buyer strike going on. You can see it in tertiary inventories around the world. They're dropping, which tells you they're withholding their buying. The Chinese are withholding their buying. All of them are withholding their buying, which means you're going to have pent-up demand on the other side of the deal. So that's point number one. The investors liquidating their positions. Anticipation prices are going to drop. By the way, when the deal on Friday, more likely than not, you're going to rally because you have all of this selling pressure into this, which I would argue is probably the more likely outcome here. The other factor is what's likely this deal has a near-term impact, which it could unleash the pent-up oil that's inside the Gulf right now. That comes out, but that's not much. Call it 60 plus million barrels. We're drawing 6 million barrels a day. That buys you 10 days of inventory. That's not a whole lot. Longer term, there's a much bigger issue here. You listen to the likes of Maersk and Mitsui, they're not willing to take the ships back into the Gulf right now. And the reason being is they don't see how this thing is solved. So I think there's a lot of unanswered questions right now. It means that the uncertainty remains high, and the sustainability of the deal is highly questioned. The bottom line is both sides are claiming a victory, bragging about things that don't match. So I'm really curious what's going to happen on Friday when these issues come to a head.
And of course, the immediate read-through when this war began was, all right, so we have a disruption in oil. That means inflationary impetus. That means higher yields. That means a stronger dollar. That means the price of gold comes down. All of this obviously coming together. And it's a very interesting time to have this deal because, of course, we have the FOMC policy announcement, the first one for Kevin Warsh coming up. Do you think that the markets are right to still think we've got a rate hike on the menu here because all of this is not going to go away quickly and the inflationary impetus remains?
I definitely believe this stuff's not going away quickly because even if you wanted to, one, you got to resolve the mines. France just said they're not willing to start demining this until they see how it plays out on Friday. Then after you get rid of all of the mines, you got to get the ships to come back. That's number one. They got to get the ships to go back in there. What's going to get them to go back in there when the deal doesn't have all the parties involved party to it? The Israelis weren't a part of it. The other Gulf states weren't a part of it. And when you look at the likes of, and I think it was yesterday, J.D. Vance said, who's going to pay the $300 billion that's owed to the Iranians? And our Gulf friends are going to take care of it. Well, were the Gulf friends consulted? Nobody's seen any details of this. These are big questions that need to be asked before those ships are going to come back. Okay, so let's say they agree to bring the ships back in. Then you have to go find the ships, and the ships are all out of place right now. It's going to take, bare minimum 6 to 8 weeks just to get the ships back after you've demined it. And then they gotta feel really comfortable that there's not going to be another outbreak and you got your ship tracked in there. I mean, so that means you got to have some time behind this and be comfortable that it's a sustainable deal. So I think there's a lot of question marks that remain open here, which means in the interim, you're still drawing inventories. Markets are getting tighter and creating the potential for substantially more upside.
Well, I think the question of inventories is a very important one. I mean, I think you've made the point very clearly that much of the kind of resilience we've had to this oil shock so far has come because inventories have been pulled to such an aggressive extent. And certainly not just in the U.S., where it looks like we're exporting a lot to kind of cover the gap, but global inventories as well. How much of a price shock and how much of a durable price shock do you think there is here? Obviously, we've seen CPI and PPI numbers are already showing spillover from this into core. Is this something that's with us here? Is this now an inflationary shock that's already in the cake?
Well, you're already seeing it. As you point out, you're seeing it in the numbers already. It can only get worse from here, not better. Because the situation is tighter today than it was 2 months ago, than it was 3 months ago. It's progressively getting tighter every single day this goes on. So therefore, you have to come to the conclusion that global supply chains are more stretched today than what they were then. So if it was a problem already in the CPI data then, it's got to even be a bigger problem today and tomorrow until this thing absolutely resolves itself.
That's right. Okay, so let's then follow that lead. So if this is more of an issue, we already have an economy where the consumer is getting squeezed by this, certainly not just in the U.S., but everywhere. Let's focus on the U.S. for a moment. We have this blistering build out of AI that's driving the economy, but the consumer is obviously a much bigger piece of the pie, and that's the piece that's getting squeezed. Are we starting to flirt with some sort of stagflation type of a dynamic? Obviously, you can't call stagflation so early, But is this where we're heading, and what is the Fed supposed to do with this?
Well, I'm not going to be going out saying I'm not a macro guy. I got to make the stagflation type of argument, but I think they're stuck between two conflicting dynamics. You have AI as a deflationary force, and you have commodity scarcity as an inflationary force. So you got these two things going in very different directions, and I think we're going to create a lot of cross signals for them. But I also want to make the point is that the deflationary pressures on AI are predicated on the ability that it's like the old tech model, infinitely scalable at zero marginal cost. This one's not infinitely scalable at zero marginal cost. This is your standard commodity supply curve, because not only does it have data going in it, but it has atoms and molecules who face upward sloping supply curves. So this is not your standard tech model anymore. This is good old fashioned commodities. So, I like to do is we're replacing humans with commodities in AI. And human beings are renewable, commodities are not. And I think that point gets lost. So, that deflationary pressure that comes from traditional tech frameworks, I don't know if it really applies here. This is just good old-fashioned commodity production. And I think this is what's been lost by the investors. They think that these companies are magic and that they can trade at whatever times earnings. These are good old-fashioned cyclical commodity companies now. They get 10 to 15 multiples, not 30 or 40 multiples. Then that point, I think, is completely lost on many of the investors, as well as the macro community, assuming how deflationary this whole thing is going to be.
I actually agree. I think you look at the growth mix, at least in the first quarter, you see business investment spinning at over 10% annualized rate. Meanwhile, consumption is growing slower than the economy itself. And you go, well, I wonder if you spin a tiny piece of the economy that fast, what's going to happen? Inflation. So the build out may be inflationary, and then we'll get to the deflation part when and if this thing is finally built eventually, possibly. I think you're spot on here. So for me, as I look at this, sort of the natural question then becomes, we've had these really exuberant moves in stocks this week with the announcement of this deal. Ostensibly, people are celebrating that we're going to get the inflation risk out of the equation. We're going to get oil back down and sort of get back to business as usual. Do you think all of this is actually setting up to be a disappointment for stock markets?
Absolutely. Unfortunately, I think that is going to be the case. And one thing I don't understand, the corporates are telling you, I'm not willing to do this. The foreign governments are telling you they're not going to go minesweep this because they don't believe it. So why do U.S. financial markets believe it if the corporates don't, the other foreign governments don't? That's the part that I'm a little baffled by, that they're just selling all of this really hard and trading it as if it is a permanent sticky deal, but the reality is very few participants actually come to that same conclusion.
What do you think is the demand destruction aspect of this? I mean, obviously we're going to get to a place, ostensibly, if crude oil keeps marching and the consumer keeps getting squeezed, where it's going to start to bear down on the economy as a kind of cyclical squeeze. What's the window where that starts to counteract the supply shortages and sort of the bottleneck there?
I think it's not going to happen in the U.S. Unlikely to happen here in Europe. It's most likely going to happen in emerging markets and places in Asia, and we're already beginning and have seen it. So it's not something that you will likely feel at home, which is part of the reason why people are ignoring this. It's something that's going to happen more broader on a much bigger scale than just happening, on a more smaller scale. So I think these are I think what'll probably happen is once it encapsulates and becomes bigger, is the U.S. is exporting oil and product all around the world. The end game is that the U.S. prices spike and shut down that hard to the rest of the world. That's how this probably ends. So the Americans will feel it, but it's not going to result in demand destruction because they're too rich relative to the rest of the world.
One last question here. Obviously, the implication for all of this, as we've said, has been higher rates because the markets have sniffed out the inflationary impetus basically on day one of this war. And one of the consequences has been gold prices, which were on a relentless march last year. And really, the whole precious metals complex has come down significantly because, of course, these things don't yield anything in real terms. And when rates go up, that's not a good thing for them. Do you think that is a thing that's going to continue if we're looking for crude oil to continue to be sticky at these higher levels? Is gold going to continue falling here?
Yeah, I put out a piece, a few months ago where I was short gold. And the reason being is for precisely what you just said. The rates are going to be higher. They're having to sell gold to fund defense and energy security programs, which is putting a lot of downward pressure. Last week we went as low as 4,000. I think the key message is you don't get long gold again until you're on the backside of this, and central banks are now beginning to think about rate cuts. And at that point, that's why I think you really open up the upside on gold. 5,500 was the previous high. I think we could even double from there, because ultimately you're asking what kind of share of central bank assets does gold need to get to you look at places like China. On a global basis, we're somewhere around 27. Actually, with prices down, we're probably back down to about equal to where U.S. Treasuries were as a share of reserve assets. So call it in that 25, 26%. But if you go back to where we were in the 60s or 70s, you got to push that up into the 40 to 50% range, which is essentially another doubling in the price from here. So that's why I would argue that there's still a lot more upside left to gold. However, I wouldn't want to be long today, I don't think.
I'm running snow leopard with this. I'm a Mac. I'm a Mac. I'm a Mac. Gee. Multitask, MacBook handler, brother. iPhone in one hand, iPad in the other. Pop open top, Apple logo shining on the back. That's why all these player haters know that I'm the Mac. Easier to see a nun with VD than to see me ever typing on a PC. So if you got one, you can play a sad tune and play it back later in your room on your Zune. Windows made to break, and I'm here to crack it. And if I'm a Mac, that means that I'm immaculate. Style so clean like it's disinfected. Clean surfaces where white light is reflected. Plastic case, Apple Store, keep my phone protected. Check my toolbar to see if networks are detected. Use my side swipe, applications hidden in it. This is Mac world, bitch, you're just living in it. I'm a Mac. 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 Roll into the coffee shop, know I'm on a power trip. Strapped with my laptop and my own power strip. Eye outlet, about to make your cable drop. Apple logo shining off the marble on the tabletop. So if you see me, then you seen a star. Any place I sit down, call that the Genius Bar. Looks like I'm working hard, but to really know the truth, just taking pictures of my fine self in photo booth. Interface simple, why I need a Kindle. Working on that pad keeps my fingers mad nimble. So if you think I come up short, you must be wrong. More than one reason that these ladies call me Justin Long. I'm a Mac. I'm a Mac. I'm a Mac. Yeah, Justin Long, son. You catch that? Known by the ladies as the toolbar. 10-hour battery life. Force. Quiz.
We are back. You're watching Tasty Live. It is still Wednesday, June 17th, 2026, which means it's time for a Fed rate decision here at the top of the hour. Kevin Warsh's first meeting as Fed chair, so we're bringing it to you live. Next 20 minutes, Ilya and I will take you through as we get the actual decision itself. Tom Preston will come on about 1:10 Eastern, 12:10 Central Time to talk through the trade setups as we get ready for that press conference. Ilya, before we get there into the breakdown of what could change here at the top of this hour, we have new dot plots, new summary of economic projections coming up with inflation, with growth, with unemployment. Let's talk about how this market's set up here. Laura, we can go to the charts right now. S&P 500 down just 2.5 points, 75.84. Volatility a touch higher over the course of today's session. The VIX sitting in right now just under 17, still 1665, right off the session high, but still about 25 cents higher. NASDAQ here's had a little bit of a better outperformance going into this, and like the S&P, somewhat higher vol today. It's up by 0.4%, 132 points, not much really to do there about anything. Bonds, of course, are probably the most important part of this move today. They might be the linchpin upon which everything sits. Notes here are slightly weaker, down by one tick, sitting at 109.29. ZB, where volatility is very low, it's up by one tick. By the way, a negative IVR on the platform, that's scaled 0 to 100. So when you go above 100, you're thinking in percentage terms. 105 IVR means volatility is 5% higher than the previous high reading over the past 52 weeks. A negative IVR means volatility right now is 0.9% lower than where it's been over the past 52 weeks. So this is a new cycle low in bond vol, as it were. Ilya, we want to keep moving here, though. Crude oil's had a little bit of a bounce, although it's kind of pinned against that April 17th low. It's come off its highs as Trump has made its way through the day through some of these various comments in Iran around the G7 meeting. We have gold prices here, which are likewise bouncing a little bit, but maybe haven't turned a corner just yet. Through the end of the day, Ilya, before we get to you, what is the S&P 500 doing? Futures market here, 38 points, 39 points the rest of the session. So around 0.5% or so. Okay, that's where the market stands. Ilya, 2 o'clock we get this new summary of economic projections. That could trigger a market reaction because the market's perception of where the Fed thinks inflation and then vis-a-vis rates are going would be an interpolation. So what do we know about the dot plots and our anchor point for what the Fed is going to tell us in about 5 minutes' time?
I think you look at GDP numbers here, December projection versus the update in March, and you see higher numbers. You look at inflation, and you go, okay, December numbers versus March update, higher numbers. You look at the long-run projection for GDP, increased from 1.8 to 2%. The parallel long-run increase in the Fed funds rate projection from 3 to 3.1. What is this telling you? It's telling you that there is a pickup in inflation for this from former now Chair Powell in the last press conference that he did when the Fed last convened. This was, of course, after these forecasts. There was an inter-meeting gap there. And so you had him come out and say, hey, we're not saying that we're more concerned about inflation because of this war, which at that point had only just started. No. We're saying there were reasons to think the economy was reflating before that. We're not even there yet as far as this energy shock. We'll see what the energy shock does. And so the way that this has been set up is you've got Kevin Warsh ostensibly coming in as new chair with a mandate to be dovish by a very insistent White House. Meanwhile, you have a hawkish committee. And so the biggest question here is going to be, how does he do in the press conference? And does the Fed appear paralyzed? Because they're going to have to see something really dramatic this way or that before this logjam can get cleared up.
We're still only down by 2.5 points here in the S&P 500, 75.85. Ilya, I currently do not have any trades on in ES or MES right now across any expiration. I am still leaning long deltas in the NASDAQ here, though. I'm paying attention to how this market reacts because if we do see a meaningful enough pullback, it might cause me to trim my exposure and take off the positions that I have on here, at least in MNQ, temporarily speaking, especially the short put spreads, as it were. Over the course of the last week, I had been laying in some short put spreads as we got close to that 50-day moving average, anticipating that, well, if the uptrend's still here as a trend follower, I'm going to have to buy a dip at what is a key trend level. So right now it's working out. But if we start to see today as we go into the close, right, a NASDAQ that all of a sudden loses its recent pivot point, this pivot point being the high that we had here on June 9th, 30,138.75, I may just take whatever little profits I currently have remaining sitting around in the short put spreads in NASDAQ and see where this market settles. And maybe we get another pullback to the 50-day moving average that offers an opportunity for a better chance at re-entry, as it were. But with a 16 and change VIX right now, if we get that movement here and yields start going up, stocks start getting dislocated, there's some breathing room, some blue skies, should I say, that would allow for volatility to expand and breathe a little bit more, because it's not like we're starting this meeting with a 22 or 23 VIX.
Right. I mean, I've been sitting in exposure on the short side, but it's structured as short call verticals, and there was very rich premium to have there, so much so that the max loss I locked in at the time was smaller than the premium received up front. Now, again, I stress this is not free money, because the markets will always find a way. After all, we've seen negative crude oil just in recent years. Who would have thought that's even a conceivable thing? But the markets will find a way. Nevertheless, I'm in this exposure against the highs from the beginning of the month, late May. And so for me, this is the market kind of waiting to see whether that top really is the top that I thought it was. So I'm sitting in those positions. I've got all kinds of time on them, still 44 days on them, and some of this exposure I've had for over a month. So we'll see, but I'm biased in the direction of higher rates with my exposure. I'm long the dollar. I'm short risk. I'm spying what's going to happen here with bonds and with gold, because if the upshot here ends up being stocks down, dollar up, but yen also up, and gold up, and bonds up, then the markets are spying some sort of a cyclical risk that the Fed is nudging at when it says what it says today.
You know, I took a little trade here in notes before the meeting. I just bought the plain 109 put. Tom Preston was giving me some grief for it, but max loss $15.63. Look, I'm leaning long deltas in stocks right now. What's the worst thing that could happen to me here? A rate shock, right? Rates all of a sudden start shooting up, 2s, 5s, 10s. The market gets jumpy, and all of a sudden the stock stuff starts to go under. But we're going into this meeting, Ilya, S&P 500's flat. Very funny how that works out on a day like today. We're going to get this new announcement here any moment now. A little bit of jiggle there, 75.70 in the S&P 500. So just keep that in mind, as it were. I'm waiting to see what the statement says, because I have not seen any of the numbers cross my screen just yet.
We got lower gold and a stronger dollar here out the gate.
Out the gate, we have the Fed has left rates unchanged, which is the consensus expectation going in today.
Right, we knew that much.
We've said that multiple times on air. CME FedWatch tool was very clear that there was 1% chance or so for a rate rise today. But this new summary of economic projections, it'd be nice if the FOMC summary of economic projections loaded up on their website.
Oh, wow. This statement is significantly revised.
Well, naturally.
And the summary of economic projections here is significantly more hawkish. We're betting on hikes here in this summary of economic projections for this year.
And you're seeing stocks give up their gains here. The S&P is now down 30 points or so. Change in the projections here. That's come out at the top of the hour right now. Inflation, 3.6% from 2.7. But dare I say, Ilya, they're saying it's transitory. For next year, only 2.3 from 2.2. Yes. This is going to be a very interesting conversation that Warsh has to explain to the markets here about why they're not expecting inflation to go bump in the night a little bit more. And maybe that's the soothsaying this market needs to hear. But you mentioned the changes in projection overall. GDP's in a touch. You're getting much faster inflation, both in the PCE and in the core. And in fact, in the core next year, 2.5 from 2.2. You mentioned where the Fed funds rate will be. The Fed is telling us from 3.4 to 3.8. My math isn't that good, but 3.8 minus 3.4 is 0.4, and that is more than 0.25. 0.25
it most certainly is. Note also that the path back is to 3.4 by 2028. So we get to where we thought we were going to be this year only in 2 years' time. We get back to where we thought we were going to be with 50 basis points in cuts this year in 2 years' time. This is a very hawkish rethink here.
So the market going into today is pricing in 73% chance of at least one hike this year. The Fed is telling us that that's undercounting it, that the market should be pricing in perhaps a little bit more than that. As things stand, they stand ready to deliver potentially more than one hike right now. You can see in the SR3 Z6 contract, Ilya, right down to 4%. Now trading right at 96. The market has gone to go price in immediately that 4% Fed funds rate, which is, for what it's worth, when we had after that non-farm payrolls report on Friday, June 5th, and the Fed funds rate cratered into 4% again, that's when the S&P 500, the NASDAQ had their biggest losses. So the NASDAQ here, it's now in negative territory, off by 0.2%. I wonder, though, because the Fed telling us that they may have to hike, that's probably good. They're expressing to the market that they know that there's a problem here and they have a hand on the steering wheel.
Yeah.
What does this do for the bond market?
Well, this is where things get really, really interesting. Because if you look at what's happening now, sort of as this is getting baked into the cake in real time, I mean, just take a look at what ZN is doing here. And you can see we have an immediate reaction. And it is a sharp move higher in rates. Now, we'll see how this settles. We still have the press conference to go. And as I was saying when I was previewing this yesterday, the way that you arrive at the dance here, right? The committee is clearly hawkish. And we've heard this. And you and I were talking about it before this came across.
Risk of overheating.
Kevin Warsh came here with a mandate to be dovish, but what can he do? Well, the first round of excuses to the White House are probably going to be, well, the committee did it. What am I supposed to do? I can't outvote all of them. And so you're probably going to get some level of moderating of this influence here when you get the press conference. He's probably going to come out and try to soothe this somehow. And we'll see how it all shakes out in the end. It'll be his first press conference. Even Powell had a few iffy press conferences there in the beginning, and he'd been Fed governor for a few years before he became chair. Kevin Warsh hasn't been a Fed official for a lot of years. So
I want to bring this to people's attention. Gold's reaction to this here right now,
massive.
Off $50, giving up the day's gains. It's an area where we had a former swing low back at the end of May. It's an area where we tried to rally through on June 9th and failed. We did again on June 15th and failed. Today, maybe another failure. And for the faint of heart out here, Ilya, this 4-hour close right now, above the prior candle high, below the prior candle low. I'm seeing this here right now. This might be a good MGC or maybe 10Z short.
I'm going to be looking at this as a 10Z short, depending on how this candle closes. Obviously, I've been short for a while, but as we talked about, I took the positions off, thankfully, after the first 4-hour candle post ceasefire. And so I got to keep my gains for the most part, and it's been just a profitable idea so far this year to be short gold. So I'm going to be looking to get back in.
I just actually sold a 10Z contract here. Given that the sell-off is accelerating, Nasdaq's down 0.6%, S&P down by 0.8% here. Ilya, if that's a bearish engulfing bar, it's happening at the exact level where you'd want it to happen. And if we're looking at rate hikes that are coming onto the board that the market wasn't previously anticipating, which clearly not, then gold could get softened up in this environment. And that's not to say that the Fed is telling us it's just 1 or 1.5, maybe 2. You know, they're telling us that they think this is short-lived. So if there's evidence that accumulates over the next few months that inflation is making its way through the system in a compounding fashion, then you could get more hikes on the board right now. You could get more hikes earlier next year. So it's not something that you want to dismiss handily. But I want to hear what Kevin Warsh has to say, Ilya, because the way that he talks about the statement, right? If he says, like, we think it's going to be transitory and these are just insurance hikes in order to prevent things from getting out of control, we stand ready to act, but we're not going to hike just yet. We'll see what happens with oil after the Strait reopens. Come the next meeting, they may turn around and have a totally different view and start to massage the sidelines here and try to get people to, re-understand or have a new interpretation of what their ultimate view is. So we're only off 0.5% right now. I will say that if there was a full hike coming onto the board that wasn't priced in, I would expect a little bit more weakness here, which is why Warsh carries so much importance for me.
Yeah, I mean, I think we need to look at that. If you look at the statement, it is bare bones to say the least. I mean, we have.
Let me pull this up here. This is
we have barely a statement here.
There's nothing here.
Right.
So because there's no detail, it's all the FOMC, it's all the dot plots and the projections that are doing the lifting and influencing the markets.
Yeah.
There's nothing
so
to read
get
between.
ready, everybody. This is how the Fed communicates now. Ostensibly, this is a preview of the Warsh Fed. It issues statements in tweetable chunks. And that's going to be aligned with what Kevin Warsh has talked about before. He's been a critic of excessive forward guidance. And so it looks like we have some strategic ambiguity here. That only means the press conference is going to be that much more impactful. The market doesn't have a lot to go on here. Mind you, the statement has been approved in a 12-0 vote. So Kevin Warsh did not vote for a cut today. Stephen Mirren, he is not.
That to me is one of the undercurrents of this little message here. Ilya, where do they usually put the vote announcement on
at the bottom?
Right. They usually put it at the bottom in the Powell era and in the Yellen era and in the Bernanke era. This is the first time that I feel like
Powell Fed followed the Bernanke-Yellen script.
So they're telling you up front, 12-0. It's usually the last thing here. They also tell you who was voting for the action and all these other statements. It'd be like Jerome Powell, John Williams, Michael Barr. None of those names are listed. Yeah. They usually explain why they're doing what they're doing up front before they get to the conclusion, right? Hey, the economy's doing this, inflation's doing this, labor's doing this, this is what we're worried about. And so because of all those things, this is why we're doing no change, a hike, a cut. This is really fascinating. It feels like this is short because Warsh doesn't want the president to misinterpret things. He wants to be able to explain this himself. So the bottom of the hour, Ilya, it's going to be fascinating. Just a quick review before you head out the door and we swap TP in for you. We were talking about the level here in the NASDAQ, around 30,000, that swing level. If we get through the June 9th, you can see how we're bouncing from it here, which is why I'm watching it on the close before I lift any of my NASDAQ long delta trades right now. If that line is held and we just hold up here, the beauty of the short put spread is I don't need this thing to rally. Time decay can work for me. And so I'll have no reason to just sit tight and let time go off the clock. But Ilya, you and I are going to have much more to talk about later on overtime. We'll check in on that gold trade as the day goes on. Thanks for guiding us through this Fed meeting. And wow, I can't believe they're looking at that much inflation. At least they're being honest about it.
Well, there's that. Let's see how Kevin's going to spin this thing and where all this dust finally settles.
Before TP comes on, just quick, what's the number one thing to watch during the press conference?
He's got to make sense of the hike being an indication and not a given, and stress that he doesn't like the dot plot, thereby neutering it.
Is it bonds? Are you looking at ZT? Are you looking at ZN?
I'm looking at ZN. I'm looking at gold, and I'm looking at the dollar.
Tom's going to be here in 5 minutes. Tom's going to be here in 5 minutes, by the way. So we'll keep going with this here. ZT sitting near the lows of the day. Mm-hmm. You and I have discussed in recent sessions the framework that the market gave us around the 2024 double rate cut, when Treasury yields shot higher as a result of them cutting rates. What does it tell you about the market where you're having yields drift up across the curve in a parallel fashion for now? It's not like we're seeing any sort of twist just yet. But what does it tell you right now about how the bond market's interpreting this? Is this not enough? Or maybe this is the credible signal that the Fed needs to send to let the market know we're not going to do a repeat of 2022 again?
I think what officials clearly are trying to do is tell the markets we're not going to repeat 2022 again and get this out of hand. I think it also seems to suggest that the market as a whole is recognizing the committee will not be cowed if there were any kind of dovish pressure from the new Fed chair. It is not obvious in this dot plot. And to his credit, there is no effort to suppress that kind of signaling here. I mean, clearly this is a very hawkish dot plot. It reflects each individual member individually. That is to say, this isn't a cumulative effort. This is a median of people writing down their own stuff. And clearly here is the Warsh Fed letting it be known where it stands as a committee. So I think the market collectively is saying, well, if we were concerned that somehow this was going to be a culture shift into an unrecognizable institution, that's not what this is.
You know, I think that today's meeting is really so much more about, I mean, this maps to me like the June 21 meeting, right? In June 2021,
yes.
And really, quite frankly, in the March Summary of Economic Projections, I'm looking at them here now, their 2021 PC inflation was 2.2. The 2022 reading was 2%. At the June 15th, 16th meeting, they bumped it up to 3% for 2021 and 2.1% for 2022. In September, it went to 3.7. Ilya, at the December meeting is when they pushed up the next year to 4.4%.
I mean, that June meeting was my tell. I started loading up on the dollar basically after that Fed meeting going, okay, they've finally seen it. They're going to hike, and they're going to hike in size.
What is tricky about that moment, though, is that while the dollar started going up and 2-year yields started going up, stocks still rallied for another few months.
They did. They had this kind of double dip thing where they had an initial sell-off going into Jackson Hole. Then they rallied after Jackson Hole into the actual start of the hike cycle. You saw the dollar front run that by months. So you knew the market knew. But stocks, in their infinite ability to only see that which gets people long, it managed to ignore it for months until they absolutely had to go once the calendar turned over.
Well, dollar's having a very strong day, bouncing off of its 1-month moving average again. Euro dollar, pound dollar, dollar yen.
Yeah, it is.
Dollar yen, pinned near 160. We're going to have to see what the BOJ does tonight. But Ilya, thank you for sticking around for a little bit longer. Tom Preston is here. TP, welcome back.
Yeehaw, Chris. Got a nice move up and down on these markets.
We do. Laura, I'm still seeing the ghost of Ilya. There's Tom.
Oh, yeah, no, don't lose Ilya. I love Ilya too much.
Well, he's already moved on. Gone but not forgotten, as they say. We'll remember him later for overtime. Tom, I'm not sure if you saw the Summary of Economic Projections, but the Fed's telling us they're going to have to give us at least 1, maybe 2 hikes this year. Is the market right to be a little upset here? The stock reaction is obviously negative.
Yeah, of course. And Chris, like you and I were talking about this morning, this is not a big surprise. It's the comments, and that for whatever reason, is what's his name? Warsh? Is he bucking political pressure to become a little bit more hawkish and prone towards increasing interest rates versus the Trump administration wants to see them lower? Who knows, right? And who knows? And like you always say, Chris, time will tell. There's a lot of time between now and the late fall and wintertime FOMC meeting. So they could certainly keep them down, keep them lower through the summer, and start increasing them in the fall. Who knows? But the probabilities of the Fed funds futures actually predict they did tick up a little bit higher still. They were showing non-zero probabilities of a rate hike in those fall and winter FOMC meetings. Now they're even a little bit higher still. So SPOO's now coming back a little bit. I was buying the dip, not through any kind of genius call on my part, but I still, Chris, have a bullish bias towards the market. What do you think?
I'm with you. I mean, there's part of me mapping this over to what happened in 2021. The Fed did something similar at literally the same juncture, where throughout the first half of the year, they're more or less ignoring the concerns about rising inflation. And then you get to June 21, and they make that upgrade to their inflation forecast, saying that we could see north of 3% inflation this year. And it spooked the market for a little bit. But the NASDAQ didn't peak until November 21. The S&P didn't peak until January 22. And given all the concerns around the Fed being, well, not so independent anymore because of Warsh's appointment, and given Trump's outsized pressure on wanting rate cuts, maybe it's the bull in me, and maybe I'm talking in my book here, but the Fed coming out with a 12-0 vote not to lower rates, not to change rates and more importantly to upgrade their inflation forecast and their rate hike forecast, it might be credibility affirming, which may be more important for the market than anything else. How many times have we seen a dip on Trump trying to fire Powell headlines? This might be good.
No kidding. So, and again, this isn't really a question about politics. It's just Chris, as you alluded to, the independence of these agencies. You know what's interesting though, is look at SMH. The chip stocks are rallying. TSM, AMD, take your pick. Those things are rallying sharply. And is that a surprise? No, I mean, they came off a little bit. The only one that was down is NVIDIA still down? Yeah, NVIDIA is still down a little over $1 right now. So for whatever reason, the AI story seems to have survived. But check out SpaceX. And SpaceX, I'm short put spreads in there. It came back a little bit. It was down about $6 earlier. And now it's down about $3.80. So it came back a little bit. I'm hanging on to my put spreads for one more day. That's when they expire. I always like to play. Hey, do I have an opinion about the stock? No. But that's coming back a little bit. So I think, Chris, if the economy is still an AI story, and I don't even know what that means, but if it's an AI story and the AI stocks, the chip stocks, the manufacturing stocks like TSM, the chip manufacturing stock, if those are all rallying, that could provide a lot of still support to the S&Ps because, again, they are major components of that cap-weighted index.
You mentioned the SpaceX trade. Yesterday, you and I put something on during Confirm and Send, I believe, which is a good reminder. If you want your trade ideas discussed on air here, send over to research at tastylive.com, and we'll look at them on Confirm and Send in the morning. Liz and Jamal or myself and Tom here. One of the trades was what was the better value opportunity this week if you're looking to sell premium in something like SpaceX or in the S&P 500. And Tom, we went out to the one standard deviation move here, which when you go to the trade tab and find your expiry on the platform, it'll be these dotted lines. The short dotted line is the one standard. This greater spaced dotted line here, the dashed line we'll call it, that's the 2 standard deviation move. So at 1 standard deviation right now, yesterday it was like 3.5 to 1. It's a little bit worse than that for the wear here. But that is the case where if you're looking at SpaceX on the same timeline, we'll call it like 30 days in the S&P versus SpaceX, you'd be selling we'll go $5 wide, 140, 135 here. Not great. But in the S&P, not great, but in the S&P 500 at 30 days to go out to 1 standard deviation, taking a little bit more risk, not much more gain. I'd rather just play in SpaceX right now, quite frankly.
I agree. You know what's interesting about SpaceX? And by the way, the VIX is only up 76 cents, trading 17.17, so it's up a little bit on the sell-off. What's interesting about SpaceX, Chris, is how much volatility has come in. Those one-day options, or at least, like yesterday they were 2 day, two days ago they were 3 day. Those short-term options, the implied volatility in the June expiration was like 220%. Now it's about 162. You say, well, geez, Tom, 162 is still, 10 times bigger than the VIX. Yeah, I get it, but it's way down. Those July options trading at a 102% volatility, they were up around, I think, 180, 190, if memory serves. Yes. So volatility is coming in SpaceX. Why? It's becoming a known, okay? Does that mean we know the financials of it? No, of course not. But now we know, okay, it's $197 stock. It's moving around, $5-6 at a time. That sort of defines the magnitude of the potential price moves. And Chris, as you pointed out, those standard deviation moves on the trade page, those are based on the stock or index's volatility. We don't just make those things up. We look at the overall volatility of the the SpaceX options with 1 day to go. We take that volatility, we run it through a probability calculator and determine what those 1, 2 standard deviations are. It's all math. It's all quantified. It's not Chris's opinion. It's not my opinion. It's what the market says the magnitude could be.
It's one of my favorite things. I mean, it really doesn't matter what stock you look at. You're going to find this on the platform automatically everywhere you go. And that's a good place to anchor trades. And quite frankly, if you are a directionally neutral volatility seller, when I do this in like oil, for example, I just go out to the one standard deviation, go like $1 or $2 wide around it, short put spread, short call spread, and then like go fishing when we're not in a geopolitical risk period. And you don't get a lot out of it. I call it yeoman's work, Tom. But you get a few of those trades in your profile where you're like, I don't need to think about this. Just, it's unlikely to hit those levels.
You know what, Chris? I'm sorry. What point? You want to make another point?
No, all you.
Okay. So what I was going to say is it is a place to start. So if I open up the platform and I look at, I don't know, NASDAQ, if I look at crude oil, if I look at Tesla, if I look at SpaceX, I'm presented with this array of option prices. Where do I start? What do I do? Yeah, I've been doing this for 30 years. I zero right into what I want to see. But instead of spending 30 years figuring this out, you can use the tools on the platform. And that one standard deviation, two standard deviation, take your pick, that level gets you on the playing field. And just like Chris was saying, it's okay, maybe I sell that one standard deviation put. Oh, geez, I'm not really getting enough credit for that. Fine. Move it to a closer strike, to a closer to the at the money. Fine. It's those lines give you a place to start. They get you on the dance floor. Okay. You pick your partner once you're on the dance floor, right? And if you need to adjust higher or lower, do it that way. But like I said, it's a place to start. Okay, I don't want to come out on left field at you, Chris, and I'm not sure how much you've heard about this yet, but it could be the next geopolitical excitement. Did you hear about the Russian Navy ships circling around the English Channel and taking pot shots at a British yacht after the British Navy seized one of their shadow tankers? Have you seen that news yet?
I haven't. I'm always, the echoes.
And I don't want to put you, Chris. I don't want to put you on the spot. Well, that's not my intent.
No. One of my favorite, tidbits about history is how World War I gets started. Right in the early days of World War I, you have this British vessel that's chasing a German frigate around the Mediterranean, and the German frigate's navigation equipment goes awry, and so they just got to start sailing. And so as they do, where do they go? They end up sailing towards Turkey, the Ottoman Empire at the time. And they are received by the Ottoman Empire. And so the UK is like, we're declaring war on you too, simply because they sailed into the wrong port. So wars have started over these kind of things.
Well, see, that's exactly right. And I think everybody's a little bit nervous about what was going on with Iran, and maybe we're stepping back from it. Maybe we're not. Whatever is happening in the English Channel may be over by tomorrow afternoon. Who knows? But I do think it is a potential potential crisis that could roil the market and maybe send these things lower. The S&P is right now, SPX right now is back down to 45. So it's been bouncing around 20 points at a time. Chris, I know you bought was it a ZN put earlier this morning?
That is true. I did buy a ZN put this morning just to kind of, given that I'm long deltas and stocks here, the thing that I'm worried about today was a bit of a rate move here. So I got the 109. I could theoretically now flip it for a nothing. So we're going to need to see a little bit more weakness for this to work out. But on the flip side, if it doesn't work out, it probably means that stocks aren't going to be selling off that much more.
Well, and as you pointed out earlier, and again, just to be very clear, I don't love buying options. I would have sold the call spread instead. But two traders, two trades. That's what it means. We're down 10 cents right now, or 10 ticks in ZN. ZB, we're only down 5. That is a very unusual move. Typically, you'll see bonds move about 2.5 times what the notes will. And we're not seeing that today. Not sure what that means entirely, but they're hitting the ZNs a little bit harder than the ZBs.
if we think about the long end of the curve in terms of inflation expectations, if the Fed's telling us they're going to have to hike more than they previously thought, it kind of makes sense to me that we would see long end yields not necessarily blow out, right? I always go back to September 24. The Fed gave us a 50 basis point cut. Yields went up because the market said, this is too loose of a policy. You're going to stoke inflation and growth. So there is somewhat of a read through on my end here where I'm trying to figure out in my head right now. Yeah, yields are up a little bit, but they could be up a lot more right now. And you look at ZB here and they're not up at all.
Well, that's exactly right. And there's a huge difference along the yield curve about the impact of an FOMC meeting, which is, again, we're talking about earlier this morning, is our overnight rates, okay? Overnight, literally. The banks borrow from the Treasury. 30 years out, 10 years out, those are a long way off. Hey, Chris, just for the sake of argument, could you pull up that 3-month T-bill yield, please?
You want to go to ETF?
It's okay. No, this is fine. Either way, whatever you prefer. It basically tells the same story. The 3-month yield, like Chris explained earlier, this is a price of a 3-month T-bill. To get the yield, it's 100 minus the price. And right now, it was trading about 4%, you said? Now it's trading a little over 4, earlier a little over 4%. You had some support and resistance lines on there.
Yeah, just drawing for what the implied price level is. So right now, we're back down to, actually, this is a new cycle low. The market's pricing in more hikes by December 2026 than it has at any point in recent weeks.
Right.
Not something to ignore.
That's a pretty steep jump in the 3-month. And, is that going to trickle down into the more consumer-sensitive rates? Who knows? But right now, ZB is only down 3 ticks, and ZN is still down 10. That's a pretty, again, it's not huge. We're talking about sub 1 point moves in these things. But still, 2 or 3 times, if ZNs are moving more than the ZBs by that amount, that's pretty significant.
Just looking at the breakdown here as we get ready for this Fed meeting, Kevin Warsh is going to be speaking in a few moments. Very, I know I sound sarcastic. I'm very genuinely excited for this. 9 of the 18 officials, Tom, pointed to at least one hike this year. 6 of the 9 people who voted for hikes have multiple hikes in 2026. All that's a good story. But until we actually see the market start to give up the ghost, I'm leaning on this key level here in the NASDAQ. It's very simple for me the rest of the day. I just want to see 30,000 hold. It was here May 14th. It was support here, 26th, 27th, back to resistance on June 9th, June 15th, June 12th, excuse me. And now it's a little bit of support here. So if we're staying above 30,000, the short put spreads that I put on last week and the week before in the NASDAQ, I'm going to hold them. I may even add another one in at this point in time. But I want to see 30,000. I want to see how the market reacts here around Warsh's first few words. You mentioned oil earlier, though, and when we get ready for Warsh to speak and obviously leave an impact on this market, oil has been slowly creeping back up here over the course of the session. Mm-hmm. It hasn't been substantial, but we're kind of getting pinned now near some pretty important lows that we carved out in April. You still feel good about the long delta trade. This has had a bit of a roller coaster today. It went up since you and I spoke this morning, and it's come back down, so we're basically back to where we were.
Yeah, I mean, this is. I'm not concerned. I'm still going to be bullish on crude oil for the time being in those August futures. So I'm short. I'm short put spreads in the 29-day options. I am short the 73-74 put spread. I'm comfortable with that. That's how I trade. Do I know which way crude oil is going to go? No, I don't. But I look at the probabilities, and the probabilities were in my favor in that trade, so I put it on. It is one of 80 positions I have on. It's just one part of a portfolio.
Just one part of the portfolio. Mr. Warsh is up at the podium right now, Tom, which is, again, so very, very exciting here.
Gripping news.
For all of us, Fed. I know you're a fellow Fed lover, as you so describe yourself on our internal chats. Me and Chris, the Fed lovers. 75.53 here on the S&P 500. It's a 32-point loss. We are off the lows. The low came in right after the reaction to those new dot plots at 75.14. So not a nothing bounce of 40 points right now here, Tom. Volatility is coming too. You briefly mentioned that. 1749 right now on the VIX. It's off the highs near 1810 or so. Is this ultimately the thing that equity traders care the most about the rest of the day? If volatility doesn't really get bothered and doesn't get out of bed across the curve, what are we doing?
It's certainly an indication. It's not the only thing that the market's going to look at. The market's going to try to absorb whatever inflation tea leaves it gets from Warsh's comments, or any other data that they can pull from it. But the VIX being, again, 1773, it's not panicking yet. It's not panicking. But more to the point, Chris, this is not complete complacency. If we were sub 15 or something like that, I'd say, yeah, the market is way too complacent. We're due for a sell-off. 1755 right now, yeah, with the volatility we're seeing in the SPX today, I'm not surprised by that increase. I think this is par for the course. Take note of it, but it is not necessarily, oh my gosh, I got to get short the market.
No, and we haven't really seen any of the major lows. I mean, Tom always said the 2-year, you don't need to pay attention to what the Fed says. The 2-year yield is going to tell you everything you need to know about which way monetary policy is going. And to a certain extent, that's right. When you look at the historical charts, the 2-year yield moves before the Fed actually does. The 2-year yield goes up, the Fed's probably going to hike sometime down the road. And when it starts coming in, it probably means they're going to cut sometime down the road. You really don't need to overthink it. But if we're going to go by that metric, then the 2-year yield, 2-year notes here are down at their session low still. And so the market is getting a little bit of a read-through that maybe Warsh and Co. are going to be a little bit more eye on the ball about this inflation problem. He said that inflation's well ahead of its 2% goal, and they're posing a persistently high burden right now for markets. Tom, I'm not so concerned about the politicization of the Fed. I mentioned this on air a number of times before, but before he passed away, Paul Volcker wrote a memoir, right? And in his memoir, he talked about the pressure that was put on him by the Reagan administration, by I think it was Steve Baker, if I'm remembering the name correctly, who called him in to a meeting right before the 1982 midterms and was like, "Look, we need you to cut rates."
Well, Howard Baker. Baker.
Okay, so there you go. And Volcker says, "No, go kick rocks. Like, we got to defeat inflation." And as I've read other books by Bernanke and by Geithner and by Greenspan, this is something that all presidents do. Bush did it, Clinton did it, Bush 2 did it, Obama did it. They didn't do it so publicly.
And Chris, you're absolutely right. The big difference, and I remember living through those days, the country was, the politics were less fraught. Okay. It was, you could disagree about what the Fed was doing without hating each other. Today, we hate each other. Okay. And that's the difference. People take the Fed a lot more personally, I think, than they have in the past.
People call me a Keynesian shill whenever I say anything positive about the Federal Reserve.
Right. Keynesian shill. People couldn't even... The people calling you that probably couldn't even define Keynesian economics. Forget that crap. Stuff like that is just stupid. But I will say, what all these genius economists seem to forget is that you can actually grow your way out of inflation, and that, I think, is the push towards cutting interest rates. If prices are high, what you can do is give people more money, basically get more growth to justify those higher prices. Companies will start manufacturing more products, eventually bringing prices down. It's a supply and demand issue. Yes, the easy and sort of most straightforward thing, got to increase rates, got to make people suffer, got to go through austerity. However, mathematically, you can get to the same place by easing rates. I'm not an economist. I hate those arguments. I'm a trader. All I care about is how I make money off this stuff. You want to go research this stuff, feel free. But there are two sides to this inflation coin.
What's the most interesting opportunity for you as we've seen the market evolve here after the statement as Warsh is speaking? The dollar's obviously still stronger here. The NASDAQ is now back in positive territory for what it's worth. The market seems to be comfortable with what Warsh is saying so far. He, by the way, this is a funny quip regarding this short policy statement. The policy statement's shorter, simpler, and just the facts. Thank God. I was so tired of all that nonsense they were putting in it before. I suppose. I like that little shot, by the way. I like that shot he's taking at Powell. He's like, yeah, that other guy, lawyer, way too chatty, way too chatty.
So I think it's very interesting that the NASDAQ is up and the SPOOs are still down. It's okay. It's a little bit of divergence. What's IWM doing? Looking at QQQs, Qs are up 40 cents. IWM up $1. The small caps are liking this, which is kind of unusual, Chris. Traditionally, small caps are a little bit more sensitive to higher interest rates, simply because they're growth stories. They might need to borrow some money, that sort of thing. They don't like higher interest rates. That's the traditional argument. They're rallying on this news. I think that's interesting. I'm short IWM. I've been waiting for a sell-off for a long time. It's never happened. I may have to add some short put spreads to defend that position. But I am still long. I think if you're talking about winners rather than losers and underperformance and overperformance, the S&Ps are underperforming, both NASDAQ and Russell. So I'm going to be bullish on the SPY right now.
Nice little bounce here in the S&P, right off of its 1 month moving average, that yellow line in the chart here. You're seeing in the NASDAQ, we never quite got down to the 1 month, and we are bouncing up, now up almost 0.2%. Even the Dow Jones, it hit a new all-time high today. That's usually bullish, I think.
That's crazy.
Right? And the Russell here, with just a little bit more of a push, its all-time closing high is 2988.60. We're at 2983, we'll call it here, just to round it out. So this is a market that is holding up. The tape is improving as we're making our way through this Warsh press conference, and I think the number one tell for us, TP, is the VIX. It looks like it's on the cusp of sliding right back down below 17 again here.
That's just sad, okay? Because I love volatility, and I love the VIX. And I know some people think it's confusing. I don't think it is. For what it is, as far as
1706 right now. You're getting your bounce here, Tom. You know, I think I'm gonna have to go over to M&Q, watching this bounce play out. What are the day's lows? 30,072. Should we add in something else? I mean, I've already been peppering in these positions here. Let's put in something else. Let's put in something else.
Or 1 day. I love the zero DTEs and 1 days for these things. A little bit slow in coming in. What's the future right now? 386? 390?
Yeah, I'm looking at the 5 days to expiration right now over in M&Q U6. And if we go just below the current lows, if we wanted to really pin this here, I mean, you're risking...
Yeah, I like that trade.
You know, it's interesting. It's interesting here.
Just look at that. All it comes down to, Chris, is the metrics on that trade. You have you can get about 30% return on your risk. If your max profit, load up that short put spread again for a second. Any short put spread. But there's fine. Look at the metrics on those trades. I can generate $27 of max profit versus what? $600 of risk. That doesn't seem like a lot, but the return on capital is actually pretty high. My theta, ignore that theta number. That would be it's not a negative theta trade. You're actually getting some positive theta with that trade. Ignore that theta number, but you have about a 67% probability of making at least a penny before expiration in 5 days. That's the kind of trade that I like. Again, that one gives you a 50% max profit versus a $150 max loss. Those are pretty good metrics, Chris. That's why I like verticals, selling put spreads, selling call spreads. The metrics are very attractive.
Tom, this is an attractive trade here. 29,900 is our 1 month average. Going just below
Chris,
there.
Yeah, Chris, you make $36 versus 163 max loss. That's a good risk reward ratio for 5 days.
Yeah, and just picking up little pieces, and I've already had a bunch of M&Q positions on here. So, but the one thing that we may need to take an adjustment of, because I was talking about this with Ilya here,
gold.
Is gold, because gold was looking pretty bad there for a hot second, and it kept selling off. Let's go over to 1OZ, where I just started layering into this. I mean, we're basically at the same price where we were when I first got in. It did take a dip below 4,300. I mean, gold, the rates argument there is pretty simple, and I love the technicals here, Tom.
Gold is weird. Gold is just weird. It's no longer the safe haven. It's not it doesn't attract the flight to quality anymore. It is, still kind of an industrial metal, I guess. I'm not sure if, China's buying gold, India's buying gold. I don't know if the central banks are loading up on gold anymore. I don't know. They were, but it was selling off during this Iran war stuff. I'm not sure if the strength. I'm bearish on gold.
This comment just came across the board from Warsh, and it may be the most significant thing that he said. He said that inflation's remit or the inflation task force remit. Apparently, we now have an inflation task force, by the way. The inflation task force remit is to understand the drivers of inflation, and he sees no reason to revisit the 2% inflation mandate until at least we get back to 2%. This is one of those silly conversations that some people have been having on the sidelines the past few days, that because we can't get back down to 2%, the Fed might as well just move their inflation target up to 3%, and that way we can actually start having real policy discussions again. That would be a nightmare for the market, Tom. Right?
Well, it's
silly.
No, that is stupid, and anyway. The whole point of this is the answer is out. We were all waiting for what he's going to talk about. They're going to sort through the details. What are the SPOOs right now? Are they up on the day?
Almost.
I had to close my platform.
Yeah, no, we're almost there. We're only down by 0.1% here, Tom.
Down 7.25. We're coming all the way back. That's why I am biased long in the S&Ps.
Tom, I think this credibility argument that we discussed a few moments ago may actually be the thing I want to hang my hat on here. Warsh is telling us that we got a 12-0 vote. He puts that at the top of the statement. By the way, we're not cutting rates like Trump wants. In fact, we're telling you that we may actually have to raise rates more than we previously anticipated. And we're not going to revisit any inflation target. We can't change the rules of the game while we're losing. We have to win the game first, and then we can revisit it afterwards. Those are good for Fed independence. Those are really reassuring things. So a little bit of a market bounce here, Tom. I'm still in the gold position. I'm obviously still in SpaceX with you. You and me, though, are going to take a brief break. Back to $200 here for SpaceX. We're going to take a brief break. We're going to go back to our regularly scheduled programming here. Thanks for stepping in with us on this Fed meeting day. In a little bit, we're going to get over to Tim Knight, of course, and then we'll go to last call and overtime as we wind down this Fed Wednesday. TP, I will see you shortly.
What is going on, everybody? Happy Wednesday and welcome back to Risk and Reward. I would love to say that it's the middle of the week, but as we traders know, it is not. We have a short week this week with Juneteenth this Friday, so it is a synthetic Thursday today, and I'm joined as always by my wonderful co-host Errol Coleman, who's looking sharp, who's doing red shirt synthetic Thursday today, if you will. How are we feeling, Errol? What's going on?
We'll take it. Red shirt for a red day on SpaceX so far today. Sold a few policies today. Got the Jake from State Farm comments time today too, so I'll take it. No, I'm excited for the volatility. I know this is the second day that options are being traded on SpaceX. I haven't dabbled myself, but being the first week, the official full week for SpaceX to be out there on the market, it's only right to take a few positions. So I'll be keeping everybody posted whenever we dabble in there a little bit.
Yeah, I went as Jacob from State Farm for 2 or 3 Halloweens in high school.
Did you really?
Because it was so easy. It's just khakis, red polo,
yeah,
and I just slap a "my name is" thing on me and write Jake. People loved it too. It wasn't like a cop out. People were like, "Oh, he's Jake from State Farm."
Oh yeah,
it's right
absolutely.
there.
I would.
Everybody needs a free Halloween costume out there. you probably have the equipment to be Jake from State Farm in your closet right now.
Yeah, I'll come to you to get a couple policies closed. Absolutely, if I see a Jake walking around.
Yeah,
great branding for that brand.
It is. It is. Yeah.
Are you in good
Did you
hands?
say Allstate just now?
Are you in good hands?
You must know that you're saying Allstate. Yeah. Insurance companies in general got good branding right now. I love the Liberty Mutual commercials. Which
one is that again?
They got Limu, Emu, and Doug. It's the Emu, the guy in a yellow shirt. Those are hilarious. I also love the guy in front of the Statue of Liberty that just says Liberty Bibberty over and over. Really makes me laugh. Big fan of that guy. We have an exciting show planned for you guys today. In about 12 short minutes, we will be joined by Andrew Rader, special guest. Options aficionado, gamma exposure aficionado. We're excited to have him on. But before we do that, we can jump straight into the Tasty platform, talk about some of your positions and today's market action.
Yeah, let's jump into the platform here. We got the Tasty Trade platform pulled up here. I guess we could start with SPY since we have that pulled up. You already know the go-to is QQQ, but we got SPY. We can't ignore, the regular S&P 500. We're getting a little bit of a sell-off today, a little bit of back and forth action. A lot of, I don't like to use the word manipulation, but a lot of clear liquidity grabs clearly on both sides of the market. And that's to be expected, especially with something like FOMC coming up today at 1 o'clock Central. So it seems that a lot of capital is probably on the sidelines right now to make a little bit more definitive decisions whenever that announcement comes out. So that's kind of the market that we've been trading in today, at least, very choppy. Some of the price action that we saw this morning, we put in some very prominent highs, some very prominent lows. Put in some new day lows, and then pretty much reclaiming and recovering back to pretty much near where we opened up today. So that's pretty much been the story all morning. Very choppy price action. If you're intraday trading today, it's one of those days where you got to just take what the market gives you from a shorter duration, because we can't expect any type of full continuations until clock Central. I'm curious to see what we get. Today's going to be the first day that we have the new Fed chair sitting in the seat. So I'm excited about that. I know we were talking about how Jerome Powell became a little bit of a meme. Your thoughts on this new guy coming in? Are you excited just to check out his presence in person?
Yeah, I just think this is a spot where, as a trader, a little change. It's fun and welcome. Shake it up a little bit.
You're kicking Jerome Powell to the curb.
Interested to see what the new memes bring on. It's a fun little shake up. I wouldn't say I'm kicking Jerome Powell to the curb. Respect him for all that he did. He was pretty good at the job. As many memes as there were.
Oh, he was. He played the role really well.
Yeah, he did. But it's a little shake up's fun. Keep things lively. Tune into the Tasty Live Show Instagram later today to see Errol and Jamal discuss the Fed results.
Yeah, we'll chop it up a little bit
live. Yeah, we'll be having a mini stream there. But yeah, obviously, market sort of just in a holding pattern here as we await what the new Fed chair has to say. I don't believe that it's not in the equation at all that he's going to change rates, right?
Yeah, maybe he'll be holding them there. That's going to be the consensus going into it. Maybe we get a surprise. I don't know. But with that being said, we got volatility upticking just a little bit there. As headed up to this binary event. Volatility sitting at 16.81. How are you kind of viewing volatility right now that we finally collapsed over the last few days? Finally.
Yeah. I'm just not. It would be hard for VIX to do anything that could surprise me at this time. And I'm not surprised to see us climbing up a little bit today. I suppose that this is a little bit more of a jump in VIX than I would typically expect. From the very slight downward action that we have going on today, but I don't know. It's sort of a nothing burger to me. Like I said, I don't really pay attention to volatility until it's over 25 in this environment.
No, I hear you. I'm kind of piggybacking off that same idea with volatility right now. Just kind of waiting on it for it to do something now. It's funny because again, when volatility was trading at around like 20, 21, 22, I was kind of sitting there a little bit like, do something, and then it contracts very aggressively. Now I'm like, okay, well, I guess we did have something, and now I'm really waiting for. I don't know what it's going to take to spook the market. I don't know, a surprise announcement with the Fed, I think could spook the market a little bit. I doubt we get a surprise announcement, but with that being said, volatility is sitting at 1680 right now. And again, that's relatively still high for what we've seen in the past, prior to 2020. I know we bring it up a lot, but I think we were kind of spoiled with the premiums and volatility we've seen after 2020. Ask guys like Scott and some other guys that's been trading over the last couple decades, they'd still tell you 16, 17. Pretty high based off of what they've seen.
Yes, it's what we've become accustomed to, and then the goalposts just continue to move higher for me.
They do. 100%.
My laptop has decided to take an OS update now. I clicked nothing, but I'm sitting here staring at a black screen with an Apple on it.
That's hilarious. No, I always press delay. I'll do it tomorrow. I'll do it tomorrow. Sometimes I'll update the computer tomorrow for like 2 years straight. No joke. And then I'm wondering why my computer's all slow.
Yeah, now it's just bricked. The Apple logo went away. There's nothing here, and it had the questions for the guest on it.
Looking
So
at your lovely
yeah, we're gonna have to rattle these off dome. We'll see what we got.
Gotcha.
You're still short the Qs, I see.
Yeah, I'm still short the Qs. Sold an out of the money call spread there. Again, sold the 755s, bought the 760. We collected about $1.69, so just about 3 pennies over a third of the width. I'm pretty what's the word I'm looking for? I'm pretty meticulous about how much credit I'm really receiving on these things. I really don't want to go underneath a third of the width, right? Like $1.66 is really the sweet spot. Would love to collect a little bit more, but anything under $1.66, in my opinion, is just not going to be as worth it. Just because, again, the less credit you take upon a defined risk trade, the more risk that you have overall. So it's like the more credit that we can receive up to that $5 width, the better. 50%, you're probably pretty close to the money, and then you're playing with fire a little bit there. But it is nice to reduce that risk, get a little bit of extra reward. Some might argue just sell the strangle, just sell an undefined risk, get a little bit more profit under your belt. But you can always sit very comfortable in these swing positions when it comes down to trading the broader market at least. So we'll keep an eye on QQQ. And as we have a couple minutes here left before we have our guest come in and join us here in about a minute, check out SNDK. It's funny, whenever we bring this up, it kind of surprises me how impressive this move has been. I'm still going to be patient to get on any type of short delta in here. But SNDK and Micron still putting in legs to the upside. And has not really proven any type of backside just yet. So we'll stay patient there, but that's kind of what's had my eye. And lastly, before we pivot here, we can take a quick look at oil. And let me know your guys' thoughts on oil. How are you guys kind of positioning right now? I know we had a lot of traders in the Tasty Live community already getting a little bit more short delta onto the downside. Now that we've had 3, 4, 5 consecutive days to the downside, and we've even took out yesterday's low, put in a new low for today, recovering a little bit there now. But I'm looking at a little bit of long delta. I want to get on a little bit of long delta. Might use USO to get a little exposure to the oil market there. But let us know how you're kind of viewing oil right now. I know there's still more headlines coming out about how things are okay with Iran, and it's allowing a little bit more air to come out of these oil names. But we'll keep an eye on it. Oil definitely seen a little volatility to the downside, though.
Well, I'm being told in my ear that we are ready with our very special guest for today. We can bring him on in. This is Andrew Rader. He is at Rader Trader on TikTok,
good to see
Instagram.
You guys.
Good to see you. How you doing today?
Good, doing well, man. Exciting market. Lots and lots to talk about.
Yeah, Andrew, you wanna do the plug yourself, or would you like me to do it for you?
You can do some of it. I'll finish the other half for you. How about that?
Sure. Andrew, he runs the RaderTrader.com, which is a website predicated on the idea that options pricing increasingly drives the pricing of the underlying asset, not the other way around, particularly as it pertains to gamma exposure. He has a ton of very cool proprietary tools there based on this idea. Did I do a good job there? Anything you want to add?
Yeah, you did. One correction, it's the RaderReport.com.
RaderReport.com. Yes.
Absolutely
apologies.
fine. No, you're good. To build on that, though, there's a lot to kind of what I've done in my life. I'm very young, but I really did start out with a focus on options. When I first got into trading to begin with, a big interest of mine was, well, wait a second, if you're talking about trading, there's this really, everyone was like, hey, trade equities, it's safer, all this, but when you look at it, if you're a trader and you have edge, and edge is only within a defined time window, and you believe, this is going to play out during this time window, then there's no better asset or, way of expressing that idea than options. So I was really interested in that. And through my, several years of research, I was able to develop a few different tools that I think are unique to this industry, but also just build off of knowledge and take it to a professional level as far as how I trade with derivatives and stock alike. So,
yeah, no, that's awesome, Andrew. And I'm also curious. I know you're kind of an options guy yourself. What kind of got you interested in digging a little deeper in terms of option flow and gamma exposure?
Yeah, so I mean, over the last 10 years, even, you do a lot of reading of what options are, and there's a few great pioneers in this industry. There's people like Jem Carson and other voices to help point people towards this growing, not problem, but growing, influence of options on the 100%. Underlying market that even Charlie Munger and Warren Buffett have made comments before regarding that they believe options, they're concerned about them because they're starting to take over the market and to some degree influence them way more than just the traditional stock market. And that's, I'm sure a lot of your viewers know already, but the volumes in options have been exponentially growing as product issuance grows, as the demand from institutions to hedge these massive long positions grows. You need more options. And with that demand for options, you have a bigger need from market makers to influence the underlying price because they need to, hedge out their risk for providing the supply of options. So there's this really interesting dynamic there that ultimately has influenced the markets.
No, I love that. And then also, I am curious again with the options flow. What are some of the most common products you like to view the options flow from? Is it usually the indices like QQQ, the ETF for NASDAQ, or how do you kind of, view the options flow, and what kind of options have the necessary liquidity that makes it attractive to view that gamma exposure?
Yeah, so when I first started out looking at option flows, I started out with the big names and names like Nvidia, Tesla, etc. But what you then realize is that individual orders on stocks like that are far more impactful or less impactful than something which has a massive derivative order on a stock that had previously no option volume.
Yeah.
So there's this really interesting dynamic of, well, how do you balance that between one big large order and the market cap of the stock? But over time, I've really narrowed my focus to kind of what I expect flows to actually do. A lot of people look at individual orders. There's a lot of services like Unusual Whales or where they track political or even just unusual option volumes. What I typically like to look at rather is just the and this is what I kind of built a tool around, was basically looking at the total flow volume. So, and ranking that against historical readings of that stock, because that way, a $5 million order on Tesla is not going to be the same impactful order than a $5 million order on something like Kohl's, KSS, where there's no option volume. So,
Andrew, give us a little
just.
No,
Yeah,
didn't mean to cut you off. I'm sorry, but if you don't mind, we have you on here. We're here for a little bit of the sauce. Give us just an idea of some of those playbooks that you like to deploy into the market. And then I assume you use some of those tools that you like gamma exposure, options flow, to then gain a little bit more confidence and conviction in terms of what you're doing. But what does a playbook trade look like for you?
That's great. Yeah, there's a bunch of simple ones, and I'll just give you a time-relevant one, and then I'll kind of give you another, maybe a more classic one. But even with SpaceX yesterday, you guys know that options were introduced to SpaceX yesterday.
Yep.
And there was a big run-up into SpaceX, and because of how big of the run-up was, you guys saw in the after hours that it spiked to 230 after already 2 days up. It hit that $3 trillion market cap in the after hours, and then we opened right around 2:15 at 4 a.m. on SpaceX. Well, a simple playbook there with options is just simply anchoring in the idea that with options now unlocking, you have a lot of people, institutions who are unhedged, who are long SpaceX, and hedge funds who are buying them would like to hedge because it's up so much. So the thesis there is that you can expect a lot of people to buy puts, and that's going to drive a lot of selling pressure because, again, when you as a participant go and buy puts, market makers sell you that put, and they have, naked exposure to that put, which they can take an infinite loss on, so they have to sell equity to hedge. So that creates selling pressure on the market. And, the thesis yesterday, which was actually a PR trade in my career, was shorting SpaceX to have that. Now, there was that first move up that squeezed everyone out, but on that backside, you can see even today, it's just melting lower. And that's, again, just a very simple playbook of, with IPOs in the future, such as OpenAI and even Anthropic coming up, you can deploy this idea and really look for, if there's a big run up into these option unlocks, there is a very strong case to say that they could go down.
I love it. And, zooming out a little bit here, obviously options are traditionally the focus of the Tasty audience. But as your research suggests that options markets increasingly drive price action rather than just reflect it, do you think we're at a point where the tail is fully wagging the dog here? And if that's the case, what are the implications for traditional investors?
Yeah, sure. So I think this is situational. There is increased magnitude of, impact during certain market environments, and less so in others. So, for example, when you're in a market where, markets have been extremely quiet. So I'll give you, this will kind of lead into another playbook. But I think we're not quite to the point where the tail is being, the options are fully wagging the market per se, because at the end of the day, it's ultimately about stocks. And where options really thrive is not only boosting the volatility of these stocks, but adding, a little bit of a deeper layer of information that you don't get otherwise in the equity markets. So, for example, one of the other playbooks I was going to tell you guys about is just really simple. It actually worked out on June 5th. on SPY, where it's super simple. And you kind of just expect, it's called what I call the Jex flip playbook. So whenever you have a run up in a market where it's just positive gamma, positive gamma, positive gamma. So, 10, 20 days in a row of the market's really healthy, really green, indices and positive gamma, their ranges are compressed and they're just climbing higher. All of a sudden, after, a 10, 20-day period, you'll see one day, whether it's a catalyst, like it was on June 5th, kind of gap it down below the negative gamma Jex flip. And when that happens for the first time in 10 to 20 days, what you actually get is a very simple playbook. It is in the morning, you want to look to short pre-market lows. You want to look to, buy, basically short anything with 0DT puts or with equity, short a pre-market low or first opening drive or break. And then into the afternoon, this is the one I like with 0DTs, is taking an afternoon roll. So oftentimes you'll see it bounce, either come up to that open or below the Jex flip, and then it'll start to roll over into the afternoon. And the kind of mechanics there is that in the morning, you'll see that IB spike. Into the afternoons, volumes decrease. All these 0DTEs start to decay, causing a bounce, market makers buying back equity. And then as those decay happens, that afternoon roll can give really great prices for 0DT options because they actually decay often more so than even they were at the morning. So you get the same price, but a cheaper contract. Really simple playbook there. But yeah, that's kind of where I'm leading to. Yeah.
No, Andrew, I had actually peeped some of the entries and exits that you took on SpaceX. I had seen that screenshot. So you're a little bit of a scalper sometimes. Sometimes you'll take more scalping opportunities if the volatility is there. Or how do you view that? Is that accurate?
Yeah, so we, trading at a professional desk, there's a variety of different strategies you do. You're expected here to trade a variety of strategies based off what the market environment is. And something like SpaceX is not you can't short this as it's going up 3 days in a row, super strong, and expect it to go down to zero. So it is a move-to-move trade there. And so because we didn't have options, we have to really trade that with equity. But there are instances in significant runners where we'll throw on something called a hedge trade, where, for example, on CAR, what we'll do is grab calls in the short term because we believe CAR, as you could kind of see it break through 200, 300, it's going to turn into an overextension eventually, right? It's going to come back to earth eventually. And because we know that, what we can do is throw on some calls and say, we're going to be long until it's a good short. Because right now it's a bad short. We know it's a bad short. We know what a good short looks like. And so what we'll do is we'll be long calls against short stock when it starts to turn. And that way that we have protection, and that we can actually, when that finally unravels the CAR, we can load the boat short with equity, still have a cushion of calls, and then be able to sell those calls to have a bigger stop. So that's kind of the different dynamics we'll do. But most of the time we are scalping intraday, but the big trades we take at the desk are definitely swing trades.
No, that's awesome. What's kind of the threshold? I know I'm pulling up CAR right here. You were speaking about the CAR ticker, right, where we had that kind of parabolic move and then that blow off top. What is the threshold to start buying these calls, to start hedging that position when understanding that the top could be near, right? We don't know the exact top, but what is the threshold for when that hedging becomes a little bit more attractive?
Yeah, so it's really interesting because when you talk about a playbook, one of the most important things for any traders is to have the best examples. Go out and grab 10, 20, 30 examples of how this trade plays. So, for example, this was a daily overextension short. And so if you can recall different setups such as Silver, such as Circle, such as even prior names like MSTR in 2024. These playbooks, what you'll find is in the final innings often of these daily overextension shorts is you get expanding price and volume. It kind of looks like a cellular service on your phone. Expanding price and volume, starting to go parabolic. Dollar volume is increasing at higher prices. And once that starts to happen, once implied volatilities, again, with options, become so unsustainable, the argument for a top becomes stronger and stronger. And so for something like CAR, what actually happened was, or even Silver, this is a great chart, Silver or Gold, was you had the biggest gap in the last 4 days. You had just a tremendous blowout of that first kind of red day. And that was like, okay, this is pretty crazy. Like having the biggest gap, one of the biggest gaps in the trend so high up at these altitudes is a big sign of exhaustion. And so off the morning, you're looking, hey, how can I position into options short now that you were long calls? But specifically for when we're deploying long calls, it's often an uncomfortable place when we're like buying highs and we're like, we have to have an imagination because you're buying calls at a really uncomfortable place, but that's where it gives really good edge because not a lot of people are expecting to continue higher. As far as where we're looking to hedge, it's really when those big gaps come in, when huge volume to the upside or an unsustainable move happens. And in the case of commodities, oftentimes the moves were after hours, so we were positioning short in the early AM or PMs.
Absolutely.
Fascinating. Yeah, and I would ask as well, circling back a little bit more into your framework, but gamma exposure, open interest, these things are becoming more popular. And as those tools grow in popularity, do you think that there's any risk that your edge gets arbitraged away? Like at what point would you begin to rethink your framework on those things?
Yeah, what I like to say is that I believe that options data is incredibly powerful. I think some of it can be turned into automated strategies, or at least, but what ultimately to me options data is a tool in my toolbox. So for example, open interest. What can open interest give us from a basic information standpoint? It can give us levels of importance. It can give us locations where we can expect maybe a turn or something like that. But what it can't do is say, I'm going to buy off the biggest open interest strike every time and make money. We know that doesn't have edge. And so we have to kind of work that into a different playbook, a broader playbook. So for example, if you're a breakout trader, how can I work options data into it? Because it can give you a lot of data. Well, for example, if you have a stock like ARM, which was recently breaking out into all-time highs extremely aggressively, you don't have any frames of reference for technical analysis to the upside. And so, there's no equity volume you can really see. So what are the best ways to look at maybe some levels? Well, definitely the options positioning, because that can give you a level of information that you can't otherwise get in the equity chart or the price chart. So using options like that, but no, I don't think there's a few things in the market that will never be edged or eroded away, rather, and that is human psychology, and that's going to stick around forever. Breakouts have been working forever. If the stock is on a catalyst and it's a good one and people want to buy it, no matter what institution is out there, they're not going to be able to arb that out. And so for stuff like options, especially, options are always going to be mispriced in some areas of the market. Options are always going to be the best vessel in underpriced for what could actually happen in the future because it can't see everything in the future. So things like open interest, those, and even like option volumes, those I think are here to stay. And it's nice that you can talk about them and not worry about that.
So what you're saying is human behavior never changes and kind of repeats over time.
That's for better or worse. Yep.
I know
that's a great answer. I mean, that's something we talk about all the time. Is it's all the markets are just one big psychological thing, and
100%.
And human psychology is never going to change on you.
Absolutely, we exaggerate moves to the upside all the time. We exaggerate moves to the downside. Quickly, I know you had mentioned some of the data points or some of the criteria that you'll have for some of these playbook trades. You mentioned dollar volume for a moment. Is dollar volume something you track specifically on these parabolic type moves? And then also, are you just taking the average volume traded that day multiplied by the average price traded, or what are you looking at there?
Yeah, there's a few simple ways you can do it. You can literally just do dollars, the stock times the volume traded on the day, or some people do it from VWAP, like what was the shares traded at VWAP, and things like that. I think, to keep it simple, dollar volume is just an idea that, you're trading big volume at higher prices. So if you have a day with 10 million volume, and then the stock's at $100, and then you have, it goes up to $400 the next day, but it only did 8 million volume. Well, just because it did 8 million volume, it did less volume. The dollar volume was still insane. And so it was way more because it's 4 times the price. So it's harder. Even though it did less volume, it's still harder to sustain. It's extremely difficult to sustain that. So I think not a lot of traders look at that, but just keep it simple. Like something like silver or SMDK had this very situation where you're going at higher and higher prices. If you want to short something that's going up that much, you would hope that the volume is also increasing, because ultimately what a daily overextension short is unsustainable price action over a certain period of time. So what is unsustainable? Well, you have to define that, and it can be easily defined with volume and dollar volume.
Yeah, absolutely.
Absolutely, yeah. I would say, and I mean, you can keep this brief if you'd like, but options volume and structured product issuance have really exploded over the last decade. What's one market behavior that you would say exists today that simply didn't exist 10 years ago because of this explosion?
I would think just the pure violence of momentum we're seeing. I mean, we're seeing breakouts. I mean, think about this. Like, we're seeing some of the biggest companies in the world make $100+ billion moves and breakouts in a matter of days. You know, it used to take weeks for something like ARM to get to those prices, or it used to take weeks for memories to explode that high. And now we're getting it in 3 to 4 days. And if you miss that 3 to 4 day window, it's over. So just the sheer opportunity that we're getting now is of what you can make in multitudes over a shorter period of time is insane. And I think that's why you're seeing a lot more traders. I mean, even if you guys are into like the Market Wizards books and stuff, you're seeing a lot of people become breakout traders and make an absurd amount of money. I mean, I think the market, are we from?
Raider on Instagram and TikTok, theraiderreport.com. Be sure to go check out all the wonderful tools that he has there. That's all the time that we're going to have for today. We'll be right back here on the network
thanks so much.
Later today at 1:30 p.m. Central Standard Time. Be sure to come hang out with us. Like and subscribe to the Tasty Live YouTube channel so you don't miss what we have coming up next. We will see you guys next time.
I didn't realize he's a trader at S&P Capital.
Thank you.
He's an actual.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive? Uh-oh, watch yourself. We don't want to get hit by a car. My brother did that once. He can't talk now.
God, that's serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11? First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Hello, everybody. Happy Warsh Day to you. This is Kevin Warsh's first FOMC, his first press conference. I watched it until I had to click the camera over, so I missed, I don't know if he's still talking, but I missed some of it. Interesting fellow. Spent part of his time here in my fair city of Palo Alto, at the Hoover Institute, at Stanford. On the one hand, he is obviously exceptionally intelligent and well-credentialed. You know, Stanford, MIT, Harvard. Don't know if MIT, I saw it in there somewhere, but yeah, Harvard Law, Stanford undergrad. So sharp fella. Little slick. Definitely different style than Jerome Powell. Jerome Powell was sort of this avuncular chap. Whereas Warsh, I feel like I'm being sold something. He's a, you know, just a very different tone, different style. Not incompetent at all or inept, but just, yeah, a little smooth for me. The initial reaction to the Fed's announcement of no change, but kind of hawkish. He doesn't want forward guidance, but I guess whatever came in the guise of forward guidance made the market tumble. He undid that right quick with his words. But we are red again, but just barely. The NQ and the RTY are both green now. The ES is still a little bit down. For my own portfolio, good day, very good day. Yesterday was a nice day. Today's another one. Just some really good results across the board. No real screw ups. So far so good. Got some charts for you. So let's dive in on this penultimate day of the week. And we begin with the diamond, the Dow 30 ETF, which had an intraday lifetime high. We're way into the 50,000s now. When I started trading, it was strange because like the Dow was like, 1,500 or something like that. And I always marveled at the Nikkei because the prices seemed so preposterous, like 48,000 and so forth. It seemed like just silly high numbers. Well, that's us now. We've got a Dow way into the 50,000s, and at the moment it's down a touch. We're above our broken trend line again. I don't know. There's opportunities out there. I'm in 35 different short positions now. Almost all of them profitable. I'm tempted on this one. It just keeps kind of 3 days in a row of lifetime highs. But yeah, it's tempting. Got my eye on you, Mr. Diamond. Now here's a red bar we haven't seen in our lifetimes. SpaceX. It's funny. I mentioned this to Liz this morning that it's a little nerve-wracking for me because after my show each day, they'll package it into a YouTube video and they'll slap a few words on it, kind of like have some poignant bullet to grab people's interest. And yesterday's, I think, was along the lines of like me calling the SpaceX top, which sounds kind of definitive. I was really nervous to wake up to 250 on the SPCX. So far, so good. That lifetime high has held, which is about 228. I include overnight trading because it's been very active overnight. But on a day basis, this is our first red bar. I imagine it'll close red. Interesting stuff because it popped 50% in its first couple of days as a financial entity. But now we're seeing some selling and have the digit 1 as the leading price quote. I think we might see some more selling here. Like I say, I think no serious selling is going to be permitted until August 11, but there are holders out there and they could still drive the price down. The cubes, very interesting item here. Okay, we're down at the moment. When I started the show, we were green. We're red across the board now. I'm sort of annoyingly glancing at my screen over here because I want to be short Bitcoin, but I'm not, and it just keeps plunging. So when you and I say goodbye to one another, I'm going to scurry over and punch in some trades. But the cubes did something very cool today. Check this out. Look at this gap. Check that out. The low today almost exactly sealing the price gap up. What do I want to see? Well, what does the perma bear want to see? Of course, I want to see it fail. Hasn't done so yet. So that support did hold, even in the hardest selling. It's got to break it for us to get some real action going. But that's really cool. I love those gaps. Crude oil is stable right now. The excitement over the whatever you want to call victory or surrender, whatever term you want to use, the cessation of hostilities with Iran. It's like, okay, and they're done that, old news. And as I said yesterday, I don't see crude heading to $10 a barrel. It's going to be in this range for a long time because there's a lot of damage out there. XOP, the ETF for energy companies, continues to sink. Beautiful right triangle pattern I pointed out a few days ago. So far, so good. It's gingerly moving lower. I wish I had more energy exposure. I wish I was short Bitcoin, as I just said, to tell you the truth. But I've only got one energy short, which is Halliburton. I had been short Schlumberger. I covered it for no good reason. Shame on me. That's taken a real tumble today. But yeah, XOP continues to slip. Oh, here's SLB, just to twist the knife a bit. Down 4.4%. Below that sort of head and shoulders top. Looks good. So, energy assets in general, gold and energy stocks and techs, everything's slipping red. Yeah, I like what I see. Yesterday was the beginning of kind of peak good news, as I talked about, and for whatever strange reason, the market seems to like to sell off after the federal chairman, whoever the person may be, walks away from the podium. And it's happened again today. There was all this excitement about, oh, look at him, look at the stride he's taking, up to the podium. And then after it's done, it's like, sell everybody. I don't know why. Always seems to happen that way. Probably a pretty tradable reality for you. Gold, and I'm going to pick on this a moment. I might have stumbled across a bug here. I'm not sure. Gold is down hard. And I talked about yesterday being short gold, more specifically being long gold puts. It's not reflected here on a daily chart. If we change this to like a 30-minute chart, it's very much reflected. So I think maybe a little bug there, engineering team, on this futures quote. The daily data seems to not show this information. I don't know why, but this one does. And so this is a 30-minute bar, and we're seeing a nice wipeout there take place with gold as God intended. I'm short also EQX, which is Equinox, not the fitness company, but the miner. And there's a beautiful head and shoulders top on that, and we're reversing away from that nicely too. I think all the precious metals are going to go down: silver, palladium, silver miners, you name it. Over in the wonderful world of semiconductors, I'm still obsessed with NVIDIA. I'm short this. And I think that it's going to be an important bellwether for semiconductors in general. A lot of the high flyers like Micron and Applied Materials and the storage companies, WDC, STX, SNDK, they're just in la la land. NVIDIA seems to have a firm grasp of reality here. And my main man, Ed Zitron, he's been getting a lot of press lately because of his revelation that OpenAI is losing even more money than originally revealed. It's just like billing is just blowing up in dumpster fire. And people are like, all the hyperscaling thing, all the AI thing, starting to have their doubts, and they should. And so NVIDIA, I think, is kind of recognizing that. The other stuff is just feeding on itself. And, a reader of mine said, hey, you should short ARM. The fundamentals are crazy. It's like, no, I'd love to, but it keeps going up. Shorting something because it's insanely priced, unfortunately, isn't a great reason to short it from my perspective. I'm a chartist at heart. I need to see some kind of breakdown, some kind of reversal. In recent days that I've tried to do such things, like, gosh, WDC looks like, a bamboo skewer plunged into the earth perpendicularly. It looks ridiculous. And then I lose on it. It just keeps going up. So when it falls, great will be the fall of it and all the others, but it's you got to get the day right? Here's SMH, which I've obviously bearish on too. This was the day I shot my mouth off about, this is like, an amazing opportunity to short it. And worked out great as of yesterday. Today, we've recovered a portion of yesterday's drop. I don't think it'll last. I think something bigger is on the way. So I've continued to, those are January puts I've got on that bad boy. SNDK, I made mention of that, is up $18, but it too is teetering right at that trend line there. For the bolder among you, you might want to short it. I'm not, but it's crazy expensive. Speaking of Stanford University, one company born there was Snap, Evan Spiegel. You may have seen they introduced their new product yesterday, Specs, S-P-E-C-S. Good heavens, they're ugly. The reaction was not great. The high yesterday was in the midst of the announcement. They're basically augmented reality sunglasses. And yuck. not an attractive accessory choice. I think it's going to bomb. I think it's just going to, because Apple, which did a superb job with the Vision Pro, that was a bomb. But this one is going to be, I don't think it's going to do well at all. I think the market recognizes that. They've been trying to save, because in the midst of social media companies just becoming worth trillions, Snap's been like so yesterday's news for so many years. All they do is go down. They've been trying to turn the place around. I think at one point they renamed it Camera. I think they did, or either intended to rename the company Camera. That didn't happen. But I do not think this is a turnaround story. I think this pattern here will not produce much different results than, say, this one did. Like so. The only difference means 0 is a lot closer in terms of support. Some other shorts I got cooking. This one's not a surprise how good it is. Intercontinental Exchange, ICE. This is a big brokerage. Look at this beauty. Oh my goodness. Is this magnificent? Look at that. Good heavens. It speaks for itself. I don't have to say anything else. That is a gorgeous chart. Yay. Microsoft, I made mention yesterday that they should be ashamed of themselves for sucking so much in this bid everything up market. And I said yesterday, anything that can behave like this in this absurd market of ours deserves to go down forever. They must be so broken. They must have so many troubles they're not talking about. Oh my goodness gracious. What a dog. In a bad sense. Spot is Spotify. They're also sinking. 35 shorts. I'm not going to show them all. These are just some I wanted to highlight. Here's Donkey Kong, DKNG, DraftKings. The magical changing pattern. Okay, we're just going to go to Poink on that one. But this one is also down nicely, over 6%. And this sucker, we could probably drag him down like so. So these are all working really well. Yay. Google. I shorted this one, and as big as it is, this is not something I've either hardly ever traded or never traded it. It's just like usually really boring. But I shorted this yesterday, and so far so good. We're down almost 3% on that. So that's working out. Oh, this Bitcoin's killing me, man. My trading fingers are itchy. Meta, which I have nothing but disdain for. I shorted this yesterday again. Down about 4.5%, and I think long term they're in dreadful trouble thanks to the leadership of Alexander Wang and their acquisition of his organization. So yeah, heading lower, and oh my goodness, my favorite, the chart of the day. I showed this morning, Carvana. I'm just in love with this. I mean, it's almost so obvious that I feel awkward because I expected to double tomorrow with some surprise announcement. It's just, I'm trying not to shoot my mouth off about it because it just seems too easy. It seems too obvious, but I am nuts about this chart. Carvana, yay. Bitcoin continues to plummet. Oh, here's Bitcoin. We're down quadruple digits on this. I talked about maybe a rally to 70, 71,000. We may have to endure that. This may be it. It may have exhausted itself 2 days ago. So that could be exciting. So this is our new resistance, that line right there. And one last sneaky one, strategy, MSTR, down for obvious reasons also. So anyway, I'm going to go short some more Bitcoin now. I hope you're having a good day. Congratulations to Mr. Wersch for his first press conference. It seems to have handled it adroitly. And I will see you tomorrow during the last trading day of this week. So, see ya tomorrow morning, actually, and also tomorrow afternoon. So take care. Bye-bye.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately has turned into 100 shares of long or short stuff.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Grow a strong community.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Ring the alarm, hey, ring the alarm, boys. Turn up the charm. Listen up, y'all. Get out the damn stall. It's the last call. Hey, the last call. The last call. The last call.
Jamal, we're back. We're here for the final 30 minutes of the trading day. You're watching Last Call on Tasty Live. I'm your host, Chris Vecchio. He's Jamal Chandler in the co-pilot seat here, and we are arriving as markets go into session lows, Jamal. We can go right to the charts, Laura. NASDAQ, 30,078, down 0.8%. The S&P 500 off 1.3% now, giving up the gap that we had from the end of last week. We closed last week at 74.98. We are now closing that gap here, off 1.3%. Dow Jones off 1%. The Russell off 0.8%. Bonds, notes, they're seeing a little bit of weakness here, getting rejected again at key levels that have been keeping us, well, with a lid on us for the past several weeks right now. The 50-day moving average rejected here once more, Jamal. So yields are up, stocks are down. Surely that's bad news for gold, which indeed it is, down 2.4% here as we're making our way through this trading session. Volatility is up. Gold's off $150 from its high right before the Fed meeting. Volatility is up here, Jamal. VIX now in at 1837. A lot's changed since I got off air with TP just about an hour ago.
A lot has changed. And you know what? There's a task force for that. That is definitely the word of the day. Oh my goodness. Can we just talk about how interesting that was? It's very fascinating. I want to get, I mean, look, I watch these things, but I defer to you when it comes to takeaways from what Kevin Warsh said. What are your takeaways on this thing?
Obviously, it wasn't as polished a press conference as we're used to. But I think people should go back and look at Powell's early press conferences. He was not the same kind of public speaker in that particular context as he was towards the end of his term. So a little bit of jitteriness and nervousness, and people said he was a little stiff. Okay, it's his first time doing this. Like, cut the guy a slack in some regard. But also, inflation task force. Jamal, isn't the FOMC the inflation task force?
I mean, that's what I thought.
Is it their job to do that stuff?
That's what I thought. Yeah. You need a task force for the task force, I guess.
I suppose. It's always good when the people who are charged with controlling inflation have to bring in, the consultants
right.
to figure it out.
Yeah, it's a trip, man. Look, what I've been obviously had my eyes glued to is the SPOOs. Kind of typical in a way, even though it's a different person. We're seeing something that we've seen plenty of times before. The markets are sort of teetering there, and then as the statement is being made, as he's talking, and then after the meeting is over, we see a little release here. So I don't necessarily know if this is as a result of the somewhat hawkish tone today. Speaking of, it's starting to seem like we might be pricing in probably about 2 cuts maybe by the end of the year, I think, at this point. Again, this is all so quickly. This is just right after the meeting. We'll have to let some of this shake out. I don't know how much this move means currently. The S&P 500 E-minis are down 91 points below that 7,500 handle. So we were just at 76 earlier today. Now we're right at 7,500. This is not a huge drop by any stretch of the imagination. As a matter of fact, S&Ps are taking it more on the chin than the NASDAQ is. So techs aren't exactly bearing the brunt of this selling. I'll tell you that. I mean, hell, I'm looking at Intel. Intel is up $4. And Marvell's higher than it was earlier this morning. So it's not the semis. It's just the other stuff, I would say. And again, this is also an interesting day in that we had a VIX futures expiration. June VIX expired today. So it's just kind of, and this happens on Fed meetings at times. Obviously, since they occur on Wednesdays, we have some Wednesdays where both happen. So I think it's a little bit of that, honestly, Chris, where we're seeing these moves. But the one thing that definitely stands out is the dollar. Big move in the dollar, I would say, and that's what's causing gold and silver to falter.
Gold is having a really terrible session. That U.S. dollar right now, we have to go to a 12-hour chart because we got the open outcry close. We're approaching the highest level that we've seen since March right now. Dollar CAD already started to break out. But Jamal, before we get into the FX of it all, you mentioned something about the stock market. It's down 1.23% here. Not so surprising. How often is it the case that we get the S&P 500 down more than 1% or more on a FOMC meeting day? I did a little scan here going back to 2010, 15 years, I feel like. Let's just see. Nothing in 2010. So 2011 is when this starts. There are 15 occurrences since the March 15th, 2011 FOMC meeting that have produced a sell-off in the S&P 500 of 1% or greater. My question is, what happens next, obviously, in this observation? Typically, across those 15 instances, so not quite a great sample size, right? N equals 30 is our statistically significant sample size, but almost there. The average for the VIX on those days, the VIX closed on those days an average of 24.08. Okay? What returned the next day average return was negative 0.48% for the S&P 500. So tomorrow's Thursday. Right, we're not going to get a full. So 2-day return going out to the Monday close would be negative 0.56%. A 3-day forward return is negative 0.68%. But 1 week later, by this time next week, right, by the close on next Thursday, the market has averaged, again, what happens when the S&P falls by 1% or more on the day of a Fed meeting? Since 2010, the 1 week forward return has averaged plus 0.21%. So there is a little bit of a shakeout and a shock here today. Maybe it continues to bleed lower the next few days, especially if volatility goes up. But if the VIX hangs out and stays below 1920 or so during whatever little correction we're going through here, it's probably going to be something that you want to fade.
Fade the VIX?
Fade the volatility spike, fade the move lower in stocks. Not this week, but probably next week.
I was about to say, I'm literally executing on the idea that you're talking about right now. What are you talking about, fade? No, I agree with you. I am fading the idea as far as going to the downside. I'm buying some calendars. I'm glad you said that. I just did one. I did this yesterday. I mentioned it. And so I'm doing another one now. That one obviously is not going to work. That was actually short the Fed, long tomorrow. Now I'm going short tomorrow, long Monday. To your point of the data you just gave out. Doing the $7,600 calendar spread. $6 is a little chunky, but it is SPX. Sometimes they're a little chunky.
They can be a little chunky. We have a lot of negative market breadth coming down the pipeline here, according to our man behind the screen, Frank. In terms of that breadth, 70 stocks in the S&P 500 are higher right now. 428 are lower. Not great. 22 million options traded in SPY, SPX, triple Qs, and IWM, with 3 million Tesla and almost 3 million NVIDIA. MAGs are taking it decently hard today, Jamal, down 3%.
Yeah. Well, Matt is the one that's getting really beat up, and Microsoft is too. They were kind of getting beat up before this. I believe, I could be wrong. I don't think they just went lower into the meeting, but they were already down today. Microsoft and Meta specifically.
This is the 9:30 open for Meta, 596. We get to the Fed meeting here. The statement's released 580. We get to the press conference. It's trading, 575?
At that point, you're just following the market. And again, these not only are these NASDAQ stocks, but they are in the S&P as well. I think it's interesting. It looks like the NASDAQ might be catching up a little, but the SPOOS is bearing the brunt of the selling here.
30,000 NASDAQ went through like a hot knife, Frank says. Can't agree.
Sure did. It did.
Can't agree.
It's true.
And, this raises a little bit of concern for me here because I'm watching this 4-hour close. I want to see this close above 30K today to keep on some short put spreads that I put on last week before the market rallied. If we get a close down below here, I'm probably going to be partial to just taking them off the table, Jamal. I really don't like the fact that we're seeing some of these key levels that have been both support and resistance. You can just draw a line on the chart. Resistance, support, support, resistance, resistance, resistance. There should be support.
It should be, but we don't get these opportunities that often, you're already in it. For those who don't have any, I definitely could use a short spread or two.
And I would have to take, listen, it's not going to be as big of a gain, but it's at 23 days to expiration already. if we start breaking the key technical level, what am I going to really do? Ride this out for 2 days when we see that the return profile of the market is to the downside? Once the S&P 500 falls by more than 1% on a Fed meeting day, just wait a few days for another flush. We get another shot, take a shot at the 50-day moving average. That sounds good. Jamal, the 1 week win rate, though, and that's what makes this so interesting. The win rate at 3 days, the market's up 53% of the time. It's just when it's down a lot more. The win rate at 1 week is only up 47% of the time, even though it produces a positive average return. So this could be a little bit of a blender here, if history's any guide. I did see a note come in. What's the average loss of this when the S&P averages more than a 1% loss? What's its average loss in those days? 1.73% since 2010. So Nasdaq's down 1.2, S&P's off 1.45.
Yeah, I'm just watching things happen here. I'm doing a couple of things. You just made me rethink a little bit too. I mean, I ended up selling upside actually, the call spread in the S&P 500. Although I did buy a 2-day, 5-day SPX. I bought the 1-day, 5-day SPX calendar for the 7600, but then I went out to July and I sold the 7600, 7610 call spread. So I just think trying to take a little bit of advantage of some of the move we're getting here, whether it's, and again, I'm selling the upside in that situation because I have a lot of upside plays. So at some point I do have to sell some upside as a result of that. If we get another, 1.5% down over the next day or two, then maybe at that point I'm starting to look at selling more downside. We'll see.
In terms of the sector performance here today, Jamal, we track 29 sector ETFs here, at least on my watch list. I only see 2 in the green. Not great, Bob. SMH, IBB. Does it surprise you that SMH is holding up in this tape? I know that it's sold off a little bit here with the broader market, but it's still the leader.
That's what I was noticing. I mean, again, some of these names I'm looking at in my portfolio. I got Intel, I got Marvell, I got AMD. Those things are positive. So yeah, it's holding up. Like I was saying, I mean, the SPUs are, NASDAQ are catching up a little bit to SPUs here. SPUs down 1.4% versus NASDAQ down 1.1%, but these names are showing some resiliency here. What about SanDisk? SanDisk is negative. That is a name that has been positive no matter what. That thing is negative today. Just a little bit, though. Barely.
Apparently I said DOE win rate, which the production team is having a lot of fun with.
Yeah, you almost sounded Chicago-like. I mean, you don't want to do that. Still revel in your New Yorkery.
I saw someone wearing a Knicks shirt today when I went to drop off my daughter at school, and I went, yeah, baby, Knicks. This guy came up to me, just gave me a hug. I've never seen this guy before. Don't know who he was. That's like the vibe. That's the vibe right now, man. Here's Kevin Warsh harshing the vibe. What are you doing?
Yeah.
What are you doing?
It's dope.
Actually, I'll send you the video. So Mitch Robinson lives in my town, right? He has now this gigantic white and orange monster truck that he's just been driving around town blasting country music, just doing loops.
Wait, what? He's a country music guy?
Oh my gosh. I'll send you the video.
So is Mike Brown, right?
Yeah. Oh, Mitch Robinson is he lives across the street from from friends of mine. And he shows up at 1:00 in the morning with his neon lights on his monster truck, just flashing, and music blaring.
And I'm sure nobody's saying anything right now. I mean, the kings of the city, man.
No one said anything before because he on Saturdays he goes to the park and shoots basketball with the kids and attends the practices and helps out randomly.
I bet the kids make more shots than he does. That dude can't shoot at all.
You should see him shoot. It has this beautiful arc. We're where is this in the games?
Is he really one of those dudes? Because there are dudes like that.
Yes.
You're right. There's dudes that yo, why don't you play like this? No, I used to see this a lot when I was especially at a D1 school. So when I went to graduate school in Wisconsin, same deal. I used to notice that, man. Some dudes who sat at the bench weren't really that good in the game. They get out there and you're playing with them one-on-one. I mean, when you're playing with them in pickup, it's damn, this dude seemed like he could be in the NBA. What's going on with this? Well, it's funny how that works.
In this case, this guy's actually in the NBA.
Yeah, in this case, that guy actually is in the NBA. Looks like we got a little stop here towards the bottom, a little bounce off of, what was that? What did we bounce off of?
About
74.72.
74.72 here in the S&P, getting a little bit of a lift, which, not the most surprising area where we've seen some market consolidation before. I find it funny how these things work out. People tell me technicals aren't real. Jamal, when we were looking at the MES position last week, why did we hold on to it? It's because there was a little inverse head and shoulders pattern coming together here. We hit literally the extension target. That's where the market paused. And then we've since pulled back. So we're back to the breakout point. We're right around 74.65. If you liked the market last week at 74.65, you probably love it here today, as the saying goes.
Exactly.
The NASDAQ isn't really breaking down substantially, though. I'm very curious to see how we close out here. We do cover the gap from the market close on Friday, which was, again, 29,967. The low for today is 29,931, and we immediately start lifting off there. That'd be a fascinating reset, Jamal. If all we needed to do was wring out some of the enthusiasm for the start of this week, and then we kind of just pick up the pieces. So I'm more interested in the close today to see if I make any adjustments now as this session winds down until its final 15 minutes. I don't think I'm going to do anything probably until the futures market reopens. Maybe I'll do something on overtime if I need to clean up the book. But if we hold here, we've been through worse. We've been through worse than a little 1% drawdown.
We've been through worse for sure. It does all make me think. Some of this today makes me think about whether or not it's, I think there's little things that are happening that I'm paying attention to and being observant about the market. We had a piece this morning, a research piece that Sahil did about utilities. Now, utilities are never sexy and not really interesting, but we all know that utilities are something that's not really being paid attention to in a market where people are dealing with a lot of tech stocks. So, there's that. There's consumer staples, I think. We've talked about this a good bit every now and again over the last couple of weeks. And I have a Walmart put that I'm short, and I have a Costco calendar that I have on as well, the 1100. It's SEP versus short August. So, those type of things. Is this time in the beginning to put on those trades? We're seeing what's going on with the dollar here. We're seeing a market that might be looking at rate hikes at some point, and that stuff might be coming in vogue a little bit. And so I think trying to start to get a little bit of exposure in those areas might be worthwhile.
I went in you with the Walmart trade. I think that was a confirm and send trade, right? I forget, but we both did it around the same time.
No, it was me. I was thinking about it. I think it was after earnings or something. It was kind of down, so I decided to sell a put. And I told you about it the next day, and I think then you ended up putting it on too.
Right. So I'm in the 110, 115 here, and just thinking about this trade management now. A few weeks ago, this has been on for, I don't know, like 2 weeks, 3 weeks.
Yeah.
I want to just go back to the lows that we have here. This is a really important trend line to me. Maybe it's important to you too, listener at home, because it's from the lows that we have in April 2025. We have the lows here in November 25, and we have the sell-off lows at the end of May. So this is a pretty sturdy uptrend. We likewise have a meaningful swing level that was carved out in the middle of March. And so you can see why here at like 115, 120 or so, we really got to stick. But we're not sticking. We just had this counter trend bounce. And then we struggled against the 1 month. We couldn't get through it. And now we're keeling over. And the rate of change is increasing to the downside. The 5-day moving average has a more aggressive negative rate of change today than it did yesterday, as does the 1 month, as does the 50-day. So I'm looking at this, and I know there's still 65 days to expiration. I do not like this particular position here at the 110, 115. I'm just going to get this off the book. I don't want this. I hate this, in fact. I strongly dislike it, Jamal. I want it gone.
I
absolutely want it.
It's understandable.
It's just not, when we're sitting on support like this, I just don't need this kind of stress. $2, see you later.
Yeah, I'm not that worried about Walmart in that way. I'm really not. That's why I'm keeping it.
You know what I'm also worried about?
Mine is in August too, though. Where's yours? You did July, right?
No, I was out in August.
You were out in August as well. Okay, fair.
Don't want to deal with it. Jamal, I'm looking at CRM here. I'm cleaning up some things today because we are getting some breaks here right now. CRM had this nice little channel. Maybe it was breaking out higher. It never quite could get through those swing lows. It crashed back down, and we're now setting new lows. I was here with a short put spread that has now gone negative. I don't want this thing. Junk, 30 days to expiration. What am I going to do? Hope for a bounce before the end of next week? I suppose I could, but we're getting close to 21 DT. I just don't want it. So not going to catch a falling knife right now. It's totally different when we started to break out. Now that we've broken back down, get rid of it. No, thank you.
I hear you. You got to clean up the book every now and again.
Sometimes you got to do it. What do you make of the cryptos here today? I know these aren't like the sexiest things right now. Not a lot of people, we do the content, not a lot of people consume the content. But that's a function of where we are in the cycle, perhaps. Decent bounce off the lows, maybe a 10% bounce that it's already started to fade off. Do you try to catch this knife, or do you just let this sell-off work its way through the system still?
You can do both. You can try to catch a knife while the sell-off is working its way through the system. It just depends on how long you give yourself in duration for a position. So for me, it's been an IBIT. I have a couple of positions on in here, but I am short a put in one fashion. I'm actually short a couple puts. I'm short one in August. I have a short put, long call spread to the upside afterwards, and that's in August. Short 35 put, long the 40 calls, just in case this thing starts to be loved again. But that's in August. That's a while out. Also have a short put that's in the money, and I did this when it was trading 35, so that's why I sold the 38 strike. That's in the July 31st cycle. So, these are ways that you can have that exposure. You can also eventually roll these things out over time. I think this is a very liquid name. IBIT is the way to do it versus anything else.
Sure. If we do get another breakdown here, if we start to see those lows that we had in February cleared out, the lows that we had just 2 weeks ago cleared out near 59,000, I think 50K becomes a magnet. This is a weekly chart, Jamal. Jan 24, we basically get to 50K, we pull back. Once we break through, we never quite get down through there. August 2024 sell-off. I'm thinking 50K is going to be a place where this market's going to seek it out very quickly if we start to break through 60. But at 50K, Jamal, I mean, you're telling me that we can buy back in Bitcoin at 50K? That's a really interesting psychological level. And I know we've had a lot of smart people on that have said Bitcoin can go down to 10K. We had that on our YouTube channel in a Trending Trades interview a few weeks back. But I would have to think at that big round psychological number, you're going to get at least a dead cat bounce, something for like a day or two that pulls you back up. So I think we have to look down there, maybe be a little bit of a contrarian despite the crypto winter continuing to rage.
Exactly. And again, you can go further out and do it. These are positions that you can have for a while. It's not fun if you're short a put and it continues to fall further than the money, but it is something that you can roll further out. I didn't used to do that a whole lot. That's something that we've obviously had a lot of research on. We preached a lot. Something I've also kind of taken a page out of Trader Mikey B's book. I mean, Mikey's good at kind of holding on to positions for a while, rolling, and not really worrying about it because, again, it's it's affecting your buying power as it goes further down, but as long as you have the ability to hold on to that, that's a reason to continue to stay in the position. I mean, if you can't, then understandably you got to buy it back at some point. But again, I mean, these claims of 10,000, I mean, over what time period? It's just like they're talking about, like the piece I just did a little while ago, they're talking about Micron and 1,500. Yeah, over what time period? When is that going to happen? Are you calling for it next week? Are you calling for it in a day? There's always these call outs for these levels. So there's the options math doesn't necessarily support that, for example, in Micron, but it's also has to be a situation where they come up with some crazy idea around earnings and crazy valuations for it to go further and further. That's not what options are predicting right now. Options are only predicting like a 15% move on earnings, which are next week at some point. So take similar logic to Bitcoin. I don't know if Bitcoin's going to 10,000, but it's easier to trade it in IBIT. It's a lot more digestible product versus trying to buy Bitcoin and holding on through that. That's a lot more expensive. I think IBIT is just an easier product to do that in, and selling puts in that, it's very liquid. So, again, you have the ability to continue to roll out, roll up, however you need to do it just to keep yourself in the game.
I love that comment that you just made about, what's your time horizon? If I told you that the S&P 500 is going to hit 10,000, you go, wow, that's a long way from here. And I said, yeah, but it's going to do so in 4 years. You go, okay, well, that's only 8% a year for the next 4 years. Mm-hmm. It's like a huge claim. If I said S&P is going to hit 10,000 in December, you'd go, that's 36% higher just this year alone. That's a totally different set of circumstances. So yeah, the Micron stuff, these have been strong names in the tape today. Western Digital yesterday was holding up too. I thought that was noteworthy, right? You saw the weakness in Micron, some jiggling around in SanDisk, but when you went to like Seagate or Western Digital, they both were still strong, and so those are some of the leaders that we have right now. If you look to SMH broadly speaking, you probably wouldn't think that there was much. You'd think maybe today was a little bit of maybe a down day second half of the session. You could see the candle, we gap open higher, we fade off, but I don't think you'd think it was apocalyptic. Until semis break, Jamal, you can't get apocalyptic on the NASDAQ because it means the AI infrastructure component of this market is still very much in place. Before I get your response, because I do want to listen to you, you're my friend after all, we got to go to refer a friend. I've been waiting in the hopper for about 10 minutes. Nice. I've been reminded here. Yes, refer a friend. $100 for you, $100 for the referral. Either way, bring a friend along. You both get $100. tastytrade.com/refer a friend. Jamal, I've tried this as well. I told Ilya he's not a friend, and then he's actually now a friend again. They still won't let us take the offer. So we're trying to work the system. They're not letting us game it.
Yeah, understandable, I guess. I do want to talk SpaceX options.
We need to.
It does seem fall is coming in there a little bit. I have these calendar spreads on SEP versus August, and both months are kind of coming in. I think the SEP is coming in a little bit. I'm sorry, the August is coming in a little bit more than the SEP, but they're both kind of coming in. So you're starting to see this little bit of a normalization, if you will, around a very liquid options product as it is.
These are probably the most tradable things right now in the market outside of SPX, ES. There's so much volume in here right now. I mean, it's not quite the day yesterday, but 190 million SPX traded here. I keep going back to like Meta, for example, 15.4.
Yeah, and nobody wants it.
Or NVIDIA, 96. So, I mean, the SpaceX has already eclipsed NVIDIA's trading volumes through its first few days. There was, again, for yesterday, too, this company, Vanda Research, has been putting out this rolling note. SpaceX volume through its first 3 trading days was equal to all other trading volume in the rest of the market for single stocks.
Phenomenal.
Which is absolutely wild. Hey, we're getting some notes here from the Iranian agreement that we have, J-Man. Should we go through it?
Can you give me the cliff notes?
Yes. U.S. pledges no new sanctions on Iran, no additional military deployments in the region during talks. Iran to maintain nuclear program during negotiations. Here are the good things that the market probably cares about, though. U.S. to immediately begin lifting its naval blockade of Iran. Full removal targeted within 30 days. Commercial shipping through the Strait of Hormuz to resume immediately and return to pre-war levels as soon as possible. Iran to ensure safe passage of commercial shipping between the Persian Gulf and Gulf of Oman. Transit of commercial ships to be free or fees for an initial 60-day period. So, fees would be coming starting in 60 days. I just don't know if the market's going to care that much if Iran collects $1 a barrel of oil. A VLCC carries 2 million barrels of oil. And so at $70 a barrel, we're talking about what? A load that's $145 million of oil on one of these given tankers. And you're going to have to pay $2 million insurance additional on top of that right now. A 1.5% fee. People aren't going to like it. No one's going to like doing that. But it's not backbreaking. I don't think that's going to be hugely problematic.
Did I hear something about them getting $300 billion? Did I hear something like that?
Yes. Listen, mea culpa. I may have sent out a graphic yesterday to the team. I just wanted to kind of troll a little bit. I don't want to say that. But I included the list of the world's richest men on it. And Elon Musk was like, wow, look how wealthy Elon Musk has got. $1.2 billion. Or $1.2 trillion. And it was like industry, U.S. tech. And then the second richest man was the new Ayatollah. And it was $300 billion, and the attribution was U.S. taxpayers. So I think I may have been contributing to this. But
yeah, right.
Jokes aside, no, it's not. The scope of the plan doesn't seem like it would be $300 billion of taxpayer money, right? Facts matter here. It would be a $300 billion joint investment vehicle that's chipped into by a lot of states and actors in the area. It could be a Saudi Arabia, an Oman, an India, a Pakistan, right? That assuming conditions are met by Iran, then investments would be made into the infrastructure, which I know there's a lot of doubt out around there about this. There should be, right? Money's fungible. If Iran had say $5 billion that they were going to allocate to say Hamas or Hezbollah, and we just give them $5 billion, they go, yeah, we're going to use this $5 billion for infrastructure. Right, but money's fungible, so it goes to Hamas instead. And now the money that they kept internally, it's going to be a mess, Jamal. Ilya knows more about this than I do. S&P 500, 74.94. You get a bounce here off the lows into the end of the session. Volatility is up, down 1.2%, so it is a 1% down day. Jamal, NASDAQ here, though, pokes its head above 30K. Looks like I'm still in the game with the NASDAQ short put spreads for at least one more session. We'll see what happens next, but I know someone who's going to be very happy about all of this.
Oh, yeah.
And that makes both of us deeply upset. We'll see you all in 90 seconds.
In the world of investing, a beast lurks between the numbers.
Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Warsh undercuts the stock market. Did he? Maybe. It's still Wednesday, June 17th, 2026. This is Overtime. I'm your host, Chris Vecchia in New York. He's Ilya Spivak in San Francisco. We're here to take you through the next 30 minutes as we wind down this trading session. A trading session defined by Kevin Warsh's first meeting as Fed chair. Cut the guy some slack. He didn't look as polished as Powell. Of course not. Powell had years of giving speeches at the podium to get to that really crisp tone and tenor and cadence that we all came to know and love on the purple tie time to buy days. Warsh sounded pretty good, all things considered. Ilya,
he did,
right? He's a little stiff, a little academic, but that's not really what matters here.
You can't fault somebody for their first outing at that podium for sounding a little stiff and a little academic, especially when there's so much ambition behind what he's looking to do. There was a lot to do. The thing was very ambitious in terms of what he's proposing, and frankly, Powell was a little rusty at first at the podium, having been governor for consecutive years before he took the job. Warsh has been away from the Fed for a while, so he did fine.
He did fine, but the markets did not do fine here. S&P 500 down 85 points. The NASDAQ, it trims its losses. It's only down by 0.8% now. The Dow Jones up by 0.9%. The Russell off by 0.6%. Can you tell that I've had a few Celsius today, Ilya? Notes here are down by 0.6%. That's 21.5 ticks, 109 and 9 ticks here. Bonds a little bit more insulated, which is interesting. They're only down about 12 ticks, as it were, 0.3%. But gold really took it on the chin hard here coming out of this Fed meeting. It was trading near $4,400 at the time that the Fed meeting, at least the initial summary of economic projections, came out. It drops about $150 from high to low. It's now back to 42.61 here. With you on our little Fed coverage there, I did get into that short gold position, which turns out working out pretty nicely right now, as it were, so I'm going to keep that going. But today's about the dollar, too. And I know that you're a dollar guy, and Jamal was leaning into this a little bit earlier when we were talking about this on last call. It's just a plain good day for the greenback, sitting up near multi-month range highs now, which although the open outcry close won't give us the full scope of that rally, we're still in here at like, what, 100.60? 100.60? So this is the top side of a range that we've been trading in since late May, early June, actually right around Memorial Day last year. The dollar turning the corner here can't be ignored as a result of what the Fed's trying to accomplish.
No. And I think that's part of how you arrive at the unambiguously hawkish readout that the markets have for this Fed announcement, Warsh and all. See what I did there? What this, I think, clearly says, whether you look at, there he is. I
just saw just the most ridiculous Trump comment ever. He was asked about Iran being able to they retain their missile launch capability. And he goes, well, it'd be a little bit unfair for Iran to have no ballistic missiles if the other countries in the region do. What?
We just want an off ramp, baby. Come on, let me out of this thing. I just want to go home.
Of all the calls I've made recently, by the way, noting several weeks ago, Trump's done with this war, that was my best one.
It's a good one. It's a good one. Go ahead and take a little dirt off your shoulder on that one. That was spot on. I think you look at this today.
Why did we go to war with Iran?
Right.
I don't mean to interrupt you.
Listen, it's a complicated thing. Lots of ins, lots of outs, lots of what have yous, as one Jeffrey Lebowski famously explained. It's a complicated case.
Okay.
But when you look at what's going on here, I mean, what's the one thing Kevin Warsh said 90 times in this whole outing? He was asked every which way won't you please give us something to hold? Some kind of something to guide. We're not doing forward guidance. You see the short statement, no forward guidance. Won't you please something? And he kept saying that there's a task force for this and a task force for that, which very management consultant of him. But I think the most interesting thing is the one thing he kept repeating was, it's time to get inflation to target. And we're not going to have a new way to measure the target until the end of the year. Now, okay, if the inflation task force is going to come back with a redefinition of how we get to measuring 2%, and it's some sort of new Warsh-approved metric that runs cooler than current benchmark, we're not going to get there until end of the year on his timeline to know what that is. And in the meantime, we're targeting a 2% PCE bogey, and he's pounding the table saying we're going to hit this 2% come hell or high water. Okay. Then we look at the dot plot and we go, well, they want hikes. And we look at the market and we go, they've priced in 2 of them. So, okay, unambiguous. Warsh did not contradict the hawkishness of his colleagues. In fact, he came out and basically said, yeah, me too. I'm just not in the dot plot because I have, shall we say, faith-based restrictions.
That's funny that he's
conscientious objector to the SEP.
Yeah, well, I mean, he had a really interesting comment here. He said, quote, I think financial markets perform best when they react to incoming data. I think the financial markets work less efficiently when they ask a question, how will the Federal Reserve react to that incoming information?
That there's going to be anything different ever, and that there has ever been anything different is wishful thinking, because, of course, the markets are as ever forward-looking. Any market participant knows it doesn't matter what an earnings announcement is. It matters what the earnings announcement expectation is and what the outcome is relative to that, and how the markets then rebase expectations. So
they've rebased those expectations.
Lots of luck.
Pretty aggressively
to Mr. Warsh.
Today. This is a pretty aggressive rebasing of expectations today. The SO3Z6 contracts here on the platform. Tom Preston and I went through this earlier, and you and I have gone through this before, Ilya. But right-hand axis, y-axis here, you take that number, subtract it from 100. You're going to get your implied Fed funds rate effectively at that particular juncture. You could do this with the ZQ contracts on TradingView, for example. They're no longer listed here on the platform. But the point being is we went from 96.10 to 95.90 here in the very short blink of an eye during today's session. So we go from being between 3.75 and 4% by the end of the year to the market now saying, for the first time all year, by the way, that we're going to have a rate between 4 and 4.25%. And so when you think about the expectations for where the hikes have moved, this reflection makes a good deal of sense. This is a pricing in around a little bit more than one hike. And so in terms of what that looks like visually for the CME FedWatch tool, I like doing that aggregate tool, Ilya, because it just adds everything up across the board for us. We don't need to do that ridiculous math. The next hike is now for September. We went from like a 70% chance of a hike in December prior to this meeting to now 100% it's happening. There's actually a 58% chance that we're going to have to, that will be the second hike we get this year. In 3 months' time, we may be looking at a hike. So why does this matter? There was a point earlier today when the market was reacting where we hadn't seen that shift in the curve. Where the market was saying, okay, yeah, maybe the hikes are coming. Now it's like, okay, the hikes could be 3 months away. And so all of a sudden, right, I'm trying to work through this myself. Was this a June 2021 meeting? Or was this equivalent to what the Fed did in December of 2021, where they have laid the groundwork in their SEP and have effectively said, by the next summary of economic projections, we will be hiking rates? Because that's what they did.
Yes.
They did that in December 21. We get the FOMC minutes in January 22. The S&P 500 peaks. The Fed hikes in March 2022.
Well, I think it's very path. Yeah, I mean, I think it's really important to understand that if there is anything that Warsh did today, and he made sure to leave a lot of ambiguity, but if there was anything he did for sure, it was to create this sense that this is a new day. This is a different Fed. It's going to operate different. He didn't even commit to having a press conference at the next meeting. He said, we're going to have a press conference when there's something to say. And this time we felt there was something to say. You go, okay, well, he's probably going to keep doing press conferences until the end of the year because that's when his task forces are supposed to give him communication strategy updates. So, okay, we're going to keep getting this for now, but the message is clear. This is a different Fed. So we can't necessarily say that the way that there was continuity between Bernanke to Yellen, not in thinking about policy, but in how policy is communicated. All of the changes were made with a scalpel, small iterations. And every Fed chair has made changes, so has Powell. But incremental changes, small changes. There was continuity and an emphasis on continuity. What we have here from Warsh is an emphasis on discontinuity and on changing the way things work. So is this like 2021 this way or that way? Who knows?
Ilya, while the market was selling off, I decided to do a quick scan and go, since the global financial crisis, because I'm starting to throw away data that's pre-GFC. The regulations, the market structure, like so much has changed since then.
Yes.
That is. So anyway, I usually do this cutoff like since the global financial crisis. Since the global financial crisis, really since 2010, right? There have been 15 occurrences in which we've had the S&P 500 fall by more than 1% on a FOMC day. Usually, the average close for the VIX on those days is 24.08. The average return for those FOMC days is minus 1.73%. So today goes into the bucket. It's going to be minus 1.25 or so. The average next day return, 2-day return, 3-day return in those 15 occurrences, all negative. Modest, but all negative still. So the market sells off by 0.5% the next day. It then bleeds out a little bit more the next day, bleeds out a little bit more the next day. A week later, it turns modestly positive. How does this all work out? Next day, 60% of the time, it's lower to a tune of 0.48%. 2 days later, 3 days later, so it becomes a bit of a coin flip. As you move out in time, maybe the market stabilizes. But for the short-term path here, if this is your typical next day after the Fed, people who are long stocks and short put spreads or something, or short puts, you may want to reconsider. You may want to think about what that looks like. And so for me, Ilya, I am thinking about what that looks like because I have short put spreads on in the NASDAQ vis-a-vis a bunch of little short put spreads I've started to sprinkle in through MNQ. I like to build into the position. And MNQ is a big product. But doing things through MNQ, you can build up towards that full contract. So I'm thinking like at 23 days to expiration right now. If we break below 30 tomorrow, I'm going to have to take this off at a small loss. Even though the short strikes won't be hit because they're all sitting below the 50-day moving average, if this thing starts peeling back below its 1 month, I don't want to ride this out for another 1,000 points or so. I'll take it off. I'll wait to see if we get back down towards 29K, and we can figure out what we'll do around there. But this is the knife's edge. It's not fantastic price action. History isn't a great guide if you're a bull here moving forward. If you have something profitable and you're sitting at 21, 22 days to expiration, just kick it out if you want to hold it. There's no reason to wait until after Juneteenth.
Yeah, I mean, I think you look at this and you say, okay, well, the markets clearly are telling you what they think about this. So number one, they're telling you that they care. And that's a very important kind of first consideration is if you thought that monetary policy didn't matter, well, think that over again, because clearly the market does care. The second thing here is that you're looking at a situation where you're doing some technical damage. You haven't done big technical damage yet. You're kind of testing the bounds, and you're testing them across assets. Some of the initial spikes have fizzled in gold, in the dollar, not because the moves have changed course, but just because we're digesting and we're hitting big levels. So there's going to be some back and forth here. But there has been a sea change. If the question was, how do you reconcile promises to the White House that were dovish with a hawkish committee and an inflation problem that seems to be seeping into core, we learned today how you do it. You give the White House a 6-month timeline in which you say, oh, well, I got a task force for that. But in the meantime, because that's the message that reporters got today is what the White House is going to get. Oh, don't worry, Mr. President. We got a task force for that. But in the meantime,
a task force.
We got a task force, baby.
Ilya, isn't the FOMC the country's inflation? Isn't the FOMC the inflation task force for the country? Like, isn't their remit to?
It is. But the task force needs 5 more task forces because there's tasks and they need forces. Now, it's funny because the next object of speculation here is going to be who's on the task forces. If Warsh thinks that what he's going to do is teach the markets not to speculate about the inner workings of the Fed, well, there's a bridge in space I have to sell him. Because the next question is going to be
SPCX.
Who's on these task forces and what's their bias? Are they hawkish or are they dovish? What do they think?
I have there's a group out there called ITC Markets that puts out a little scale of the hawk dove. There's a lot of different metrics like this out there, but this is one that I like to keep track of. Where does Warsh come in historically speaking, based on the very hawkish? So if he's putting together, like, this is one of the little wrinkles here, how the market reads these tea leaves. If I see Warsh put together a task force for inflation, and it's like Bowman and Cook and Williams.
Stan Druckenmiller is on the task force. Oh, we're going to have some higher rates.
But
by the way, if Stan Druckenmiller is on one of these task forces, you can expect that for me, every announcement from one of these task forces is going to be a party.
Yeah, so but
that's going to be incredible.
So on the scale, blue is dovish, red is hawkish, right? So just, again, the perception here. If you have Warsh and Bowman and Powell, who have been some dovish people, I should say, if they're the ones who are on the task force, that sends the market a signal. If you have someone like Hammack over in Cleveland, the Cleveland Fed president hit under Loretta Mester, now under Hammack, big time hawk.
Yeah.
If she's on the task force and it's Logan and Schmidt and Kashkari, that tells you that they're really serious about crushing inflation. And like that can be oh yeah, we're really ready to lean in on these rate hikes. Mm-hmm. So now we have this new stupid game to play as Fed Kremlinologists, I suppose, where we have to see who goes on to what task force. If it's only internal people,
it's not. He said that as much already.
I know, but not every task force may just be all outside, right? If he all of a sudden brings an inflation task force and it's just name all like the von Mies people that are out in the world in the academic sphere.
Yeah,
it's going to be a signal.
Can we get some monitorists? We have 5 task forces to fill.
Yeah, right. Who's the guy on Twitter? Like if he gets the Rudy Havenstein Twitter character, like he gets him on one of the task force, that's going to send you a signal. If he gets a Stephanie Kelton, one of the modern monetary theorist type of folks on the task force, that's going to tell you a signal about Fed policy. But Ilya, this was just the 3rd time in history. I think this deserves noting here. Is there any signal that comes out of this? The NASDAQ a few days ago had a 3% day. How often, little quiz here, chat, this goes to you too. NASDAQ just had a 3% day, and then it saw all of its gains given back within the next 2 sessions. The VIX also closed below under 20. How many times has this happened before in history, including today?
That's a great question. I don't know.
Today was the 3rd day.
Wow.
It's never happened. Doesn't happen all that frequently. The last time that we saw this happen is in the midst of the pullback that we have going into the 4th quarter of 2018. The 3rd time that we've seen it, aside from today in that other instance, you have to go back to March 2020.
Oh, wow. That's fun.
So it's a very small sample size, but again, it's not usually something that happens before a bull market takes place or a rally takes place. It's usually something that occurs when the market is getting ready to take a little bit of a dip. Again, it's only n equals 3, and this is number 3. So I'm not sure for how you want to look into it. The return profiles obviously are very different too, Ilya. Go out 6 months from November 2018 versus March 2020, and you're going to get a very different 6-month return profile for the market, or a year, or 5 years. So I don't know if we're going to do it, but it's not great. There's not great omens right now. I'm going to stick to the price levels here, though. Yeah. We have our NASDAQ level. We have our June 9th swing high. We have our highs from the middle of May. If we maintain them and we're holding above them right now, I'm going to stick with the long deltas that were put on last week in the NASDAQ. If we don't, we get them off the books. I think I'm done speaking here. That's a lot of numbers.
I mean, for me, it's pretty straightforward here. I'm looking at existing short call bets in NASDAQ and the S&P at this point. They've got 44 days left in them. So, and they're aiming to essentially say that the high from the beginning of June is the high. That's the bet. At least that's the risk reward math. That's the high. And then until you break that high, you have not invalidated the risk reward of the idea. So, okay, let's see what that looks like. Then when you look at gold, I think you have a really interesting opportunity here. We talked about it earlier as the Fed was coming on. We are getting some understandable friction at former resistance. And now we're looking at a very interesting sort of setup here where this might well be the place to sell some gold. Now, if you look at a 4-hour chart here, I think you can kind of see where the underside of the range is that we're coming in to test. We're right around there. So I'm a seller of gold here. I'm going to start getting back into it with the scaling of 1 OZ futures contract. So far, I've just got the 1 on, but I'll do more as the thing starts to build down. And I think the U.S. dollar is a great setup here. I mean, take a look at the euro. I mean, just 6E, 6A. I mean, these are clear breaks. And I've been holding the long side here for a while. In fact, I just rolled into the next few futures contracts last week. I'm short euro, I'm short Aussie, I'm short pound. I'm short the Swiss franc in my spot account. On we go.
On we go. Yeah, euro dollar here is breaking down. The dollar had a really nice day today. Pound dollar likewise. But the one that stands out to me the most is what's happening in the Canadian dollar here. Ilya, this is a weekly chart going back to the lows that we have in July 23. It made its breakout, try to 2 weeks ago, and it's really started to accelerate. As dollar CAD goes, so too does the rest of the broader dollar basket.
Oftentimes, yeah.
Yeah, not all the time, but it feels like that's a good heuristic. We'll call it a rule of thumb, right? You can basically lean in that direction most of the occasion. So the fact that dollar CAD is breaking out right now, maybe it's a sign of acceleration of the U.S. economy. You were concerned about overheating. Maybe it's a sign that the dollar is getting liquidity demand back at the end of the day. But either way, though, higher yields, higher dollar, not good for your metals complex right now, Ilya. Small bounce here in the after hours. We've gone through 25 minutes of additional trading post-close so far, and it's been good. 74.71 washout low, and we're now back to 75.07. So a little bit of a 30-point bounce here. 0.5% bounce coming together in the S&P 500. Ilya, maybe this won't be a 1% down day after all. Before we get to the 5 p.m. close. But that's a question that you're going to have to tackle because overtime is now out of time for this Wednesday, June 17th. We'll be back tomorrow, same time, same place. We'll call it, 4 Eastern, 3 Central, right after last call. That sounds good. We're going to take a brief break here on Tasty Live. Ilya Spivak's back with Back Row Money coming up next.
See you there, everybody.
On April 14th, the SEC officially approved FINRA's proposal to eliminate the pattern day trader rule, also known as the PDT rule. This is a big deal for many retail traders. For more than 20 years, the PDT rule has been a major roadblock for smaller accounts that wanted to actively trade stocks or options intraday. In other words, we call it day trading. Here's how it used to work. If you made 4 or more day trades within a rolling 5 business day period, your account could be flagged with a pattern day trader designation. To keep that status, your margin account had to maintain at least $25,000. If your balance closed below that amount, your account could be restricted from trading and issued a PDT-related call. At tastytrade, they're called an equity maintenance call, or an EM call. The result? Retail traders with smaller accounts were effectively limited from actively participating in markets simply because they didn't have enough capital. Now, that's changing. Under the approved update to FINRA Rule 4210, the PDT designation is being removed, and that means you no longer have to limit the number of day trades you make in a 5 business day period, and you no longer have to maintain $25,000 minimum just to keep day trading in your margin account. In short, as long as your buying power stays positive, you can continue to day trade in your margin account. On our platform, we show real-time buying power, so you can always see where you stand and keep your risk in check. Now, it's important to talk about timing. While this news can be exciting, these rules will not take effect overnight. The new rules will become active 45 days after FINRA publishes its regulatory notice. After that, firms that need more time to update their system will have that additional time, up to 18 months, to fully phase in those changes. So be sure to check with your broker for their specific rollout timeline. And remember, day trading is extremely risky and not suitable for everyone. You must be knowledgeable and experienced to day trade. It's critical to manage your positions carefully and to fully understand the risk of potential loss. We'll continue to keep tastytrade account holders up to date as information becomes available. So stay tuned.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tastytrade. Make your move.
And what a day it turns out to be after the first monetary policy announcement to be helmed by new Fed Chair Kevin Warsh. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and we are going to take a look at everything that's happened here and why the markets are in such a shaken state in the wake of this. Of course, the question front and center is, did the Fed just break the stock market rally and, frankly, quite a few other things besides? We're going to take a look at the price action as ever as our jump-off point. Here is the S&P 500. And what we see here is, of course, starting to look very much like it could be a double top of some sort. So we came back with this rally once we got the news that we're going to have a U.S.-Iran deal on reopening the Strait of Hormuz, or at least an agreement to talk about one. This memorandum of understanding between Washington and Tehran expected to be signed imminently, and copies of a 14-point plan have already started to circulate as of last night. Leaks are, of course, to be expected in this kind of an environment. Apparently, the thing was getting shopped around the G7 in France, and not surprisingly, some reporters got their hands on it. So we have this thing give us a rally, and of course, yesterday everything stalls after one day's rise because we were anticipating what was going to happen with this Fed policy announcement, or at the very least, recognizing that there was event risk that was on the menu, that was going to be something that the markets have to contend with, and something that the markets didn't want to have conviction ahead of seeing. And that was apparently a wise decision, because in the wake of this policy announcement, the markets are down and they're pulling back through this former level here. This was resistance, then support, and we're seemingly back through it now. Again, we're kind of in the choppy part of this range here, but the same architecture of the down move that was here on the first attempt to break above these levels, fading volume, negative divergence on the relative strength index. The same thing is occurring here, and for the relative strength index, it's frankly more acute. The divergence between this being a nominally higher high and this being nowhere close to the preceding high in RSI, that's quite telling of fading momentum. But the volume story was very much the same again, and it looks like we're starting to carve out what could be a double top. We'll see if that's the way it plays out going forward. But at the very least, risk sentiment, having listened to Kevin Warsh explain what the new Fed looks like, was not impressed. The situation in crude oil, very interesting here as well. Of course, that memorandum of understanding between Tehran and Washington has been a reason for oil to come off as geopolitical risk exits the market, but number of interesting things here. So yesterday, crude oil continues to decline, but obviously that's not enough of a motivator for stocks. They are already looking ahead to the Fed at that stage. And while the opening gap here down after that news of the imminent reopening, or at least a deal to start the march toward the reopening of the Strait of Hormuz, while that ends up, of course, giving sentiment a lift, you can see that's this most recent green bar here, it already breaks down as of yesterday. And today, crude oil doesn't really go anywhere. But pointedly, it stops falling, and it stops falling at a very auspicious spot, right at this bottom of the sort of wartime range where we've carved it out before. Now, there's a kind of middle chop area here, this range top, this range bottom. And so in here, it's kind of anyone's guess where you might go, but you might suspect that this is about fair value. And if this overall range kind of represents the extent of the scarring that the market has endured as a consequence of this war, where, of course, here was where we started the year, and we started to creep higher. Here was the impact of the war. This is where we've kind of baked in from the very beginnings of it, going all the way back to March, as the sort of cumulative shock. We're pointedly holding that level. We are not unclenching that impetus. And so it'll be interesting to see if perhaps this ends up looking like a bottom for crude oil rather than anything else. We'll see if there's conviction to break this level. But for now, it looks like maybe crude oil is done giving the markets a disinflationary, or at least a relief of inflationary risk kind of a tailwind. Looking at what's going on with gold, of course, the implications are wholly consistent with what we see in stocks and what we see in oil, with oil having perhaps reached as far as it's going to reach on just diminished geopolitical risk premium alone, and stocks apparently not liking what they heard from the Fed. We likewise get a response from gold where we get rejected at this former support, now resistance, as if to reassert the fact that the trend here is down. Lower highs, lower lows, and perhaps the beginnings of the next leg down to retest this lower range bottom again. So far, all of this comporting to a Fed that sounded more hawkish than the markets were anticipating. It's the same story in the bonds. Not surprisingly, we get rejected at the range top that we identified over the past several days. Bonds again doing this thing where, while stocks have the capacity for more exuberance around headlines and the unraveling of geopolitical risk, at least to some extent, certainly helping stocks, although they ultimately don't break out, certainly helping crude, although it ultimately doesn't break out, landing with something of a thud in bonds, where there's not really even an attempt to unclench the idea that what all of this means over recent months is a slide in bonds and, of course, in parallel, a rise in interest rates. The dollar, for its part, takes another stab at the top of this major multi-month range. And of course, as we've been talking about, it's had its own little uptrend developing here since the lows in April. And we don't just hold it here, we bounce off it. And so all of what we had here as the initial pullback in the dollar around the MOU, around maybe some relief from the geopolitical risk, it's at this point gone. Now, we don't have a convincing breakout yet, perhaps for the dollar index, but the likes of the euro itself, the pound, the Aussie, seeing much more convincing signs of reversals here, and maybe setting up the stage for the next leg higher for the greenback. We'd have to see a little bit of confirmation on overall DXY, and it's not as convincing or more convincing depending on which of the dollar crosses you look at, but almost all of the complex here, almost all major currencies, weakened considerably against the dollar in this environment. And so naturally the question becomes, well, what did the Fed say? What was it that got everybody in such a huff? Here's the Fed statement, and if it seems short, well, that's kind of the point. We have here a very brief view of what's going on, and just the first kind of initial perspective on the kind of Fed that we are going to have going forward. Now, the important and significant thing here, perhaps, is to consider that what we're looking at more than anything seems to be a kind of shift away from forward guidance. The Fed did a lot more writing in its prior statements. It is doing considerably less of it here. And so the upshot seems to be that the Fed is just going to let the markets have more two-way risk around what policy is and how things are going to progress from here. But if we look at what this says, so not surprisingly, the committee decided to maintain the target range for the Fed funds rate unchanged. That was widely expected. What's perhaps critical here is the bit about inflation. Economic activity is expanding at a solid pace despite elevated uncertainty that owes in part to the conflict in the Middle East. Productivity growth and capital investment are strong. Read more inflation. Job gains have kept pace with the workforce, and the unemployment rate has changed little. So there's not really an inflationary impetus here from the labor market as such in this conversation, but perhaps there is one here from the Middle East that's being acknowledged, and another one from productivity growth and from capital investment. Inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks. That's, of course, what we've been looking at with the oil that have driven price increases in certain sectors, including energy. But perhaps the most important part of this whole statement is this right here. Now, this is a refrain that Chair Warsh would repeat over and over and over and over again in the press conference following this meeting. Because in so much as this is a move away from forward guidance, all the range of questions that came from the many reporters that asked them all got a similar cordial but curt, we don't do forward guidance anymore. But this part, the Fed chair was absolutely unambiguous about. He kept saying over and over again, we will deliver price stability. We continue to define that as 2% inflation. And we're going to get to the business of getting there. Now, this makes the summary of economic projections this go around especially interesting. Because what we find here is, first of all, a significant hawkish rethink of the rates path. And let's just start right there. It looks like the Fed thought we were going to have rates at 3.4 this year. Now, an important caveat in this conversation is that, of course, rates are currently above that level. So 3.4 was going to be something that the Fed was going to be able to do after a cut. And so when we look at where the market thought, okay, well, we're going to get to 3.4 this year, a critical consideration sort of in that conversation is that rates are currently in the 3.5 to 3.75 range. So that's one cut already implied. Now, what the Fed is saying here is we're not going to have that cut. And in saying that we're going to have a range at 3.8, we're saying we're going to have at least one rate increase. Because if we consider, of course, the Fed sets policy in ranges, if we're currently in the 3.5 to 3.75 range, then we're at about 3.6 in the logic of this dot plot. 3.8 would imply one hike. Now, it looks like by next year, there is an expectation that we could take that rate hike back. So we're up to 3.6. And then we get to 3.4, which was where we were supposed to end up based on the March projection this year. So, in other words, there is a kind of hiccup here in the Fed's path. Rather than delivering one cut this year, the Fed is going to deliver one hike, take it back in 2027, and then deliver the cut that they were on the menu to do this year 2 years later. Obviously, this is going to translate to much higher rates over the entire period, though we can see the longer run numbers remain, and we continue to call for a 3.1 longer run view. Now, a critical part of this dot plot update is that Warsh did not contribute to it. He has a philosophical disagreement with the idea of a dot plot, and he did not participate. So this is the view of everybody except Kevin Warsh on the FOMC. And that's a fascinating thing, because when the Fed chair came out, he basically said, I will not speak to anything that is not already in the dot plot, because guess what? We don't do forward guidance. Well, la-di-da. Okay, so this then looks very hawkish. What say you, Kevin Warsh, who came into the job of Fed chair with a mandate from the White House to be a lot more dovish than former chair Jerome Powell? Well, the committee will deliver price stability, is what the chair says. And short of any further explanation, this is how the committee defines what price stability is then. Now consider the other adjustments. Growth revised lower for this year, revised higher for 2028, which comports interestingly with there being a rate cut that year. The unemployment rate seen a little bit lower this year than previously expected, otherwise steady. Inflation much higher this year, but seemingly somewhat transitory flavored. We can see here that the big spike is this year, then things start to cool off next year, and then we kind of even out by 2028. But there is a meaningful hump here of inflation, and not surprisingly, that implies higher rates. And if you listen to the Fed chair, his perspective is price stability is where we got to go. That's 2% inflation. Now, in his press conference, Warsh also announced that he's going to be introducing 5 different task forces to look into changes, institutional changes, to various things that the Fed does. A task force on the balance sheet, a task force on how the Fed looks at economic data, a task force on inflation, a task force on the labor market, a task force even on innovation and AI. All of these task forces are supposed to come together, and they're supposed to be made up of people from within and from without the Fed. The Fed chair stressed he wants the best minds. Okay, that's a good start, I suppose. Then he expects that we're going to start to see work on this begin in the coming weeks, take the next several months to play out, and end up with results by year end. In the meantime, it looks like we're going to have business as usual for continuity, other than things like much shorter policy statements than perhaps folks were used to, even just to signal it's a new day. Do not expect for us to continue to do everything as we've done before. There is a clear shift in leadership here at the Fed and a clear shift in what people want to do. So looking at this then, this becomes the baseline wisdom for now. Warsh stressed that the 2% inflation goal is outside the scope of their rethink of the Fed as an institutional framework. So that stays. Maybe the way that you measure what inflation is, and Chair Warsh is famous for liking the trimmed mean measure, which estimates inflation lower than some of the other headline numbers currently. But sometimes it's a different story. And so even if that were the case and the bogey were to change, and essentially he would move around the goalpost and say, well, we're closer to 2% inflation than thought, because we're going to change the way that we define what 2% inflation is. Is it 2% CPI or PCE or Dallas Fed trimmed mean? Well, those are different targets. If that occurs, it doesn't occur until the end of the year. In the meantime, we're still targeting 2% PCE inflation. We're clearly oceans away from that. The Fed chair is stressing we're going to deliver price stability with a view that it should have been done yesterday, and so a significant sense of urgency. The committee is saying that means rate hikes. The Fed chair is not resisting, at least not openly. What does that mean for markets? Well, looking at Fed funds futures here, we've got a full rate hike and then some priced in for this year. 36 basis points reflected in Fed funds futures. That's at least one hike, fully discounted, and about 11 basis points in the direction of a second, which makes it narrowly better than even odds. That's dramatic, of course. And then for next year, we reflect the idea, as we see in the dot plot, that the Fed wants to take the rate hike back. So down almost 19 basis points next year. So again, a kind of hump in the Fed outlook here, where we hike this year, we take it back next year. But because of this disconnect here between 36 basis points and 19, the bias is clearly leaning in a hawkish direction. If we look at the aggregated probabilities here, we can see the market has dramatically increased when these rate hikes were supposed to arrive. It's certainly a stark thing to say, well, here we just had the June meeting. We're going to have another one in July. By September, the next update of the summary of economic projections, we've got an 80-20 chance that in a cumulative way across a range of scenarios that we're going to get at least one hike. By October, we're looking at 95% probability that we're going to get that hike. And by December, we've got a 53% chance that we have had 2 hikes. In fact, we've got a second hike on the menu, again, cumulative probabilities here, all the way through the end of next year. And only by the end of next year do we start taking that hike back. So we're looking at a situation here that's much more hawkishly minded than what the markets were aiming at. And everything that the Fed chair said really seemed to suggest that he's interested in price stability first and foremost. And if the committee seems to suggest that that means a hike or 2, he doesn't particularly seem to have an issue with that. Now, of course, that makes sense. We've been talking about the idea that looking at the inflation numbers, especially the most recent ones, the most striking thing is that we had an increase in core services inflation that boosted core prices, even outside of the obvious shock on the energy side as a consequence of the U.S.-Iran war. And then when we pull apart that core inflation into 3 main components, we can see the most important piece of it, of course, is services. We can see here that core services accounts for over 2% out of the 2.9% in overall core inflation. Whereas what's going on in goods is tiny, and although it's a decline, that decline seems to mainly reflect early signs of demand destruction. A lot of this seems to be a fading demand pull price impetus in cars and auto parts, which of course are sensitive to higher energy prices. So the key here is this: the pickup in core services inflation, the stickiest and the most significant driver of overall direction, and a rebound here all the way back to levels we hadn't seen since the middle of last year, before that disinflation that got last year's Fed to cut by 75 basis points toward the end of the year. And needless to say, the question here is, okay, well, why are we getting this rise in core? Isn't the shock here mainly energy? And of course, we've already seen over the past several months that the inflation from energy is spilling over into core via things like warehousing costs, freight costs, and that's occurring in both wholesale inflation, so PPI, as well as at the consumer level, CPI, which we've got on the chart here. And that's already spillover, but the Fed was talking about inflation quickening even before this war started to present evidence about what its impact is going to be. We already heard that from former Fed Chair Powell back in March and subsequently in May. So we're looking already at a situation, according to the rhetoric then, where inflation was quickening and then there would be an energy shock that the Fed would later assess, and obviously is now able to assess better, as can we, looking at this CPI data and seeing the scarring from the war holding and now perhaps increasingly baked in on the services side. That inflationary impetus before the energy shock, as we've discussed again, comes largely from the makeup of the way that the economy has been growing so far this year. We've said that the economy has only recovered about halfway to the growth rate in the second and third quarter of last year, which was closer to 4% after a big downturn in the fourth quarter around the government shutdown that slowed growth to just 0.5%. We're almost back to 2% in the first quarter, but we can see it's mainly driven by a contribution from investment, whereas the contribution from consumption is relatively modest. And that, of course, is very eye-catching, considering the consumer spending part of GDP is 5 times larger than the investment part. Consumption is about 68%, investment only about 14%. Now, the way that you get such a small engine to propel the whole ship is you have to run it really hot and really fast. And that's, of course, exactly what we've seen thanks to this AI data center build out. Business investment scorchingly hot at 10.4% year on year, or annualized rather, in the first quarter GDP numbers, whereas consumption slowed for a second consecutive quarter. And by the way, sure, it slowed during the government shutdown, but post-government shutdown, it just kept slowing. So the consumer here, understandably hamstrung. Tariffs and the energy shock certainly don't help. But when you have to have this kind of a mix to drive growth, well, you're going to spin that small engine of investment really hot and go really, really fast to not get very far at the headline. And of course, that means inflation onto itself, making the Fed's now hawkish disposition an understandable one, of course, because all that we've had since this lay of the land started to emerge are further inflationary risks, the U.S.-Iran war, of course, chief among them. And so, from a positioning perspective here, I am back short gold. That looked like a trade that was starting to come around again. We've of course, seen this trend develop, and we've been short it really all year. But we got out here on the bounce. Of course, didn't pick the exact bottom. That rarely ever happens. But it's been a lucrative idea being short gold this year. And now looks like it might be time to get back in. And so that's what I've done here. I'll scale this up to the degree that it works. I'm still very much long the US dollar, so short the Aussie, the pound, the euro. In my spot account, also short the Swiss franc. I'm still looking at these puts in the bonds. The TLT put vertical I had essentially expired worthless, but these puts that I have here, they still got plenty of time on them. They're at the middle of the curve, which seems to have worked better. And so they're still there looking for higher rates. And of course, the pain in risk sentiment finally comes around today. And so I'm still looking at these short call verticals in the NASDAQ via the Qs, in the S&P via SPY. And I'm still long a driver of inflation here via this call vertical in natural gas. We'll see how that develops. We'll see also how oil develops. It might be time soon enough to get back long that, but we need a little bit of confirmation here as we look at what happens at support. As we can see here from earlier in the show, it was testing here, but we don't quite know that it won't break yet. We need some sort of a sign of life, and we'll be on the lookout for that. And that is macro money for today. As ever, we are here right after overtime. That's a show that I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money returns tomorrow. Happy trading.
Good morning, everybody. It's Wednesday, June 17th. You're watching Tasty Live. I am Jamal Chandler, joined by the